Good morning. Bon matin à tous. Great wake-up music. I love this. All right. Welcome to Critical Metals Day. We have a packed day of presentations and panels for you today. We're very excited. As usual, before we continue, I would like to thank our gracious and generous sponsors who have joined us this year. Many of these sponsors have been with us through the beginning and have helped us with our journey. And just a reminder that we have two fabulous events tonight, starting with our sponsors cocktail and core shack back in our gala facilities. That starts at 6 p.m. In the January Salon, where we continue from last evening. We're ending the evening on an incredible high note with the Atkins Realis After Dark event at the Hilton on the second floor ballroom, where the ballroom is located. This is really not to be missed. They are going to host the most amazing After Dark we've ever had. They're very excited about it. So please drop by from 9 p.m. to midnight tonight. And now, it is my absolute pleasure to welcome your morning keynote speaker, Terry Solomon, CEO of Solomon Partners. Terry is the Honorary Consul General of the Republic of Singapore. He is also an author who wrote about his experiences of serving with the United States Marine Corps in Vietnam and to becoming one of Canada's most important philanthropists. Terry was recently appointed to the Order of Canada for his many contributions to the mining industry. Please help me welcome mining titan Terry Solomon to the stage.
Bonjour, Mesdames et Messieurs. C'est un plaisir pour moi d'être ici, avec vous aujourd'hui à Québec. Je tiens à remercier Joanne et Kimberly de m'avoir donné l'occasion de parler devant vous. Je suis québécois de naissance. J'apprends le français. J'ai hâte de pratiquer mon français avec vous à la conférence. Merci beaucoup. I'm honored to speak to you today. When I was asked to discuss the status of mining finance from the eyes of a veteran, I decided to pause and think about it. I came from a mining family. My father was a professor of mining and metallurgy at McGill University. Prior to that, he worked as an engineer for Noranda Inco and was mine captain of a mine that I have fond memories of, the Wade Amulet mine, 8 kilometers from Rouyn-Noranda, where, as I said, he was mine captain. I joined the United States Marine Corps in 1962 after working at Gaspé Copper Mine as a teenager for 2 summers. I also went to Boston to watch my uncle. Took me to a baseball game, Ted Williams' last game at Fenway Park. I started in the investment business as a research analyst in Old Montreal with a company called Nesbitt Thompson on the corner of Rue Saint-Jacques and Saint-Pierre, which led me to find my first mining client, which was a subsidiary of Canadian Pacific called Cominco. So in the research department of Nesbitt Thompson in those days, we truly had legends in there, including one man who invented the bought deal, which virtually everybody knows. But all the companies that people wanted to cover were all taken. So I was told by my boss to go upstairs to the tiny library in Old Montreal and see if I could find something to cover. So I ended up finding Canadian Pacific, and the only reason it was available is nobody wanted to cover it. It was too complex. But they were very, very involved in the mining business, in the coal mining and oil and gas. And so I took this on as a project and produced a 110-page report, which was long in those days. With the help of Lawrence Bloomberg, who became the founder of First Marathon, very successful guy, him and I went on the road to market this in Chicago, Boston, and New York. We had this philosophy of producing high-quality research because people paid for it. And they paid for it in spades. So one Quebec-based institution, actually, I took a picture of their office here in Quebec City, Caisse de Dépôt, Déplacement de Québec. They were a client of ours, occasionally. But when we had a new issue that we didn't call them on, they got very upset and called us and said, don't assume the case doesn't want to see what you have to say. And they promptly encouraged us, not encouraged, they promptly installed a direct line to our trading office, trading desk. In 1991, at Nesbitt Thompson, I started with a couple of my colleagues, the mining team that is now the famous BMO conference, and sort of reminds me of this when I started it all those years ago at Whistler, British Columbia, where it continued to operate for a number of years. But the strategy we wanted to bring together exploration companies because they weren't getting any attention that they deserved, and they were providing the future of this industry in terms of resources and new ore bodies that they found, because the exploration was being done largely by the juniors. So today, that has changed dramatically. We have very few funds that participate in exploration companies. So we decided to, when I formed Salmon Partners in 1994, we decided to continue that model, and for a long period of over 20 years, we had great success in telling largely exploration stories to institutions. We took risks, and we took risks and gave great opportunities to people that were unknown. But we had some early supporters, which one of them was Ross Beatty, although at the time it was his second company. And there's a great story that we did the first cross-border deal, and he called me at the West Coast, at Bamfield in British Columbia, which is the start of the West Coast Trail on Vancouver Island. And he says, I want to raise some money. And I said, how much? And he said, $10 million. And I said, well, Ross, the problem is I'm on the West Coast Trail, just about to start it. Can it wait 4 days? He paused, and he said, yes, it can. He's an outdoors person, so he said, yes, it can wait 4 days. So we proceeded to do the first cross-border deal with him. So we found rare companies that people really liked, and we went with people like Ross and someone like John McCuskey, who now runs, I think it was a $15 billion company, and Alamos was one of our early picks. We financed that in one summer day we agreed to the terms on my dining room table, and from there we had great support. The stock had a market cap of $20 million at that time, went down to $500,000, and then John was able to buy Mulatto's, which for $20 million, which produced since then to now about $800 million of cash flow. So it was a big winner, but he financed it like many people in those days with mortgaging his house. So today, institutions are far and few between in terms of supporting junior mining companies. But in the early 90s and 2000s, they were strong supporters, and that's why we were able to do very large transactions with unknown companies for the most part. Today, the institutions are not very prevalent because, I'll give you an example. Gluskin and Chef was a client of ours, and I brought in a company called Grand Cache Coal, and we were looking for $10 million. And Ira Gluskin was a fund manager at the time, and he said he was smoking a cigar. He smokes Cuban cigars in the top in his Bay Street office. You could hardly see him. And he put up his hand. He said, "Why don't you get these nice people at Salmon Partners to raise you $50 million?" What he was really saying is he would contribute a lead order if we did that. And so, but Ira was a great believer in the mining business and exploration companies, and he had the vision that many people don't have. So today, what do we do? Since the retail investor is no longer prevalent, what is happening is that the issues are getting smaller. They are getting upsized, but in a modest way, not the way that Ira Gluskin was talking to me many years ago. So, and the other problem is the issuers, the juniors, keep coming back. And oftentimes they talk about the next issue when you're selling you the first one, which is a real no-no because people say, well, I'll just wait for the next one. So, and another thing, the flow-through shares have been a godsend in many ways, but a curse in others. By that I mean that they clip the warrants and sell the shares and often, and you have a down pressure on the stock that lasts a long time. But because the flow-throughs are the only market of any size, it's a kiss, it's a kiss of death. But on the other hand, internationally, of course, it doesn't. You're back to producing hard dollars and good stories. So, in Nesbitt Thompson in the 80s, we wrote our own research reports. We marketed them endlessly on trains and planes, where the bigger players were. Today, we have a lot of large players that are individuals like Eric Sprott, Rob McEwen, sometimes others. But generally speaking, there's very, very few players like that. Streaming companies, of course, are providing. You heard one of my colleagues who used to work for me, Haytham, speak yesterday. Wheaton and others, we were one of the first financiers of Wheaton. Wheaton and others provided streaming opportunities, and they're great opportunities that didn't exist for some time ago. You can take a look at the Artemis. Stephen Dean at Atlantic Gold tried to raise money, and I remember running into him at a conference like this, and he said, there's no money for this kind of company. And then he ran into Ryan Beatty, who's a real estate developer in British Columbia, quite a successful guy, and he provided his first big order. In Artemis, Ryan Beatty is the largest shareholder. So there are people like Ryan Beatty out there, but they're hard to find. There are players like the Saudis. They are we've got a group coming in next week to talk to. They want to talk to mining companies, but they're more interested in large companies and not smaller ones. But we have a good turnout. But what can be done? I always use the example of Australia, and I've been to Perth many times, but in the skylight you always see great support for the mining industry. By that I mean you'll see the logos of BHP, RTZ, and foyers named after them. So it's a real mining community that's quite evident. Whereas hard to find a mining company with its logo on the top of a high-rise in Canada. It's just not the culture. Part of the problem is the educational system really doesn't promote mining, and it's important, especially today in the day and age of tariffs and green energy and whatnot. So Pierre Lassonde in trying to acquire Elk Valley, which was a client of mine at Canadian Pacific, it was called Fording Coal. And Ian Sinclair, who was the CEO at the time, always believed that that asset had the potential to produce the greatest the greatest cash flow of any one of his companies except the oil and gas company, Canadian Petroleum. So, you know, it was very, very supported by many institutions, and at the time we raised money for Fording Coal. But today it's almost impossible to get that kind of support. So, and Mr. Sinclair himself would go on a roadshow. So Teck ended up to be one of my clients, and they bought Cominco, and we acted for them, and it's been a huge success. And you know, what is missing though is the institutional support. The other ones that were strong in supporting juniors was Teck itself. Teck was the biggest player to support juniors, and any one time they probably had 50 junior investments, and they were sizable, and they ante up each time. One example that they are still an investor in and ante up at higher prices is Kodiak Copper. So I think more has to be done to increase pension funds, like in Australia, to support the mining industry. And how do they do that? Well, in Australia, I think they're mandated to. That's part of their DNA. They have to support the mining industry, and they rarely leave Australia, and nobody takes over BHP or RTZ. It's just not going to happen. Whereas in Canada, somebody can take over Elk Valley, as Glencore did. There wasn't much opposition. Chrisley Frieden was the minister, and I talked to Pierre Lassonde, and his comment to me was, she's not going to do anything. And that's telling. That's a telling story of sort of not in your own backyard. We like the industry, but really don't want to support it because it has all this negative connotation, as young people seem to articulate. So I think the pension funds who could support these large deals do have the ability, but they don't. Prem Watts is one of the rare ones, and you'll notice with Pierre Lassonde's recent acquisitions with Orla, that they do step up, and Prem is a large supporter. Another way that we can improve the institutional equity market is to make it more easy for institutions to get regulated. There are many flow-through funds. They're expensive to create, but a hard dollar fund is something that can be encouraged, and these large regulators have the ability to approve them and fast track. When I formed Salmon Partners in 1994, in September of 94, we had regulatory approval within 2 months, and the cost was minor compared to now. The regulations have increased so much that the barriers to entry are hard and high. So, I remember when I spoke at St. Andrews by the Sea at an IDA convention, the Quebec minister in charge of securities regulation at the time showed up, and what he was wanting to demonstrate was the amount of regulations that we have to increase every year. And so what he did, in the middle table where he was, he put layers, he put books showing how many regulations have increased year over year over year, and it was almost 6 feet tall, starting from a much smaller base. He was trying to demonstrate a point, which he did. And as much as we regulators try to decrease the regulation, it's really, really difficult. And the other thing is the mining permitting process, as everybody knows. We've heard our speaker yesterday say how difficult it has been. It's still difficult, but there are signs of hope. I went to a dinner in Vancouver, and Ross Beatty was actually with me on that particular night. And the Premier sat there, and the Premier walked in, probably his third dinner of the night, but he said, put out his hand to Ross and said, "Congratulations on your Lumina Gold deal," which was a $580 million deal that had just been announced. So he was well aware, and very pro-mining, that government. So I think but what I love about this industry is the money that is out there, so stuff it is people find things, and there's a huge amount of exploration activity going on in Canada and abroad, and the juniors need to be supportive. So we as a firm have them come in 2 or 3 a week sometimes to listen to their presentation. Sometimes we do just that. Sometimes we just invest in them. Oftentimes we recommend that they do certain things to improve their profile. So we're doing our part, but other people have to do it too. So, but I'm happy that we're here. I'm here today, and I'd like to open up for questions if possible. If anybody has any questions.
Hello, I really enjoyed your speech. Thank you very much. I'm the chairman of Rosoro Strategic Metals. We were a TSXV listed company back in 2022. And then we've just recently done a secondary listing on the Australian Stock Exchange. Finding it very easy to raise capital in Australia. There's a lot of money for mining projects there. Our difficulty is in the Canadian market and the Australian market in the aftermarket. We're finding absolutely no support whatsoever. We raised money at 50 cents. We reported a 1.4 billion tonne measured and indicated resource, largest titanium and rare earths project in the world in Brazil. Great jurisdiction. Everyone loves the project. Our stock price went from 50 cents to 72 cents when we announced the resource, and we're trading at about 20 cents now. And that's purely because absolutely no liquidity in the market, no retail investors are buying the stock. We're not looking to raise money, and we're looking at various non-equity financing, like selling a royalty. We're speaking to the DFC about funding and technical assistance. What's your solution to generating retail investment or on-market buying in, obviously an extremely valuable project trading at a huge discount?
One of the things that people don't do enough, they attend a lot of conferences, but they don't actually go to the mine site. So, when I worked in Gaspé Copper, it was a big visual what goes on there. It's a beautiful place, kind of remote in those days. I'm sure it still is. Taking people to a location is a really good way of getting some institutional interest. There was a company that I financed, the first silver company on the Toronto Stock Exchange, actually, that was Mexican. So on the way to, we decided, this was kind of institutional investors and investors, retail investors, like parties if you're successful, and they want to see success. So I took them to the property, which was maybe an hour and a half from Acapulco, which at that time was a very safe place and attractive place to have a closing dinner. So we walked this property, and it was, one of the properties was Los Filos, which was a 2 million ounce deposit, high grade. And those people walking that, retail, high net worth, research analysts, they got the picture right away. There was what ended up to be a series of 8 deposits, small. Each of them were a million ounces, but Newmont had a mill there, so it was like a great opportunity. And we financed that company privately. In those days, I think the first round was like $18 million. And privates are virtually impossible today. And yet, so taking them to the site, trying to get some technical person behind the property. Titanium is difficult, but it's also, I think, a critical metal and has incredible uses in aviation and other technology uses. So take them to the property. I know there are quite a few titanium deposits, good ones in Quebec actually. So taking them to the property, get some really good technical support, but the technical support has to be simple because investors don't have a lot of time. So if it gets too complex, they'll walk away, they'll back off. So I would say, talk to me or other people and try to get people to come out and do it in the summer. Okay. Thank you very much. Really appreciate your help today.
Good morning, everyone. My name is Mary Zhang, and I'm a director on the Mining and Metals Investment Banking team at National Bank. I'm pleased to be your conference moderator again this morning. Next up, please help me welcome Mark Bedard, Chief of Operations, Custom Metallurgical Assets for Zinc and Copper of Glencore Canada. Glencore Canada is a leading global natural resources company with major mining and metallurgical operations across Canada. Please put your hands together for Mark.
Thank you. Bonjour à tous. C'est un plaisir d'être ici ce matin avec vous. Toujours un plaisir d'être dans la ville de Québec. Merci beaucoup aux organisateurs pour cet événement qui nous permet de nous rassembler ici. Sounds like I have to do this in English this morning, so let's get this done. What I want to talk about this morning is the importance of the midstream. So I know that there was a lot of conversation around the importance of mining and getting the ore out of the ground, but what we do with it after is quite key as well. So if we don't have metallurgical facilities in order to process the material that gets out of the ground, we're still facing an important challenge. So just before I get started, maybe just who we are at Glencore. I'm the COO of all the custom metallurgical assets worldwide for Glencore. So Glencore, it's basically 150 sites worldwide, in more than 30 countries. We've got more than 50 marketing offices, and we employ more than 150 people worldwide. The differentiator for Glencore is the fact that we operate industrial assets combined with marketing, so we can sell our products worldwide. In Canada, we've got an important presence, and it goes back 100 years ago with Noranda and Falconbridge that were purchased by Xstrata and now Glencore. As you can see, we play a key role in the production of critical minerals throughout Canada. So we can see on the screen, we've got copper, zinc, cobalt, gold, platinum, and much more. And the reason why we're able to do this in Canada is that we've got an important network of sites. So it all starts with mining. So we've got 3 mines in Canada. I'm talking just base metal. In Raglan, where we produce nickel and cobalt. That material goes through Sudbury, and there's mines also in Sudbury, basically copper and nickel. And then we've got the kit operations as well in Timmins that produces copper and zinc. And what do we do with all that material once it's out of the ground? Then we send it to our metallurgical assets. Most are based in Quebec. So we've got the Horn Smelter in Rouyn-Noranda, the CCR refinery that takes all the material from the Horn Smelter in Montreal, and CE Zinc in Valleyfield, which produces zinc, and we also have General Smelting, which is a small lead producer. So the fact that all these sites are here makes it great, because all the ore coming out of the ground goes into our facilities, gets refined, gets processed, and then we can keep the entire production chain in Canada. I think it's important to say that we do the exact same worldwide. So this is just a quick snapshot of the sites that I manage. So the setup that I was talking about in North America exists also in Europe. So that really enables us to take the material from our own mines in those regions, also provide services to juniors or other companies that don't have metallurgical facilities to process the material through, and also to import a lot of material, concentrate, recycling material from other regions to add value in those regions in order to produce the minerals that we need for the future. Just want to go back to North America. These sites have been there for quite a while, so we go back 100 years, and the reason why they're still in operation is that they have been able to differentiate themselves from the competition. So yes, you need a good process. Yes, you need to be productive. You need to be efficient, but you also need to find a way to differentiate yourself. And what those assets have been able to do is that they've been able to process material that other sites are not able to do, but they also do a lot of recycling. So what's important to understand is that in Canada, there's a huge gap between supply and demand when you look at the relationship between the mines and the met assets. So in other words, there is not enough material for the met assets to be full. So they got to find ways in order to fill the production capacities and stay competitive. So how do we do this? We use recycling. So best example that I can use is your best friend, your cell phone. So once you're done with it, we collect it, we shred it, and we send it to our copper smelter up in Rouyn-Noranda. And I think it's important to understand that to do recycling, it's important to have the size in order to be competitive. But more than just the size, you need to have the right process to recover all the metals. So just in the cell phone, we're talking copper, gold, silver, palladium, platinum, nickel, lead. So there is a lot of metals that needs to be recovered. And if you don't have the right process, it's very difficult to do it. But on top of having the right process at one facility, you need a network of facility, because sometimes, or not sometimes, but most of the time, a copper smelter can do very well copper, but cannot recover all the lead and all the nickel, for instance. So if you have other met assets that can do this, altogether, it gives you a great competitive advantage. So what we process, as I said, we've been able to stay in business because we're able to diversify ourselves to process material that others cannot do. So there's a variety of materials that we're able to process in these facilities. However, right now, it's quite worrying what's going on in the smelting world. So we've got a lot of good assets here in Canada, but we're facing a lot of competition right now. So in other words, what's going on right now is there is not enough material for all the metallurgical assets worldwide. So we need more mines, we need more production coming from the ground. And the impact for us right now, because of the lack of material, is that we're all fighting for it. So what it does is it drives the treatment charge. So basically, we're getting paid to process material, and the fee that we're charging is at an historical low right now. So it makes it very, very difficult to compete. Even that at some point last year, instead of being paid to get the material, we had to pay to get the material. So we were losing money on every ton that we were processing. So that's a very worrying environment right now when you look at the smelting world. And I'm just trying to gain a bit of time this morning, but this is the last slide of the presentation. And I think it's a very worrying slide when we look at historically what happened in North America. And I'm just going to talk about copper, but the same applies to nickel and zinc and lead and any other base metal. So what we have seen over the last 15 years is a lot of metallurgical assets have disappeared from the map in North America. They were not able to compete. They were not able to stay in business. And the end result of this on the copper side, and copper, as you know, is quite critical for the new economy. So when you want to transmit electricity, you need copper. So you need copper in a lot of application. And when you look at the supply and demand over the next 10 years, we see a huge gap when we talk about copper. But in North America, right now, there's only 3 copper smelters left to take the material from the copper mines or from any other facility that has copper as a byproduct and bring it to the finish line as a pure product. So the only one is Rio Tinto in Salt Lake, Freeport in Arizona, and the Horn smelter in Rouyn-Noranda, combined with the CCR refinery in Montreal. So when you look at this picture, this is worrying. I know there's a lot of conversation about we need to do more to get the ore out of the ground, but if we get the ore out of the ground and then we don't have any facility to process it in North America or even in Canada, then the ore that comes out of the ground is going straight to China or elsewhere. So we're back to square one. So my message here is that we need to protect that industry. We need to do more to protect our metallurgical assets. They bring a lot of value. I'm talking about processing of metals, but they also produce a lot of sulfuric acid that we need for many applications. So these assets are quite important and key to protect for the entire industry. And that was the last slide. Tried to get back on schedule. I won't take any question. Thank you very much.
Thank you, Mark. Next up, please help me welcome Guy Lebel, President of XXIX Metals. XXIX Metals is a copper-focused exploration company advancing high-potential assets with a commitment to responsible resource development and long-term value creation.
Merci à tous. Merci spécial à Joanne Jobin et à toute son équipe. Alors, je m'appelle Guy Lebel et je suis le PDG de XX1X Metal Corp. Généralement, quand je suis sur scène avec un micro, c'est parce qu'on m'a invité à un bien cuit. Je vous avertis, il n'y aura pas de ça aujourd'hui. Je vous invite à visiter notre site web, de vous signer pour les mises à jour. Il va en avoir beaucoup d'ici la fin de l'année. Lisez aussi les énoncés prospectifs. Je dis la vérité, mais le futur pourrait changer. Je vais prendre la petite manette. Voilà. À 29 Metal Corp, on possède 2 actifs de qualité qui vont bouleverser la valorisation que vous donnez à notre compagnie. Ces 2 anciens producteurs de cuivre qui sont situés près d'infrastructures de qualité, Au Pémisca, on vient de publier une mise à jour de nos ressources minérales. On s'en va vers un PEA. À Thierry, qui est notre ancienne mine cuivre et platinoïde, on est en train de revoir le concept de la minéralisation et puis il va y avoir de grandes nouvelles qui vont sortir prochainement. Si on parle d'Opémisca, de son infrastructure, c'est tellement bien situé. Vous avez les routes, la rail jusqu'au site, l'aéroport, la communauté qui est accueillante. Tout ça, ça réduit les coûts de construction, les coûts d'opération, les coûts de développement. Je voudrais pointer ici le Springer Perry. C'est autour de ces deux anciens puits-là que nous avons fait nos ressources. La ville de Chapet est ici. Le puits Cook et Robitaille, c'est deux puits pour lesquels on n'a pas encore fini de compiler la ressource. Cook est une ancienne mine d'or. Il minait 5 grammes à la tonne sous terre. Le pilier de surface est encore intact et puis on va regarder si on peut l'incorporer à notre projet au moment qu'on va faire la préfaisabilité. Les nouvelles ressources minérales pour Opémisca. En bref, deux choses. Plus de cuivre, plus d'or dans une fosse plus compacte. On parle de 140 millions de tonnes à 0,69 cuivre équivalent. Comment ça se produit? Eh bien, ça se produit parce qu'on a tenu compte maintenant des stockworks qui entourent les zones de haute teneur. On parle de fractures à orientation aléatoire dont on n'avait pas tenu compte au début quand on regardait le projet. Ça change complètement l'économique du projet. La dilution est maintenant avec du minerai plutôt que du stérile. Le stripping ratio va baisser, les coûts vont baisser, plus grande flexibilité opérationnelle, une mine de plus longue vie. On dérisque le projet. Attendez une seconde, je vais me pincer pour être sûr que je ne rêve pas. Pour un CEO, c'est le projet parfait. Vous avez une idée ici de ce qui se passe avant et après les stockworks. On regarde pour à peu près 30 mètres de chaque côté des zones de haute teneur. C'est beaucoup plus facile de passer un pit ici que ce l'était, disons, l'année dernière. Quand on parle d'une fosse plus compacte, on peut regarder ici, vous avez la ressource de 2024, la ressource de 2025. La différence vient qu'on a utilisé des paramètres plus conservateurs qui sont plus proches de ce qu'une firme d'ingénieurs utiliserait pour faire le PEA. Alors, il n'y aura pas de surprise quand le PEA va sortir. Au centre, en ce moment, c'est ce que les gens qui nous connaissent, qui entendent parler de nos communiqués de presse, on appelle ça la saddle zone. C'est une zone qui est encore un peu mal comprise et puis si on ne la sort pas en ce moment, eh bien, on laisse un peu de minerai en arrière. Ce n'est pas perdu, c'est toujours là. Si l'économie change, eh bien, on va réussir à aller le chercher. Comment on va créer de la valeur au Pémisca? Eh bien, le MRE est déjà fait. On va driller Cook en cours de l'hiver, l'automne. On va faire un PEA pour probablement le 3e trimestre de l'année. Et puis, ensuite, on va s'en aller dans les études qui vont supporter la préfaisabilité, c'est-à-dire toutes les études qui sont montrées là, qui permettent un jour de faire une préfaisabilité, de faire les trade-offs et ainsi de suite. L'étude de préfaisabilité est l'étude la plus importante pour un projet. C'est là qu'on décide comment on va faire notre projet. Et puis, c'est important d'avoir toutes les études techniques en amont de l'étude de préfaisabilité. Tout ça, ça va coûter à peu près 3 à 5 millions de dollars. Mais plus vous dépensez avant, moins votre préfaisabilité va vous coûter cher. Maintenant, un petit mot sur Thierry. On a acquis Thierry pour 12 millions de dollars au mois de décembre. C'est encore un endroit qui est bien entouré, bonne infrastructure. Il y avait un ancien producteur ici, K2, une mine souterraine qui a opéré pendant 6 ans, de 1976 à 82. Pour ceux d'entre vous qui sont assez vieux dans la salle, vous savez que c'était le deuxième choc pétrolier. Le taux d'inflation était dans les double digits. Les prêts personnels étaient à près de 20 %. C'était des très mauvaises années pour partir une mine. Ils ont laissé derrière 25 millions de tonnes à 1,6 cuivre, plus les platinoïdes, plus du nickel, de l'argent et ainsi de suite. Teneur de 1,64. Il y a 200 millions de dollars en valeur d'aujourd'hui d'infrastructures souterraines, un puits jusqu'à 1500 pieds, des rampes, des galeries et ainsi de suite. Malgré tout, ce n'est pas ça qui nous a intéressés à Thierry, c'est la zone K1 qui est ici. En 2010-2011, un rapport de personnes qualifiées nous donnait 53 millions de tonnes à 0,38 cuivre, plus les platinoïdes, plus le nickel. Ça a été fait à partir de forages qui ont été faits jusqu'à, disons, 2010-2011. Par la suite, des forages, disons, jusqu'à 200 mètres. Entre 2010-2011 jusqu'à maintenant, il y a eu quelques autres forages qui ont été faits en profondeur. Ce qu'on remarque, c'est que plus vous drillez profond, plus la teneur augmente. La teneur dans la zone ici, du trou qui est là, 0,53, c'est 40 plus élevé que la teneur moyenne des 200 premiers mètres. Qu'est-ce que ça veut dire, ça? Ça veut dire driller. OK? Il faut retourner, il faut driller jusqu'à 500 mètres, 600 mètres en dessous, savoir si vraiment le modèle qui dit que la teneur augmente en profondeur est juste. Vous avez la coupe AA qui est ici. Voici ce que ça fait en coupe. Le 53 millions de tonnes historique se situe dans les zones plus foncées. Si vous voulez prendre ça en fosse, vous avez ici une largeur d'environ 200 à 300 mètres, dépendant où vous vous situez dans le gisement. La teneur augmente en profondeur. C'est ouvert en profondeur, c'est ouvert dans l'axe. La nouvelle interprétation va peut-être nous donner une teneur à peu près égale ou légèrement supérieure, on verra. Il n'y a pas encore de personne qualifiée qui a fait un rapport. Le tonnage augmente d'une façon significative. Je ne peux pas vous dire le tonnage, mais je peux vous dire que je suis 3 à 4 fois plus heureux que je l'étais au mois de décembre. On va prendre la prochaine ici. Excusez-moi. Maintenant, si on a raison pour le fait que notre modèle existe, le modèle existe, le modèle que nous avons est vrai, on va devoir voir qu'est-ce qui se passe entre K1 et K2. Il y a déjà eu de la géophysique, mais si on croit, ce qu'on voit, c'est que les gens ont foré trop haut dans le système. Alors, K1 plonge probablement vers K2, et puis même si vous avez des indications de géophysique, il faut forer en profondeur. C'est ce qu'on va faire dans les prochains mois. Le but étant de dérisquer tout le package. Comment on va créer de la valeur à Thierry? Eh bien, on va finir par compiler K2. On a encore tous les trous historiques, toutes les ouvertures souterraines, il faut que ça soit digitalisé. On va faire de la géophysique entre K1 et K2. On va faire notre nouveau modèle. On va faire des forages en dessous de K1 pour prouver que notre modèle est valide. Et ensuite, on fera un nouvel état des ressources et une PEA. Pour se rendre jusque-là, ça va coûter presque 4 millions, 2 à 3 millions de dollars pour tous les forages et un autre 800 000 probablement pour le PEA. Et par la suite, il faudra faire toutes les études techniques qui supportent une étude de préfaisabilité. Niveau corporatif, on a 250 millions d'actions. Aujourd'hui, on a un market cap d'environ 30 millions de dollars. On a 5 millions de hard cash en banque qui nous permet de faire beaucoup des choses que je vous ai montrées pour l'instant. On a aussi des actions d'une compagnie sœur pour à peu près 1,4 million. Ça change à tous les jours. Et puis, on fait partie du OR Group. Je vous recommande d'aller voir toutes les compagnies du groupe. Ils sont tous intéressantes. Et puis, s'il y a des questions, il reste quelques minutes. C'est bon? Merci. Je reviens l'année prochaine pour vous dire comment j'ai fait ça.
Thank you, Guy. Next up, please help me welcome Greg Crow, President and CEO of Silver One Resources. Silver One is a silver-focused exploration and development company with projects in Nevada and Mexico, targeting near-term production and resource expansion. Please put your hands up for Greg.
Okay, thank you, Mary, and thank you everyone for being here this morning. Is this on? It is, okay. That's much better. Thank you very much, and as Mary said, we are a US-focused company. She mentioned we did have projects in Mexico, but we no longer do. Our projects are in Nevada and Arizona, and this is a flagship project. It's called the Past-Producing Candelaria Silver Mine in the state of Nevada. I'll be spending a bit of time on this asset. That's our forward-looking statement, ubiquitous to all these talks. But we also have projects in Arizona. Phoenix Silver Project is a very high-grade silver opportunity, but interestingly enough, it has excellent porphyry copper potential as well. So we are looking at working on those first two projects. We do have a third project, but it's at the early stage, so I won't spend much time on that one right now. I'll come back to this a little bit later as we get into the summary portion, but I want to spend a little bit of time talking about why silver. Silver, unlike gold, about 65% has industrial uses. We have the traditional ones like jewelry, silverware, etc., but the big growing ones are in the electronics business, the photovoltaic business. AI is becoming much more prominent as we use more and more computers, supercomputers, to facilitate the AI evolution, using a lot more silver. A lot of people don't think about this, but the military consumes vast amounts of silver, and as we have more conflicts around the world, we're using more and more silver on a daily basis. The biggest users right now, of course, are in the electric car, electric vehicle, and photovoltaic. We're currently producing just over 800 million ounces of silver a year, but consuming over 1 billion ounces. So where do we get that makeup for that deficit, which has been going on for about 4 years? Well, we get it from scrap, we get it from recycling, probably won't last much longer. Not very many good silver projects that are near-term production in the world today. Some of the factors that are going to affect the price of silver, well, instability around the world. We're seeing competition increasing around the world. We're seeing tariffs. It's upsetting the US dollar, shall we say, viability as a world reserve currency. US dollar index is coming down. It's dropped below 100. Dow Jones is still strong, but some people are calling for a correction. We're seeing record debt just in the US, but around the world as well. Potential inflation coming in again due to the tariff situation. And this is all creating an environment where people are fleeing into safe havens of gold, silver, and some into Bitcoin as well. Interesting enough, in a commodity supercycle, silver does outperform gold on a percentage basis. We're starting to see that now as the gold-silver ratio is starting to come down again below 100. So let's watch silver, just over $34 today, very strong. So let's spend a little bit of time at Candelaria on the western side of Nevada, just off the main highway that joins Reno to Las Vegas. Very well situated, excellent infrastructure. It was an early high-grade producer, discovered in 1864. Up until 1959, it produced on an average rate of 1,250 grams per ton per day. Very high grade. It went into open pit mining in the 70s, 80s, and 90s. That open pit mining brought the average grade down to about 100 grams per ton, which wasn't bad. Kinross was the last big producer, produced up till 97. With the collapse of silver prices down to about $2.50, they decided to close the mine and start reclamation, but they never completed reclamation, which is to our benefit today. Moving on, they sold it off to Silver Standard. Silver Standard looked at it. Silver prices were still well under $5. They moved on to other projects. We did a deal with Silver Standard in 2017. We finalized that deal by putting down a $2.5 million reclamation bond on one of the big heap leach pads that you saw in the original photograph. And we now have 100% with no royalties back to Silver Standard, now SSR Mining. So we've been working diligently. When we first got hold of the project, we thought we would try and bring the heap leach pads into production as a starter. But there were some complications, so we did a lot of drilling, and we've recently, within the last 3 weeks, put out a new updated in-ground resource. Well, that in-ground resource, if we add up all of those various areas, this is the in-ground resource. I'll let you look at the numbers there, and I'll summarize them for you at the end. But we also have a lot of silver on the old heap leach pads. We've got just over 30 million ounces of silver on the large leach pad and another 15 million ounces on the small leach pad. All told, we have just under 110 million ounces measured and indicated on the property to date, lots of room to expand that, and about 30 million ounces inferred. So where are we going to go from here? Well, as I said, the infrastructure is excellent. The main road that joins Reno to Vegas is in the upper right portion of this slide. 2 miles of paved road past the 2 leach pads to the old open pits. We've got down dip to the northeast, the resource that I talked about. We've got power and we've got water. A lot of necessary components to bringing a project back into production. Also, most importantly, is because Kinross never completed reclamation, we have essentially permits that are still active. They need to be updated, but we have been told by the BLM and the Nevada Department of Environmental Protection that they will update those permits within a matter of months after we get them a plan of operation. So what are we trying to do? That's some of the drilling we did. We did some metallurgical testing. Original recoveries out of the pit were about 51%, seems to be typical for these silver oxide type deposits in the United States. We're getting 66% using cyanide leaching based on the metallurgical testing we've done on the fresh material. Now, as I said, we wanted to start with the heaps, but the metallurgical work we did on the heaps, because they had been partially leached, was disappointing. It was only 21 to 29%. But we've run into a new group, and that new group is called Extract. Extract is in partnership with Bechtel, one of the biggest engineering groups in the world. They have developed proprietary solutions which they claim could increase the recoveries on our heap leach pads. We said, prove it to us. So they did some experiments, some testing on leach pad number 1 and leach pad number 2, and they were coming up with some very interesting results. As opposed to getting 21 and 29%, they were getting 60 and 70% recoveries using their solutions. Why? Because unlike cyanide that just attacks the outer surface of a lot of the crushed material and can't deal with a lot of very difficult silver oxide minerals like jarosite, etc., these solutions seem to work on an ionic basis, penetrate into that rock, and also they attack a lot of these more difficult silver oxide minerals. We're moving forward. We want to do an economic evaluation later this year. We'll probably use cyanide as a base case, but we're going to look at this extract. We're doing some additional testing with them, and eventually what we would like to do is actually do some pilot tests on the leach pads. So that's coming up in hopefully later this year is what we're working on. There's also a lot of upside potential. Major structure controls the mineralization at Candelaria. And what's interesting is to the west of Candelaria, we're seeing a different style of mineralization. It not only has silver oxide, it's got copper sulfide and very altered looking intrusive material. We want to do some more testing to see the potential for a potential porphyry. There is a large porphyry setting to the northwest of us along the Walker Trent in the Yarrington Belt. Nevada Copper did produce from that area more recently. So we think there's a lot of potential to do that. Moving forward, I want to jump down to our project in Arizona. It's just east of Phoenix, a place called Globe. one of the biggest porphyry copper producing areas in the southwest US. This was an early project at the northeast end of a 100-plus kilometer long porphyry copper belt. Higher up in elevation on the hillside, prospectors came to us and they said, we've got this project with very little outcrop. But they had gone up the hillside with their metal detectors and they uncovered these very large silver vein fragments just below the surface. The one in the middle weighed in 417 pounds, estimated to contain about 70% pure silver. Very angular, unabraded, so we thought we'd be able to find the source of these. We're at the northeast end of this big prolific copper belt. Immediately off our southwest margin is Freeport-McMoRan, the Miami smelter complex that was talked about a couple of discussions ago. We can carry on and we see Capstone at Pinto Valley. KGHM is working on the Carlotta. We're looking at essentially the Resolution deposit, which is struggling to get their permitting, but is being recently approved by Trump. And closer to our property, a brand new discovery by BHP called Ocelot. Underneath the old Dominion mine, where there are huge polymetallic veins with gold and silver, they have discovered multiple intercepts, 250 meters plus, of 0.6 to 0.7% porphyry copper. All that trends right under our property. These are just some of the samples that we discovered. We've collected over 250 of these from around the property. We drilled to see if we could find the source of these very high-grade boulders or fragments. We were successful in outlining what we think is the host structure. We did get values up to 3,000 ppm or grams per ton silver, but we didn't find the big special one. But what's interesting is we flew the property, we did electromagnetic survey, ZTEM survey, 2 big potential porphyry copper targets on the southern portion of the property that we want to do some IP work over. And if we are successful in narrowing in some of those targets, we'll contemplate doing some drilling. We're already getting some very interested inquiries from some of our neighbors with regard to would we like to partner out on the copper potential while we pursue the silver potential on Phoenix Silver. So that's what we're doing later this year. We're currently getting some contracts on the IP survey, and we're currently carrying on doing more work with respect to our metallurgical work at Candelaria. These are just some photos. You can see the workings of Freeport-McMoRan just in behind us. We're standing on our property, getting a lot of copper samples. Multiple samples return more than 1% copper that we've collected on the project. Excellent geology, very similar to what we see down at the Resolution deposit further to the south. So let's just move forward quickly. We're running out of time. We do have a third project, very early stage, long, extensive veins with copper, silver, and gold. It was drilled in the 1980s for porphyry moly. We think there's a big porphyry deposit there. Host rocks are limestone. We think there's some CRD-looking material and big vein deposits with precious metals. Not doing a lot of work there because we're concentrating on Candelaria and Phoenix Silver. So, as I said, we're going to move forward. Candelaria, continue our metallurgical testing. Hopefully we're going to get out a updated economic study towards the end of the year. Phoenix Silver, we're going to do that IP, see if we can find some drill targets that would identify some porphyry targets to drill. And then we'll see where we go beyond that. There are several silver targets that we have to evaluate as well. And Cherokee, as I said, is an interesting project, but it's early stage exploration, and we're not focusing on it right now. So there's our summing up. Largest shareholder, of course, no surprise. We've got Mr. Eric Sprott in there. But the Jupiter Fund out of London jumped into our stock in our last financing. They took up almost 60% of the placement themselves. They're now our second largest shareholder. And we have about 20 other funds and family funds into the company right now. And we will probably go back to the market in the not too distant future because we have aggressive exploration programs that we want to conduct. That's our board of directors. I'm the president and CEO. Our chairman is Luke Norman. Some of you might know Luke. He has a company called US Gold. He's presenting here. The other prominent director would be Claudia Torrenquest. She has a copper company called Kodiak Copper. You might know that one. And we are in booth 96 if you want to drop by and say hello or ask some questions. But we're out of time. Thank you very much. Thank you.
Thank you, Greg. Next up, please help me welcome Olivier Casalapointe, Head of Investor Relations North America for Patriot Battery Metals. Patriot is a leading North American lithium exploration and development company advancing the world-class Saskatchewan project in Quebec to support the growing demand for EV transition metals. Please put your hands together for Olivier.
Bonjour, bon matin, et merci d'être ici pour la conférence Mining in the North. Mon nom est Olivier Casalapointe, je fais les relations investisseurs pour Patriot. We were here last year with Ken Brinson, our CEO, presenting for Patriot. So I figured I'd do a quick recap of the last 12 months and how the progress at the Saskatchewan property project went for Patriot. In those events, there's actually 2 MRE updates that we've done in the last 12 months. We put out a PEA, and we've discovered a couple of very interesting critical and strategic metals at the property in scales that are extremely rare. And finally, I want to touch on the different demand drivers for the lithium products, which we believe that the market is severely underestimating right now. So how were the last 12 months? Extremely busy. I'll try to go in a chronological order to help ourselves navigate here. In August of 2024, we put out the first of the 2 referenced MRE updates for the last 12 months. This fed into a PEA release that we released a couple of weeks after that. The PEA showcased how cost competitive Saskatchewan would be in production setting, with very low all-in sustaining costs below $600. 24-year mine life, so a really big, long life of mine project. 800,000 tons of spodumene a year, which at the time of production later this decade would make it the 4th largest lithium mine in the world. We would do a hybrid phased approach, so it'll be 2-step. Phase 1 of 400,000 tons, and a second phase. The first phase, open pit, second phase, underground, for another 400,000 tons, using the cash flow from the first phase to build the second one. The milestone on the PEA was really important because this led to a marquee deal for the lithium industry in December of 2024. A $69 million investment from Volkswagen for 9.9% of the shares of Patriot. The deal was done at a 65% premium to the 30-day VWAP for Patriot. The offtake on that deal is for their wholly owned subsidiary called PowerCo. PowerCo aims to fulfill around 200 gigawatt hour of battery capacity out of the 450 that Volkswagen plans to need. They're doing that through 3 different plants, and one of them is actually going to be built in Canada, just southwest of Toronto, in an area called St. Thomas. That facility will be for 90 gigawatt hour of battery capacity. It's huge. It's going to be one of the biggest in the world. That facility would require the full Shekishiwanan project at full tilt production of 800,000 tons a year. So by doing the offtake agreement with us of 100,000 tons a year, it's a small part of what they need, but it's also a small part of what our project will be able to produce eventually. 12.5% of our full production, or 25% of our phase one. Importantly also, this agreement came with an MOU, which looks at two main important things. The first one being trying to solve for the downstream of the lithium industry in North America and Europe, and collaborate on that front. The second one, as you know, funding mining operations are not easy. So the second one looks at two different funding mechanisms in exchange for more material at FID. So those are two important aspects of the deal with Volkswagen. And around the same time that we announced that deal, we wrapped up a very large drilling program, exploration program in 2024. Actually, probably one of the largest in Canadian mining history, over 130,000 meters of drilling at the property, which, happily for us, confirmed that Shekishiwanan is still a globally relevant project. In fact, it's the largest in the Americas, 8th largest in the world. And this new resource will feed into the feasibility study that we plan to announce by the end of Q3 this year, calendar Q3. So why did Volkswagen choose Patriot for their first mining investment ever? Well, because when you have a large resource, you have visibility into a long mine life. We have huge crystal sizes, which can lead us to have a DMS-only operation, as highlighted in the PEA, which means lower capex, much faster ramp-up time, and which just means more profitably going forward for the company. There's pockets of Shekishiwanan in the Nova Zone specifically, which we'll capture via underground operation, which have over 2% grades, which is basically unheard of in the industry, except with the granddaddy of it all, the Greenbushes mine in Australia. And high grades mean, again, a better margin on the operations, which means resilience through the different lithium commodity cycles that we're seeing. The other thing that can help with that is the presence of very critical and strategic metals at the property, which we've discovered and announced in the last few weeks. The first one being cesium. So cesium is a bit of a more opaque market, not as well known by most investors. However, what we believe that what we found at Shekishiwanan is, again, similar to the lithium, a scale that is extremely rare in the industry. One of the last few mines, and there's about 3 of them that are well known to have operated in the last 20 years, one of them being Canada and Tinto, Bikita in Zimbabwe, and Sinclair Mine in Australia. Sinclair mined 18,000 tons of product, that 8% grade. The deposit at Sinclair, which was one of the 3 mines in the last 20 years that operated in any significant way, was about 50 meters by 50 meters with maybe 5 meters of thickness. What we've discovered here is around 600 by 400 in one part of CV13 and 200 by 80, both of them between 5 to 10 meters of thickness. So orders of magnitude larger than what has been found. And the great thing about cesium is that it currently trades for around $2,500 US an ounce, compared to just over $600 a ton for lithium. We've also confirmed that we have the 4th largest tantalum deposit in the world. Again, high grade compared to peers. And with a commodity that's up 25% year to date, due to having 60% of the production in the Kivu regions, so DRC area. And if you had Brazil was 75% of the global supplier. So having a North American / European, potential markets for our product would be very interesting. Tantalum trades for around $100 and $105 a pound right now, so over $200,000 a ton. I want to briefly touch on the actual lithium demand market, because if you just look at most of the headlines, now you'd think EVs are a thing of the past and a 2022 thing, and demand would be falling off a cliff. If you just take a few minutes and look at the hard data, what we're seeing here is that EV sales are actually doing very, very well. In fact, they were up 25% in 2024. And this year, with the data that we have, 4 months into 2025, we're not seeing a slowing demand globally. We're actually seeing a reacceleration at 29% growth year to date after 4 months of data. And that's just on the units itself. Then you need to account that hybrids are getting bigger batteries, and EVs in general are getting bigger batteries, so the content per car is actually going up. And this is the big one. This is probably the one that the Western analysts are missing a bit in their numbers if you extrapolate over the next 5 or 10 years. Battery energy storage systems, BESS for short, are getting much cheaper and are getting put into projects now with longer duration, going from 1.5 to 2 hours to now 3, 4, 5 hours, which means a lot more lithium demand. They're almost exclusively LFP cells, thanks to China doing its thing and absolutely destroying the cost angle of putting these systems in. Battery cells are down on a per kilowatt basis in terms of pricing, down over 50% in the last 18 months. This is inspiring demand of lithium batteries, and they're making their way into all sorts of systems globally. If you look at the renewable demand, especially solar, and you extrapolate for duration for the batteries to perfectly tie in with these systems to offer 24-hour continuous electricity from a renewable source, this is what is going to shock the market in the next 5 years in terms of demand. So keep an eye on those demand numbers for BESS, as they will likely be the asymmetry of information for you as investors. Lastly, I want to briefly touch on our management team, which will be the key for us to go from pure exploration to development into a producing assets in the next few years. Leading our team, because a great project is nothing without a great team, Ken Brinsden, our CEO, used to be our chairman. Ken was the builder of Pilbara Minerals in Australia, which went from a $250 million market cap company to, at the peak, 15, 16 billion, was buried in Qantas Airways. Still today, 5-6 billion market cap, net cash position of $1 billion, second biggest mine in the world of lithium, incredible visionary for the industry. Ken brought along Alex Eastwood, which was our executive vice president commercial, which helped obviously build the Volkswagen agreement. Natasha Garut, Montreal local CFO, tons of experience with the different folks in the government of Quebec, Investissement Québec, Caisse de dépôt, when she was CFO of Champion Iron Ore. And we also have Frédéric Mercier-Langevin, who was joined us a few months ago. Frédéric is long-time industry vet, mining industry, 18 years at Agnico, more recently COO of West Dome, open pit, underground experience, mining in the north, signed some IB agreements. So Frédéric is the perfect candidate to take us here throughout the evolution of this company towards a producing asset. Frédéric is here with me today and tomorrow taking meetings with us. So we're happy to introduce Frédéric to you. Overall, I want to say that, just to wrap things up, I think when you combine the globally relevant deposit that we have, the incredible team leading the charge, and the potential blue sky coming up, which we'll discover on the economic side post the feasibility study that we'll do in Q3, which will focus on lithium. But if we keep an eye out on the cesium, the tantalum upside, those strategic and critical metals are going to be value add for us at some point. And you combine that with the demand angle of lithium raw materials via EVs or BESS, I think we believe the setup for Patriot going forward is extremely strong. Thank you for your time, and I wish you a great conference. Thank you very much.
Thank you, Olivier. Next up, please help me welcome Matthew Gordon of Crux Investor, who will introduce and moderate the Energy Transition Metals panel.
That was a bit busy.
Good morning, everyone. We're going to be talking about critical minerals and the importance, well, in the context of the energy transition. We're going to cover uranium guys at the end there who will want to talk their book, I'm sure. But first, we're going to start with you, Artie. Maybe kind of set this up, because it's a big topic.
Yeah. So thank you, Matthew. Being an engineer here, I like to have a framework and a structure. And obviously, critical minerals is a big thing these days. Everybody's talking about energy transition and critical minerals. But what is it that we really need to have an integrated, critical mineral, framework in Canada? A few things just to, set the tone for the stage is net zero. So mining is a crucial factor for achieving the net zero goals that we have. And while we're switching from fossil fuels to green energy and basically going to low carbon economy, there is a demand for mining of critical minerals. We're talking about copper, nickel, cobalt, lithium. And why do we need that? Because of everything that we use, from the smartphones that we carry, construction materials, you name it. We talked about that yesterday, today. Everyone is aware of the importance of the critical minerals. So in order to achieve that, we have to increase the amount of mining by 500% globally. What does that really mean? Like, if building a mine takes from the discovery to, going into operation up to 25 years from the discovery of the deposit, what can we do to be self-sufficient and have a supply chain for critical minerals? So I can think of a few things. And if we start from the top, is junior mining companies, not exploration. That's really the key in order to feed all the major mining companies with those assets. And speaking of junior miners, we have them on the panel. We were just talking about it, about how do you deal with that? What's your biggest challenge? Is the capital and your access to capital for the investment. So that begs the question that where this money is coming from. If you look at CCI, Canadian Climate Institute, they're estimating an upward of $30 billion capital investment to get to that point where we want to be in Canada. So that's really one of the key components of meeting that critical minerals demand in Canada. But what are the other factors? Another thing that I can think of is, do we have that critical mineral supply in Canada in order to meet the demand of the manufacturing? Can we have that, or we have to rely on import of critical minerals from other countries? We don't want to be there. We want to be self-sufficient. Mark was talking about processing all those critical metals to the point that we can use them in manufacturing. That will be another key component. We don't want to just dig that mineral resource or the mineral and import and export that to other countries for processing. We want to make sure that we have the entire life cycle of that process in Canada, going from exploration, exploitation, processing, and selling that in the market. Other benefits will be helping the local economy, helping the technology companies in terms of development of the technologies that we can do the processing. That's going to help the universities, research and development, and on top of that, the local communities that we're doing the mining. So these were the framework that I was thinking. I wanted to, open the floor. I mean, obviously.
Yeah, a lot of moving parts. Like I say, it's a big topic, and probably we won't do it justice in 30 minutes, I suspect. And I'm going to probably start at the far end, because these are the guys who've got to find the stuff which you engineers will help them get out of the ground efficiently. And then, for Chris, obviously, hopefully funding some of these things at some point as well. But maybe, Ed, I'm going to come to you. You've kind of got a broad spectrum of knowledge, and you can put some of this into context in the sense of how is Canada approaching this? It seems like we've been mining a long time, but it still seems like a relatively new idea, critical minerals lists, and how can Canada be self-sufficient? Well, so the question is, can it?
It's interesting, and in the makeup of this panel, we find it interesting because I'm focused on nuclear, which is a critical mineral, but completely different than I would say than the rest of the execution of the battery minerals and other critical minerals. Yet, in the energy transition, nuclear is a very important part of what we do, and as Canada, it's one of our strategic assets that we have, and I think we really need to focus more on. So I am really in the ideal spot between the two. I think Canada has been very good at highlighting what our challenges are and making big, beautiful, glossy statements about our problems, and we don't have a lot of solutions. And I don't think we need to be an expert at everything. I don't think we need to own 100% of the supply chain from the ground to the ground, so to say. And a lot of the policies that we put out there as a government have been misdirected in the sense that we tend to react to what the Americans are doing. We need to put out big battery plants because the Americans are going to get them all if we don't spend $10 billion ourselves to do that. And there hasn't been a lot of planning into how do we get the steps and how do we build a roadmap on going from A to B, as opposed to, oh geez, we need B, what can we do? And then reacting instead of actually planning. And I think I don't want to be the one to continually be a non-believer in what the government is doing, because we have great programs in place that are accomplishing some of the goals. Though I think we can plan it better from a road mapping standpoint.
Okay, well, let's talk about some of the problems that the juniors face, and there are many obstacles to face. I mean, maybe start with you. You're a prospect generator exploration guy, John. What are the obstacles that aren't put in front of you that perhaps you think could be, let's call it, refined or removed?
Yeah, great question, Matt. So as a junior exploration company, our company Standard Uranium, we are in Saskatchewan. We have 13 projects. Multiple projects are project generators, so we find other companies to spend their own money on our projects. And the biggest obstacle we face is capital. How do we get the capital to do the exploration work? And it's a constant battle. In 2023, the uranium market really heated up, and we saw a spot price go from $60 to $110, and money was flying in. And then we got to 2024, and it reversed, 110 down to 60. And now in 2025, it's been pretty flat, around $70 or $72 a pound right now, but we're seeing some great momentum in the market right now. When that market heats up, money starts to get coming back into the market, and we can start to get that capital and start to explore. So junior exploration companies like ATHA and Standard, we rely on capital to come in to get the exploration work done so that mines can be built on the basis of exploration. So it's always sourcing capital, and we need to, more help from the government or others to find ways to get more capital to juniors.
Right, but and Chris will sort of come on and talk about the top end of that one, but risk is always involved, and there's been some pretty badly run companies, some loss of value for retail shareholders, etc. So there's different appetite for capital allocation to juniors at the moment. I mean, you're coming out of slightly more advanced, slightly more de-risked situation, but for you, Troy, what do you think? Access to capital.
I think it's coming. Okay, it's more than we're talking about critical minerals here, energy transition, etc. But I think we've also started to shift almost past that too, and talking about energy security, right? Energy security, national security, these things are tied together. For the first time in probably 30 years in North America, we're actually seeing baseload energy demands increasing and projected to substantially increase. Our rate limiting factor to growth in Canada and in the US is our energy infrastructure. And you know, it's a timely conversation because right now we're at a position where people are starting, you know, nuclear is forefront to that discussion and that conversation, and going to be at the forefront of the build out, you know, of the hyperscaler systems, of the data centers, of the AI infrastructure in the US. And this is a long way, Matt, of getting around to the question of capital. You know, that's an exceptionally compelling investment opportunity. And for what was a pretty niche market, you know, the amount of capital that gets attracted into, you know, the junior exploration sector is a small segment of the capital pool. But as that opportunity continues to expand and grow with the fundamentals of the nuclear energy space, people are looking to how do we de-risk this? How do we de-risk the supply chain? What are the opportunities? What are the investment opportunities as the price of uranium continues to move up? Capital flows into the space and it flows into the sector. And we're starting to see that again now, which is absolutely required because it's a space that's been beat up over the last 15 years, 20 years. And as a function of that, we just don't have the assets, don't have the deposits in the pipeline to meet future demand. And that's true across the critical mineral space in general. And so I think we're starting to see a rotation of capital into the commodities.
Right, and Chris, better get you involved with this one. You're PSP, part of the Canadian Growth Fund. What's the remit, what's the brief in terms of the critical minerals contacts that we're talking about today?
Yeah, no, it's a great question. I think the discussion here is spot on in terms of the key points that Canada is facing in growing critical minerals. And you know, a couple of the panelists mentioned capital. Canada Growth Fund is a very powerful tool that is ramping up on the critical mineral side to be a source of capital to help to unlock and capitalize on Canada's abundance of natural resources. It's a fund where it's managed by PSP. It's a federal-backed fund with allocations to deploy capital into both clean tech, decarbonization, but what we're here today to talk about is the low-carbon supply chain and critical minerals investing. And a lot of what we've been working on ramping up and will continue to ramp up, and some people have seen some of the recent investments that we've made, are to find ways where capital can be impactful in accelerating the growth of critical minerals, accelerating projects to FID, to production, getting projects built in this environment where, as everyone's talked about, it's more important than ever to have these critical minerals extracted and flow through the supply chain.
Okay.
Sorry, I think there are two conversations we have to have. And as an investment conference, we're all here to try to make money. And you know, from a supply demand in the future, uranium, buy all the uranium stocks you can because the supply demand fundamentals are unbelievable. And I'm not here to advocate for uranium. Yeah. But in what you're doing, you're facilitating projects that can't get funded otherwise. And your mandate isn't to make the highest return possible on the equity or debt or however you put the funds in. It's more to facilitate projects that are not getting there, like the loans program office at the DOE, similar type mandate. So you're just hoping to get your money back and recycle it again, and not necessarily make a 10 times return, which is really necessary. But going back to my comments on the supply chain, they're not all economic. Like doing rare earth minerals, it's a really necessary thing for strategic importance, but you're not going to make money doing it, or it's hard to make money doing it because the economics are very challenging. And the final end market is maybe not there, and the feedstocks are maybe not there to go into it. So it's a really, it's a very complicated puzzle to put together and try to get capital formation to happen when you know all of these moving parts are out there, and you don't even know what in 10 years from now, what will the battery chemistry be? Do we need cobalt in the world anymore? Probably for some applications, but how do you build a mine that's going to be built, commissioned 15 years from now, and hope that you have a market for your product that may not be there? It's really a challenging conversation.
I'm interested in your point that you made earlier, Ed. Why should the Canadian government try to solve for all the problem, have an end-to-end solution for everything? Because someone's got to finance that, and that's going to be the taxpayers of Canada, surely.
Yes.
Yeah, this is a great conversation. We have people from different, spectrums in this panel. But, what we see in the industry is everybody is working in their own silos. Junior miners are working in their own silos. Investors are, trying to invest their money and deploy the money somewhere that they can get the return. And we come into the picture as the engineers who can work out the asset in a way that you look at the financials as investor. For example, Chris, if you want to invest in a mine, what do? You look at the IRR, NPV, and then you want to get the return for your money in the fastest time frame. You look at the payback period, and then you make a decision whether you want to invest in that asset or not. So there has to be a collaboration across, engineer service providers, miners, financiers, everybody working together to get that asset from the ground to production in the fastest time frame possible. That's how we see it, and we have to have that platform to collaborate together to get to that point.
Yeah. So I'd like to build on a point that Ed raised with respect to where the risk lies in financing projects and where the risk lies in building mines in uncertain times, in uncertain commodity environments. And it's a really good question. And part of the mandate of the Canada Growth Fund, and one of the things that we get really excited about, is the ability to take risks beyond where the public markets may take risk. Like, a lot of the mandate is to catalyze private investment by, in some cases, expanding the pool, in some cases, creating consortiums, and in other cases, creating structuring solutions that may expand the ability of that project to get financed or take risk a step beyond where the market sees it in order to catalyze growth, catalyze that private investment. And so it's a really good point you raised about the space and about and it really becomes a question of risk. And while you're right, there's financial soundness in every investment that we make, and we need to evaluate those merits. Part of our mandate is the impact that we're making. And can that impact accelerate projects? Can that impact achieve other goals for the benefit of Canada, for the benefit of bringing jobs in Canada, for the benefit of accelerating growth and energy transition in Canada, while still meeting a financial soundness test? And so it's a really good point you raise, and in some ways is what gets us so excited about the mandate at PSP to implement the Canada Growth Fund is, the mandate really does allow us to tackle a bit of that. It's going to take us and others working together with the private sector, with partners, with investors alongside us as we advance there. But it's a challenge that we hope to help solve in the Canadian mining industry.
I think it represents a tremendous opportunity for Canada. We have a large endowment of critical minerals, uranium, across the spectrum. Okay, and we have a skilled technical workforce. We have skilled explorers. Canadians across the space are miners and explorers, and we do a very good job and have done a very good job historically. The conversation now is getting to the point where it's there's starting to become a broader realization and understanding that it is, critical minerals. 10 years ago, we just called those base metals, right? Like, it is the stuff that underpins our economy and supports our economy. And we're good at it, and we have a high endowment. And what we're seeing within supply-demand curves across the spectrum is that incentive pricing is coming within the commodity space that is going to incent capital back into the sector, that is going to lead to exploration, going to lead to discovery and development of assets. So on a look-forward basis, tremendous opportunity for Canada, tremendous opportunity for junior explorers, right up the value chain, engineering firms, financiers, etc. I'm very optimistic, Matt.
But if I may say, because this is a question of whether you believe in, isolationism, as in, we will, protectionism, we will look after ourselves, we'll stand alone, or you say there's an inevitable globalism required to be able to, deliver this kind of critical minerals list, or pseudo-globalism needed. We are going to need international partners, because I don't think Canada can solve for its own problems, and certainly not finance it.
Mm-hmm.
Matt, let
So,
me jump in there
John,
for a
yeah,
sec.
please.
I mean, we are very blessed, as Troy mentioned, to have incredible endowments in Canada. Saskatchewan has got the best uranium, probably, endowments in the world, the highest grade by far. And just to our south, we have the U.S., who have got, massive, the world's largest nuclear fleet right now. And their new minister, Chris Wright, just said they want to triple or quadruple that in the next 20 to 30 years. But they don't have the endowments we have in Canada. So they're producing about 1 million pounds right now a year. They want to get that up over the next number of years. Maybe they get to 25 million pounds. Maybe they get to 50 million pounds. But they want to get, something 5 times, 10 times that. And Canada has got the opportunity to move quick, to make the discoveries on our projects in Canada. And the U.S., Mr. Trump is, he's a lot of things, but he will need to get those minerals from Canada to build out the U.S. nuclear fleet. So we've got a great opportunity to fund that, get those discoveries happening, get those mines built, and have a great partner in the U.S.
But isn't that about trying to capture more of the value in country? That's what Canada needs to do, and then sell into receptive, friendly markets like the U.S. So how do we do that? I mean, Ed, what do you think?
That's part of this puzzle or the roadmap that I see missing. It's in the midstream. We're actually really good at mining, not so great at permitting mining, but we have lots of endowments. And don't get me wrong, I'm the most optimistic person in the world. Like, I love where I am, and I'm focused on energy transition because there's such an opportunity, and I see it as such a complex challenge to look at all of the aspects of how to get a project built. And I focus on nuclear in particular because it is, the financing matters, the regulatory matters, but then there's, the community engagement side of things, there's the policy side of things, and in their case particularly, the enrichment side of things generally is a challenge as well. So there's a lot of midstream processing stuff that we have to address, and we tend to not talk about the fact that, well, we were happy in the last 50 years to let China take all of the midstream processing and do it themselves because we didn't want to use the power, we didn't want to pollute our nation, and we were happy to let them do it. And all of a sudden now, with changing governments south of us, it's become an issue that we don't, they're the new enemy of the world, so to say. Anyway, enemy of the U.S., they're not our enemy, and I think we should, if we wanted to deploy solar, it's great. I would rather buy panels from and modules from China at the cheapest price and put them on roofs rather than try to shore an industry in our own right, because there's no point. So that's what I was saying. We need to choose where are we good, what are we good at doing, what are we endowed with, and how do we take the 31 strategic minerals that the government pointed out and say, well, we don't need to be able to do all of them, but we should be doing some really well, and how do we own that whole supply chain from beginning to end? And I don't think it has to be across the board.
And Chris, I mean, your fund, you've kind of got a remit. You know what you're meant to be getting after. Do you see that sort of evolving and changing over time? Is it, we've got to buy Canadian, we've got to support Canadian? Is that what it's going to be going forward for you?
The focus of the Canada Growth Fund is very much investing in Canada.
It's not making money, it's about supporting Canada.
It's about supporting Canada while making having financial soundness in investments.
Right.
The goal ultimately is to recycle capital and have the capital accelerate growth in Canada through that. So there has to be a financial soundness. We are independently arm's length of the federal government and make our own investment decisions accordingly. But a very key part of our measurement are impacts on Canada. And how can we stimulate growth? And I go back to a comment I made at the beginning of how can we really capitalize on the abundance of natural resources that Canada has and do it in a financial way to accelerate growth, attract in other investment alongside our investment, work within financial structures that can help to unlock projects where there may be capital providers ready to provide part of the capex to build that project in a structure they're comfortable with. And there's just one part of that capital stack that just a company's been trying to solve. Ideally, those are situations where we're trying to work and find ways we can solve that.
Right. Who do you partner with on these sorts of things to make sure that these guys get the money that they need to build these things out so this guy can do his engineering?
In terms of partners, in terms of, when I say partners, I mean like investors that we may invest alongside. It's the private sector. Okay. It's, we certainly want to invest alongside high quality partners, but the key really is just stimulating additional investment.
Right. And are you the lead? Are you the cornerstone usually in those sorts of relationships, or would you follow behind?
in most situations where we find ourselves, we're additive investors.
Right.
We can help to work with companies and help to really accelerate that. And in some ways, even having a secondary investor can help you almost as a leader. If you know there's an investor that's there, if you just kind of have that cornerstone, you can be an accelerator.
Yeah.
We view ourselves as a really unique tool to the Canadian ecosystem of helping to accelerate investment, accelerate capital, because everyone on the stage has seen projects of that discussion where you talk to a independent financier, talk to a private sector investor, and like, well, you know, if you've got every other dollar there, I'll be the last dollar in. And you know, in some ways, we're going to be part of that solution too. That's part of that group. But ideally, we can help companies get a bit closer to that last dollar in, so that in the raises that we do, in the ways that we can fund, you can look at, okay, people have the confidence that there's now a partner there that's a pretty deep funding partner,
right,
that can help to provide that project support.
So it's a kind of financial and it's a kind of political animal, really.
Yeah, we look at projects from a perspective of impact. We look at projects from a perspective of like readiness to advance, from financial soundness and a number of other factors.
Right, okay.
Once your dollars are allocated though, does the governance prevent you from actually having influence over the business at that point? Or here's the money, do what you should with it, but then do you actually have any actual influence and ability to affect management?
Yeah, we're an arm's length private investor. It's public, the type of rights agreements that we have with investments that we've done, and we look to partner with businesses, and we look to work with those businesses, continue to support those businesses, and this is across the spectrum of the Canada Growth Fund, not just in our low carbon supply chain vertical, but also the work we do on decarbonization projects and the work we do on Canadian clean technology investing.
Artie, can I come to you? Having listened to this conversation, are you filled with hope about the ability to grow your company? It seems like a lot of barriers for some of the employers, some of the clients that you may have further down the line. Is this all going to come together for you?
That's a great question. So, I think there's a need for streamlining all these processes because, we talked about permitting. If it takes a long time to permit a mine, what can we do to streamline that process, that we permit a mine in a time frame that is, beneficial for Chris as an investor and for the miners to get their project off the ground, and for other players like us who's going to be involved in developing and building those assets. So we don't want to fast track or expedite, because at the same time, we want to make sure that we have highest standards for permitting. We make sure that we work with the local communities and indigenous group to ensure that they are protected as part of this process, but at the same time we can fast track building a mine. You know what I mean? We want to make sure that that process is there, and we definitely need support from the government to be a part of this. We want to make sure that they are on board and they support miners, investors, companies like us to all work together to get to that goal.
And are you seeing actions, not words, out there? Politicians are great at talking.
You see, I heard some positive comments, and this is what we see. There is the will, and it's something in the works. So it's not as fast as we would like to see, but there is a push to get things off the ground much faster and quicker.
Ed, are you hopeful?
I'm hopeful, and then I'm going back to what you said originally. Atkins is in a really fantastic spot as far as this all goes from an investor standpoint, and your stock has done well. They happen to be the one of the top nuclear developers as well with the CANDU program, and they've done really well. And their nuclear services, they're building the BWX, and they're part of the integrated plan there. So you win in any scenario because you're so vast and you have such a good influence over what's going on. You're going to participate in whatever it is, if it's mining and in supply chain and in any aspect of it. So that's great, and I'm optimistic because I hope that we will find the signal through the noise. There's been a lot of noise every day. We wake up and say, "Oh my God, what's happening today?" This morning the tariffs went up on steel and aluminum to 50%, and how does that affect the demand for, it's hard to figure it out, and whether it will stay for a week, it's hard to figure out, but I'm optimistic in the sense that, it's only 4 years, and we'll get through it, and there will be sanity through the, signal through the noise at some point.
And I'm going to go back to the beginning of the food chain. That's you, John.
Yeah.
How are you feeling about all this?
Well, I am hearing some great things today in this panel. Number one, as you mentioned, engineering firms could be a great strategic partner for junior exploration companies. If they're looking for work down the road, come in, be a strategic partner, put some financing into junior exploration, and the Canada Fund as well. I'm not sure how far down the food chain you're going, but there's great opportunities to look at those projects that could use some government funding as well to move that along. I'm excited. We've got great projects. The global demand for nuclear and uranium is massive, and it only continues to grow, and capital is flowing back into the uranium space. We've got a great team, as does Troy at ATHA, and we know capital is going to find us, and we're going to have a bright future.
Great. Gentlemen, appreciate the time. I said not enough time to cover all the topics, but some super commentary here. Appreciate your time. Thank you.
Thanks, Matt.
Okay.
Thanks, Matt.
Thanks, Matt.
All right. So next up, we have a fireside chat with Rob Weir, Vice President of Corporate Development at Lithium Royalty Corp. Please help me welcome Rob to the stage. So Rob, thank you for joining us today.
Thanks for having us.
And so we know Lithium Royalty Corp as a pure play lithium focused royalty company. You guys have a diversified portfolio of 35 assets, current market cap of around 300 million Canadian, and total net asset value of around 600 million Canadian. Is there anything else you want to flag for the audience today as part of the company overview?
Yeah, sure. I mean, you highlighted the chief issue is the multiple we think is extremely low. We've bought back $4 million worth of stock in the last 30 days, part of it through an SIB, the other part on our SIB. So we put a $7 million SIB in the market. We got 45% uptake. So the 30 months has taken its toll on any of the lithium-based companies, and we're not immune to that. So I think we've been putting our money where our mouth is while things look a little bit bleak.
Yeah, and of course, we'll talk about the lithium market in a bit. I understand you guys, in terms of your portfolio, there's quite a few exciting catalysts this year. You guys have a royalty on Tres Quebradas, which Zijin operates, as well as a royalty on Mariana, which Ganfeng operates, and both of those assets are producing this year. Can you tell us a little bit more about that?
Yeah, we were just there. One of my colleagues was on an SMM trip, and the latest intel we have is they'll be producing June and July. So there's usually a quarter lag before we start collecting royalty payments, but I'd say very high probability they produce this year. We thought Zijin would have been producing back in 2023. They've held off until now, but those are combined $6 million US a year, even at today's prices for us. So those are important projects, and they've spent about $1.4 billion in total capital to build them. So.
Yeah, and so it'll be exciting when the cash flow starts coming in on those assets. And in addition to those, you guys also have a royalty on Sigma Lithium's mine in Brazil. That's been producing for a couple of years now. How's that partnership been, and how's the expansion going?
They've been great. We bought that back in 2018 for $7 million US. I think the market cap was about 108 million, and they had 13 million tons of reserves. So the reserve base is up meaningfully. The stock had a market cap, $4.5, $5 billion, and then they've succumbed to the weakness in prices. But even at today's prices, if you look out over the next 3 years, they'll generate about 420 million of revenue and about 65 million of EBITDA. So they have phase 2 fully funded. They'll do 300,000 tons this year, growing to 520 next year. So the market, they're out of favor with the market. But we think they're great operators, and we're happy to have them as our leading royalty company in Brazil.
Yeah, and that's very impressive revenue generation even in this lithium market, right?
For sure.
So pivoting to some of your other key assets, Core Lithium recently completed a comprehensive restart at Finesse in Australia, and you guys own a 2.5% gross overriding royalty on that. So that sounds exciting. And of course, you guys also own royalties on Mount Cattlin in Australia and Galaxy in Quebec, both of which are now owned by Rio Tinto, who's been investing pretty aggressively into the lithium space over the last couple years. Can you expand on that a little bit more?
Yeah, Finniss is in the Northern Territories near the Port of Darwin. They were trying to ramp up into the lithium price decline, so they had to go into care and maintenance. And as you said, it's a material royalty for us at a 2.5% GOR. So they've done a restart study. They've bought out their old offtake partner. There's about $250 million sunk into that project. So they've done a really good job at taking mining processing costs down. I'm not sure they could press go on it today, given where spodumene prices are. But Ernie, our CEO, was just in China, and he thinks there's ample demand for offtake. So they may surprise people with an above-market transaction there, and so that sunk capital is a big advantage. And like you said, that 2.5% GOR even today is $3 million US to us. So we're patient, and we think they have a really good operating team in place there. Mount Cattlin, Rio, as you said, is a new owner. That's the 4th owner since we've had that project. It's a tonnage-based royalty. Arcadium had earmarked it to go into care and maintenance at the end of Q2. I think Rio probably follows through on that, but then there's an opportunity to go underground in a different price environment. So we'll be just really patient over time. Like I said, this is the 4th operator, so it's been a good royalty for us, notwithstanding the current challenges it has.
Right. And what's the status with Galaxy?
Yeah, Galaxy, Rio has been fairly quiet. The 2 geographies they talked about accelerating or being most optimistic on were both Argentina and Quebec. They've definitely followed through on their capital allocation in Argentina. Quebec remains to be seen. I suspect it needs a higher price environment north of 1,000, maybe north of 1,200 before that happens, but it's a huge asset. And again, we can afford to be patient when we have those 2 brines and other projects around the world coming into production. So we'll have to wait and see.
Right. And is there any indications on where Rio is going with their lithium strategy, just with recent shakeup or shakeup to come?
Yeah, they just announced a new CEO, and they'd been sort of the only buyer, so to speak, paying a big premium for Arcadium. They just announced a deal on Maricunga. So I think brines are their first stop, and then hard rock comes later once we get into a stronger price environment. But Quebec and Argentina are the 2 focuses for them, no doubt.
Right. And of course, for you guys, having such a strong operator as the counterparty is a huge plus.
Yeah, they're very constructive. They think lithium grows at a 10% CAGR. I think they're sort of in that consensus view of being oversupplied between now and the end of the decade, but any oversupply is very minimal at this stage given the different pockets of demand. So I think that's a pretty conservative and credible view.
Right. So diving into the lithium market a little bit, as you mentioned, Rio has been investing pretty aggressively into the lithium space in the last couple of years, where lithium prices have been on decline. Do you think lithium prices have bottomed out?
It's a great question, and I'd be lying to you if I had the answer. I think these bear markets sort of only end with the benefit of hindsight. But at $600 a ton, something in the system is going to break, and it's going to eliminate the surplus that we have. And you have so many different demand drivers, even outside of EV and battery storage. People thought AI was a foreign concept 10 years ago, and now it's a huge demand driver for a lot of different companies. And EV tolls and these humanoid robots are coming pretty quickly, and so maybe it's a demand shock that resuscitates things. But either way, at $600 a ton, not a lot works, so something has to give.
Right. So then, taking things into longer term, what's your view on supply-demand dynamics over the long term?
I think short term it's challenged. You have a lot of low-cost tons that still filter into the system through the end of 2026. I think medium term we're going to get back over 1,000, and I think long term, given the demand profile, we're going to need 65 to 80 mines, and you're going to need $1,000 to $1,200 for that to happen. So short-term pain, medium and long-term very positive.
Okay, and so driving the positive trend in the longer term, do you think that price recovery is going to be supply or demand driven?
I always say supply driven because it's just almost everything is cash flow negative right now. So at some point, something's going to have to cycle off. And we saw it in China earlier this year with one of their lepidolite mines coming off. That was 20% of their domestic production. So something's gonna break and something's gonna get shut off. And when you have demand, growing as quickly as it is, it doesn't take much to have that surplus swing into a deficit, and then we're in a whole new price environment. But like I said, you don't know until after the fact, so you just have to be patient.
And in terms of China's influence, how do you see that playing out in the longer term? You mentioned one of the lepidolite mines coming off. Any other thoughts there?
They've been very patient. They've grown their lepidolite production 20-fold since 2020. They've financed a lot of the African-based assets. Those African projects have taken a lot of market share from Western Australia, so they seem pretty resolute to continue producing on a fully integrated basis. They do control all the processing capacity, so companies like Frontier, with Mitsubishi as an investor, companies like Patriot that were just up, they're pretty determined to have a North American-based supply chain and conversion capacity right here in Quebec. So to the extent those guys can be successful, I think it would be a real positive.
Okay. And then moving into, I guess, just the general M&A market in lithium, there's been quite a bit of consolidation within the sector as well, probably also driven by lithium prices and where they are right now. Do you think that trend's going to continue?
I think M&A is, you need some level of stability for companies to be comfortable, and as the price continues to hit new lows, I think people just feel that they have time and they can be patient. So, our Arcadium going at a 90% premium, Pilbara made a big acquisition in Brazil for $500 million. So I think some of the smartest companies in the space have made pretty big acquisitions, and I think they're just kind of keeping a low profile until we get into a different price environment. But I would expect you'd see more given the dislocations we're going to see.
Right, okay. And we've got a couple minutes left here. What would you say are the key reasons why someone in the audience should buy Lithium Royalty stock today?
We've got a great balance sheet. We have $31 million US in cash. It's about 15% of our market cap, so we're not going anywhere. We have no debt. We do have an undrawn facility with you guys. But our underwriting standards haven't changed. We've applied the same formula to every royalty we bought. So the general idea was high grade, hard rock, safe jurisdiction, low technical complexity. The two brines would be the exception to that rule. So we've got a huge business development pipeline. It's just a question of which assets do we pick and choose, how close are they to first production. So the lithium price is going to do what it's going to do. We're just going to stick to our knitting, and we're going to underwrite what we think are the best projects in the world. So you're buying it at a huge discount to NAV, and like I said at the outset, we just bought back $4 million Canadian of stock in the last 30 days. So we're pretty optimistic long term.
Excellent. Well, I think that wraps it up for us, and thank you very much for joining us today, Rob.
Thanks for having us.
Thanks. All right. Okay, so next up, we'll have a presentation from Q2 Metals. Please help me welcome Alicia Milne, Director, President, and CEO of Q2 Metals. Q2 Metals is a Canadian exploration company focused on advancing lithium and critical minerals in Quebec's James Bay region. Hi, Alicia.
Thank you.
Great to see you.
Hi, everyone. As she mentioned, my name is Alicia Milne. I'm the President, CEO, and a Director of Q2 Metals. And I am here today to introduce to you our Cisco project, which is located in James Bay. This is a quick picture that we like to put in here. This is the main outcrop area that was discovered in about 2021, 2022. The vendors of the project essentially landed their helicopter on this large outcrop, got out to have a coffee and looked around and saw what they were standing on, and did some mapping and sampling and did a small drill program and came up with some pretty good results, which drew our attention to the project. Just a quick bio on myself and Neil McCallum, who's sitting in the back there, our VP Exploration. I have a legal background. I've sort of run the gamut of working from all sorts of different companies, from private through to TSX Venture Exchange companies, all the way to New York Stock Exchange listed companies doing legal work for them. Neil McCallum has quite an experienced history in the James Bay region. He was involved with originally staking part of the Shakatchewinen project back when it was a smaller company by the name of 92 Resources, I believe. He's been in the James Bay region for probably 10 years or so, looking at various lithium projects. Quick update on our share structure. This is as at May 1st, so it's slightly out of date, but current cash on hand, we have about $7.5 million cash. Current market cap is about $70 million, I believe, at this point, maybe 75. Not really sure what our share price is today. But we do have analyst coverage through Canaccord and through Argonaut in Australia, and for 2024, we are on the TSX Top 50. And over to our Cisco project. So that main outcrop picture that was at the beginning of our presentation here, you can see that up at the very top corner there. That's essentially the main outcropping area that you can see, because the rest of the area is pretty heavily forested. It's in an area where there's a lot of forestry cut blocks. And that last drill hole of the season last year is sort of at the bottom of that picture. That length between the CO1 outcrop and that last drill hole is about 850 meters. And in our winter program, which I'll get into, we actually extended that further south another 650 odd meters. Here's where we are in the James Bay region. You can see your Patriot Shakatchewinen project up to the north of us, Winsome's Adina, Rio's Galaxy project, and there we are down in the lower portion of the James Bay region, essentially 150 kilometers north of the town of Matagami, which is also your Canadian National Railway, the railhead there. I believe it was about 2 weeks ago the Quebec government and Rio Tinto announced that they had provided some funding to the town to upgrade the transshipment center there. So I think that'll be a big boom for the area itself, building out the railway hub in the area. Here's a quick overview of what our claim map looks like. The original project that we bought in February 2024 is sort of that small inset that you can see. And then in November, December, we actually extended the mineral claims that we have to cover off a lot of the road area and a lot more of the greenstone belt, just because at that point we were seeing what we were getting results-wise. So we decided that we should have more of the actual area itself. To date, at Cisco, we've drilled a total of 14,622 meters over 37 holes. So still a relatively early project, but with the results we're getting, we're seeing very wide intervals of mineralization, and it's proving up to be quite a world-class project. And this here's our drilling that we've done. So as I mentioned, the vendors did a small drill program. They drilled 6 holes at the top along that CO1 outcrop. When we got out there, essentially, I think it was a year ago this week is when we actually stepped foot on the project and started doing some work. We started drilling, sort of following the same trend that they were drilling, and started coming around down to the south. And that's when we stumbled upon hole number 10 there, which had a wide interval of 120 meters that assayed at 1.72% lithium oxide. And as we continued following the mineralization that we were seeing, we then hit hole 18, which was a very large intercept of 215 meters that graded at 1.69%. And hole 21, which set the bar really high for ourselves, was a 347 meter continuous interval that ended up grading at 1.35%. As I mentioned before, we ended the project on hole 23. That was a 188 meter interval. And for our winter program that we did between February and April this year, we were doing large stepping out 200 to 400 meters. And with hole 27 to the south of us, that was pretty much our best hole of the program. That hit a 179 meter interval that graded at 1.66%. And then followed closely thereafter, there was another 58 meters. And then just after that, there was another 91 meters. So that one drill hole itself is very, very well mineralized, and just extended the actual mineralized zone that we're seeing at Cisco to essentially 1.5 kilometers right now by about 650 meters wide. This here's a cross-section that you can see sort of covering a main area of drilling. You can see hole 18 there that had that 250-meter intercept. And the system itself is hanging very well together with these large mineralized intercepts, consistent grade, trending to the south. This is a picture. We decided to set the bar really high for ourselves with this, and this is a geologist with all of the core boxes. That was that hole 21 with a 347-meter interval. This here's a long section which just essentially shows every single drill hole that we've drilled, showing the area and how far we've actually come within this past year to 1.5 kilometers. Still open in all directions. And Neil's job this summer is to get back out there and start infilling in some of those between the green dots there. Those are the outcropping areas. Start filling in some of the spacing there and tighten it up a little bit. When we did hit that 347-meter hole, we had quite a few comments saying that we were drilling down dip to it, and there's no possible way we could have hit something that significant. So we have been doing surface and downhole measurements as we go, essentially putting a camera down the hole and taking some measurements there. And it just is going to prove up that we are drilling true width, or as close to true width as we possibly can at this point. And we'll continue to do that as we progress. Metallurgy, we've done initial mineralogical work, which has just gone to show that spodumene is a primary lithium-bearing mineral in the pegmatite. Right now, we do have samples in with the lab to do the first sort of set of work, metallurgy work, and that's essentially to show that we could potentially use DMS in order to separate it. This is a good sort of visual picture that I like to refer to for the non-geologists. Red is good. Red is the actual continuous spodumene intervals. And you can see like hole 18 there with the 250-meter interval. Not only did that have that one 250-meter interval, it also had a couple other intervals in there. So in all manners of speaking, 72% of that hole was very well mineralized, which tends to get lost in the fact when you have such a significant interval. There's also additional ones in there. And that hole 27 that I mentioned there, that was a hole that we just released 2 weeks ago. 56% of that hole is mineralized, but that hole actually ended in mineralization as well. So, you know, again, we're seeing these very long, wide mineralized intercepts. Upcoming catalysts. I mean, we're currently out there doing mapping and sampling. We have about a 41,000 hectare land package. So last year we were only able to essentially work on about a 5 kilometer by 5 kilometer section. So right now we have crews out there driving in, using some of the forestry roads, hiking in, and essentially mapping a lot more of that greenstone belt, which is about a 30-kilometer long greenstone belt there. And then we'll start drilling. So the drill was actually left collared in a hole number 36 at the end of last season. We were sort of in a race against time to finish off the last hole, and we didn't get it done before goose break. So that'll be the first hole that we start up, and that was up towards hole 18. And then for the rest of the summer, we'll just get out there and continue drilling, continue stepping out, testing other areas, and at the same time doing some infill drilling here and there just to make sure that the wide mineralized intervals are, in fact, continuing. And why lithium, why Quebec? I mean, Rob had a very good presentation there earlier about lithium and the demand for it. I think there'll be a continued demand, and you know, it's just a matter of the supply-demand metrics working themselves out. Quebec is also a great jurisdiction to be working in. I don't think I've worked in a better jurisdiction in Canada. They're very supportive, and it's a great place to be. That's my presentation. If you have any questions, feel free to come by and see us. Thanks.
Thank you, Alicia. Next up, please help me welcome Sean Cleary, CEO and Director of Strategic Resources. Strategic Resources is advancing the Blackrock vanadium and titanium project in Quebec with a vision to support the clean energy transition through the critical mineral supply. Please welcome Sean.
Good morning, and thank you for attending the presentation of Strategic Resources. We are a public company listed on the Toronto Venture Exchange and focused on developing Canadian green steel supplier. So we have a significant project here in Quebec as well as in Finland. Today I'm going to focus on our project in Quebec, which is our flagship project known as the Blackrock Project. So within the Blackrock Project, we have a permitted iron ore pelletizing facility that we are currently finalizing engineering on, going to FID later this year, early next year. This is located at Port Saguenay in Quebec to produce 4 million tons of high purity DR grade iron ore pellets. We have, for phase 2 of the project, already permitted the DR furnace that will be installed at Port Saguenay Industrial Park in Quebec to produce about 750,000 tons of high purity HBI DRI for electric steelmaking. And finally, in phase 3, we have the fully permitted open pit mine and concentrator at Chibougamau in Quebec, where we will produce a concentrate that will get transformed at Port Saguenay to produce pig iron, vanadium slag, and titanium slag. So this is a picture of the wharf at Port Saguenay. Currently, we have an industrial park that has been built out at the port. This is a Ports Canada port, so it's a federal public port, and we have the long-term lease on the core portion of the industrial park at the port, where that will be the site where we will install the 4 million ton iron ore pellet plant. And the reason why we're really focused in this area on high purity iron and is because electric steel making requires high purity iron. It requires this iron to be pelletized, so therefore that's phase 1 of our project. And then those pellets need to be transformed into directly reduced iron or hot briquetted iron, which form a portion of the ingredients for electric steel making. And then finally, in phase 3 of our project, we'll produce high purity pig iron, which is also a key ingredient for electric steel making. And at each stage of the development of our project, at each phase, as we introduce each of these products, the pellets, the DRI, the HBI, and the pig iron, it has increasingly higher margins. So the idea is to take a very plentiful supply of iron concentrate that's produced in Quebec and upgrade this and transform this into ever higher margins. This is great for the region, and we're seriously under capacity in terms of pelletizing capacity in Quebec. So this is a map of the iron ore producing region in Quebec, typically known as the Labrador Trough. We have in this area about 75 million tons of iron ore production per year, and we have currently about 25 million tons of pelletizing capacity. And as the steel industry moves towards electric steel making transition, more and more of this iron ore concentrate needs to be transformed into high purity pellets. Right now in Quebec, we have a couple of projects that are going on to produce even higher iron ore concentrates, and these are the concentrates moving from about 65% iron ore contained in the concentrate up to around 69% iron ore contained in the concentrate. These are the concentrates that will be ideally suited for transformation for the green steel transformation. So at Port Saguenay, this is a very strategically located port. We have a deep sea port with access to both the Great Lakes region as well as the Atlantic seaborne trade. And at Port Saguenay, we also have, interestingly, access to low-cost electrical power within the industrial park that's just been completed, as well as natural gas. And you really need natural gas for the conversion of both clean green iron ore pellets as well as DRI and HBI. You can't do it without natural gas. So, and within Port Saguenay, we have a very well-developed industrial area. Of course, this area is being hit hard because of the Trump administration tariffs on aluminum today. Rio Tinto is the largest employer in the region. So one of the things that needs to happen within the Saguenay-Lac-Saint-Jean area is a diversification of its mineral portfolio, and moving to iron ore, which is Quebec's #1 export, is a very easy and value-added way to help diversify the industrial base within the Saguenay region. So this is the same sort of photo at the top that I showed earlier in the presentation, which is the wharf at Port Saguenay. And then the picture below is the industrial park that has now been built out, sort of at the top of the hill. So it's located about 1.5 kilometers from the actual wharf. And currently this is being connected by conveyor systems. So the port, in partnership with the government of Quebec, are installing a two-way conveyor system to enable concentrate to move from the wharf up to where the plant is to be located, and then the pellets back down to the wharf for shipment, either into the Great Lakes or out into the seaborne market. And this is the location of the wharf and where the conveyor system is going to commence. And this is an overhead shot of our wharf going, and then the conveyor system going up to the stockpiles, which will be located at the top of the picture, and then a small conveyor system over to the pellet plant, which is located at the bottom of the picture there. And this is standard technology. There's nothing new about pelletizing iron ore. This is being done for over 100 years. However, the major strategic advantage of Port Saguenay is the access to natural gas, which we don't have in Port Cartier or Sept-Îles and the Labrador Trough. And others have looked at how to increase the capacity of pelletization in the region, and have recognized that you really need access to a natural gas pipeline. This really can't be done with LNG. It can't be done with other types of fossil fuels in a way that can get permitted, that is clean and green. And so that's why Port Saguenay is the obvious location for this type of industrial project. Okay, so late last year we signed a pellet feed supply agreement and pellet offtake agreement with Javelin Global Commodities out of London. They're one of the main players in the trade for these types of products. And along with that, so this was a 10-year deal that will commence once the plant is up and operational, which is expected to be in 2028. And it comes with a $150 million working capital line of credit. And one of the questions we get from investors and interested parties that are new to this area of understanding the green supply chain for steel production is how much DRI is going to be available for for this market, and what is the expectation in terms of the growth of the market. Because electric steel furnaces are really scrap melters. So the main ingredient going into furnaces that are run on electricity, electric arc furnaces, is scrap iron and it's scrap steel. The problem with those ingredients is that they contain contaminants that you cannot easily remove physically. So they have to be diluted with what we call virgin iron units. So that's why we're so focused on the production of high purity virgin iron units like DRI, HBI, and pig iron. And this is a chart of forecast chart by one of the leading consultancies to the steel industry globally. And they're basically showing that in 2023, the world globally, we produced 136 million tons of DRI. And what is the expectation for that, which is significant growth as we have more and more transformation to electric arc furnaces, basically doubling and tripling over the next number of years. This is the market where we want to play, and it's a significant market. So, what is our production at Port Saguenay going to mean? Well, in phase one, we're producing 4 million tons, so less than really, 2, 3, 4% of current DRI pellet feed that, on a global basis. So it's a meaningful amount in terms of dollars and cents, but it's not going to change the market. And we're really focused on the high purity end of this. And so when we look at what is the pellet premium compared to the concentrate price for DR grade pellets, we see that, on the long-term mean, it's about just over $50 per ton. And that's the margin, after taking into our account our operating costs, which are expected based on the feasibility study work that's been done to date, to be about just over $16 a ton. So we have a very nice margin business here that we can operate as phase one of the BlackRock project. And these are some of the numbers that came out of the study that was completed to date. We are working towards finalizing these numbers. In the next couple of quarters, we will complete a full feasibility study on the 4 million ton plant, and we'll be publishing that feasibility study. And in line with, we're very close to filing our environmental application for some, we've asked for some changes to our existing certificate of authorization. So we're going through a process with the government around this, which is going to take approximately 6 to 9 months in total. So overall, we should get to a final investment decision sometime early next year. And this is our project schedule. The way we have it right now, we would, basically, we've completed the feed agreements. We have some collaboration agreements. One we've signed with Takora that operates the Scully mine up in Labrador City, and we're working on a couple of other collaboration agreements. We'll complete the feasibility study in the first half of next year. We are already working on the debt and equity raise for phase one of the project. So CapEx for phase one is just under $500 million. We've hired Societe Generale on the debt side. That's moving along nicely, and we're in discussions with some of the big pools of capital to round out the total capital that will be required for the $500 million raise, which will happen next year. And then construction and ramp up, it looks like it's going to be about 24 months, so we expect that we would be fully ramped up by the end of 2028. And, we're well sponsored. We have a significant ownership by the Quebec government, represented by Investissement Québec, as well as Orion Mine Finance out of New York. Ross Beatty and the Lumina Group are significant shareholders, as are the Cree Nation government, where we have a full project IBA in place with the Cree, and we also have development agreements in place with 3 different bands of Innu. So just in summary, phase one, as I mentioned, 4 million ton a year iron ore pellet plant located at Port Saguenay, very, significant. We can produce a clean, green, lower CO2 emission type of iron ore pellet for the green steel industry, which is growing. In phase two, we'll forward integrate, install the DR furnace. In this part of the project, we'll produce about 750,000 tons of high purity directly reduced iron. And then in phase three, we would backwards integrate, open the mine, produce a portion of our own concentrate, and that would add pig iron, vanadium, slag, and titanium slag to our product mix. So that's the overall project, and that's what we're working towards. Thank you, everybody.
Thank you, Sean. Next up, please help me welcome Jason Jessup, CEO of Magna Mining. Magna Mining is a Canadian nickel, copper, and PGM developer focused on the Sudbury region with a mission to deliver high-grade, clean metals for the electrification economy. Please welcome Jason.
Thank you very much for that introduction. I founded the company, Magna, back in 2016, and I'm based in Sudbury. I've been living there for about 25 years, and previously I'd worked for Inco, which is one of the big mining companies there, and then went to work for a junior company called FNX Mining, who had acquired 5 past-producing Inco mines, and we were able to bring 3 of them back into production, made some very significant discoveries, and ultimately were acquired for about $1.5 billion in 2010. And shortly after that, about 2 years later, that company was acquired by KGHM. And this was really what inspired me to found Magna. I had recognized that these non-core assets to the majors in Sudbury we could unlock a lot of value by being an entrepreneurial junior company. And these mines that were so great within FNX were now, again, non-core within a major mining company. So we have went public in 2021 and made our first acquisition post going public of our Crane Hill project. And then just this year, February 28th, we closed the acquisition of 8 properties from KGHM, including the producing McCreedy West mine, which myself and many of our team have worked at before with FNX, as well as Levack and Podolsky mines, which we also had in production. So it's been a great ride for us over the last 8 years, and yeah, I'm really excited to tell you more about it. So throughout this presentation, there will be a number of forward-looking statements. I'd like to caution all the listeners, do your own due diligence. So since founding the company, really I've had a vision of how we were going to grow, and it is based upon 3 pillars of growth. First one, production. Now, being in production with the McCreedy West mine, we see an opportunity to continue to grow, to bring other projects we have which are permitted into production and continue to grow that production profile. The second pillar of growth is exploration, and much like the success that FNX had making some major discoveries in Sudbury, we believe there's still a lot of opportunity to make these types of discoveries on our properties, and much of our exploration team are the former FNX team and my former colleagues, so it's great to bring back that team. And then the third pillar is one that I think we have been very successful at, is acquiring non-core assets from major mining companies in Sudbury. And we have proven that we have a track record of doing smart deals, and we truly believe this is a strategy that we will continue to pursue, and we think there's great opportunity over the next 12 to 24 months to make other accretive acquisitions in the Sudbury Basin that have synergies with our existing team and projects. So this is a map of Sudbury. The Sudbury Basin was created by a meteorite impact about 1.85 billion years ago, and the mines typically sit on the edge of this crater. The city of Sudbury itself is about 180,000 people, a 4-hour drive north of Toronto. Currently dominated, I would say, they're primarily operated by Vale and Glencore, and then we are the 3rd operating company in Sudbury. Our business model is to sell ore to Vale and Glencore's mills. So we don't operate our own mill, which has a lot of benefits. It allows us to be very flexible with our production, and we simply deliver the ore to these mills and get paid for it. In black, you can see that's our McCreedy West mine. This is our producing copper mine. Next door to it is the Levack mine. The Podolsky mine is just on the other side of the basin. And then we have our Crane Hill and Shakespeare projects. All those projects that are labeled there in blue are fully permitted, past-producing mines that we believe we can bring back into production very capital efficiently. And those gray properties outside of that are earlier stage exploration properties where we also believe there's great potential. So we have a broad portfolio of projects from production through to exploration, and this really fits with our 3 pillars of growth. So with all those projects, people ask, how do you stay focused? What are you, going to accomplish? Well, it's quite simple. For this year, we are focused on the McCreedy West mine. McCreedy West is a mine that was non-core to its previous owner, had not received the kind of capital that we believe that it deserved and then the attention it needs and deserves. So we are going to focus on investing capital, increasing development at the mine, opening up new workplaces, and this is really going to create what we believe an optimal, sustainable mining operation at McCreedy West. And we believe that we can use cash flow in 2026, once we've made these optimizations, to be able to reinvest, to bootstrap Levack, Podolsky, Crane Hill, and eventually Shakespeare, and bring those back into production. So this bootstrapped approach is very similar to my experience with FNX Mining, and we believe we have an opportunity to do that as well. This is a picture of the McCreedy West mine, a very simple operation, ramp access. Our offices are trailers. McCreedy West has been operating, it was reopened by FNX in 2003, and has been operating continuously since then. Prior to that, it operated for about 25 years by Inco. It's produced about 22 million tons so far. So it is a long life mine that just keeps going, and it's a very shallow mine, which has a lot of benefits to it. We have released a NI 43-101 resource on it last year when we announced the acquisition. Currently that sits at about 9.3 million tons in the indicated category. Last week we had the honor of announcing our first quarterly financials. Now, be it closing the deal on February 28th, it was only for the month of March, but again, it was a huge milestone for our company, and we're very pleased to be able to say that in our first month, even with all the transition and there was management changes at the mine and I would say a slow start, we were able to turn a small profit margin of about $300,000 for the month. Again, a good start for our first month, and we also closed the quarter with $38 million in the bank. So we are well cashed up to execute our plan going forward. So this is a map of the property boundaries for McCreedy West and the adjacent Levack mine. So McCreedy West is right here. This is the town of Levack, and then the Levack mine is right here. And I just want to point out this white dot right here is one of the most important buildings in the town of Levack. That's the hockey arena where my son plays. So as I mentioned, about a 9.3 million ton indicated resource at the McCreedy West mine, and that is between three distinctly different zones. So there is the contact nickel zone, there is the PM zone, which is a footwall breccia-hosted deposit that's higher in PGMs, lower in sulfides, lower in copper. And then there's the 700 copper PGM complex. And that 700 zone, that is where we are focusing our attention, and we are primarily focused on copper at this time. So as I mentioned, the Sudbury Basin was created by a meteorite impact, and this would basically be the wall of that crater, and this is where the nickel deposits in Sudbury typically would be deposited and found. And then in behind that, in the footwall, hosted in a rock type called Sudbury breccia, you get these footwall deposits which are typically higher in copper and higher in PGMs. So we can target certain commodities, and we believe that at some point nickel will rebound, and probably rebound quite strongly. We will be in an enviable position to take advantage of that and restart nickel mining in the inner main. In the meantime, we'll focus on copper because that's providing us the best margins. So out of that 9.3 million ton global resource at McCreedy West, there's about 5.2 million tons of it in the 700 complex at just under 2% copper and just below 1% nickel, with about 2.5 grams of precious metals. And this is the resource that we are currently working on developing a long-term mine plan and doing the development to access other areas. So what you're seeing here are in orange are our design stopes for the remainder of this year in the 700 complex, and in green is our development that we're planning on doing throughout the rest of this year and the first half of next year. What we really want to do is get the development out onto this western side. So a lot of this area was that 15 million tons that Inco mined while they were in production, but that western side of the deposit wasn't mined by Inco. They had a very high cutoff grade at that time. We believe there's still a lot of opportunity. We've done some drilling, albeit not at ideal angles, but we believe that this will become sort of the new complex of the McCreedy West mine. that allow us to have higher throughput rates, beyond what historically has been about 900 tons a day by the previous owner. And we think we can get that well over 1,000, possibly up towards 1,500. But we need to get the development in place. As you can see here, a number of levels that are laid out, and then that will allow us access to that west side. And really, once we get drilling, this west side, we believe, can have a tremendous impact on the future of the mine. We released some drilling already this year since we've acquired the property, and this is drilling that's really supporting our mine plan and helping us to better design our stopes. And what we've seen is some of this drilling is outside the currently designed stopes that we inherited when we bought the property, but show opportunity to either enhance grades, expand stopes, or at least adjust it to optimize. And some of those intersections are quite good, such as this hole here where we intersected 14.5% copper, 3.5% nickel, 6 grams over 9.6 meters. So there is some very, very high-grade copper still remaining in the 700 complex, and we're definitely engaged with 2 drills turning to better define that so we can mine higher grades and higher margin ores. So then on to our Levack mine, and Levack is a mine that's on care and maintenance. It operated up until 2019. It has got a lot of infrastructure. It's got an active shaft. There's people going underground every day. We have a small team that's doing care and maintenance on the mine. But our goal this year is to build a restart plan to restart Levack, and we're currently drilling on the property to support that. So again, Levack and McCreedy are connected underground on the 1,600-foot level, and Levack acts as the secondary egress for the McCreedy West mine. Much like McCreedy West, it has both a contact deposit as well as a breccia-hosted footwall deposit. We have a historic resource currently that was done by the previous owner, and we're in the process of updating that resource, and we will plan to have that out by the end of Q3. But based on the historic resource, there's about 5 million tons of contact nickel at 2% nickel, 1% copper, as well as a significant footwall component that is more copper dominated. So the footwall deposit that was mined up until 2019 is called the Morrison deposit. It was an FNX discovery, very high-grade copper. I brought that deposit into production with FNX. We mined 8 to 10% copper, 8 to 10 grams precious metals, and about 1.5% nickel quarter after quarter while we were operating, so very high-grade potential. But our restart plan will not be looking at going after what's remaining in the Morrison deposit. We're going to be looking to develop a plan that's much closer to surface. And our recent drilling that we've announced is supporting that plan. We've announced a few intersections that we've drilled that are within 200 meters of surface, where we intersected narrow intersections up to about 1.8 meters, but 24 to 25% copper. So very chalcopyrite-rich veins, and these are typical of what we see in Sudbury footwall deposits, and very typical to what we mined in the Morrison deposit. So our goal right now is to expand this mineralization closer to surface in what we call the keel zone, so that we can incorporate that into a mine restart plan, along with the remaining resources that are already there. Now, quite quickly, we recognize that these footwall deposits that can be very, very high grade in copper and precious metals are hosted within a rock type called Sudbury breccia. And what we're showing here in these yellow shapes is that Sudbury breccia plane, and we've mapped that out, and now that we understand it better, we can start targeting areas that we think have high potential for additional high-grade copper footwall mineralization. And that's what we started to see, and this is where we're following up. So those high-grade hits up in the keel zone, they're on this breccia train. It also, in this breccia area, hosts the Morrison deposit. But in between, there's been very little exploration. A few holes FNX did intersect had some high-grade copper. We're going to follow up on those. There's a large fault that offsets the deposit, and I see I'm running out of time, so I'm going to jump ahead, but a lot of exploration potential in the footwall and between McCreedy West and Levack. $38 million in the bank, great support of shareholders led by Dundee Corp. Stocks performed well, and we're really excited to continue ramping up production and exploration throughout the course of this year. Thank you very much.
Thank you, Jason. Good morning, everyone. My name is Thomas Bachand. I'm Managing Director in Investment Banking at National Bank based in Montreal. I'm pleased to be with you to moderate the next few sessions. So next up, please help me welcome a panel on the future of mining, AI, and efficiencies. This panel will be introduced and moderated by Pierre Matt of Agnico Eagle. Pierre?
On s'en va dans le fond.
Hello, everyone. So today we're going to talk about future of mining. I know that mining people are seen as a conservative bunch, but there's a lot of nice things going on. Today we're pretty lucky. We have 5 people really working on in really innovative business. So we're going to talk to them and learn a bit more. So we have here Alain, which is the president of GPR Geophysics, and also he's the founding partner of SOAR Technologies. We have right next Doug Morrison, who's the president and CEO of SEMI. And then Ed Humphreys, VP Global Capitalization for, sorry, I got it here.
Atkins Realis.
Yeah, Atkins Realis. And then we have GP working for Verify, CTO of Verify. And lastly, Matt Granger, VP of Value Creation at VerAI. So we'll welcome everyone, and then we'll start going with the first topic. Just a brief, I will ask you just a brief description of your business and how do you see the future of mining. So maybe I'll start with Alain right here.
Thank you very much. As you said, I'm one of the founding partners of Core Technologies, which is a spin-off of Geophysics GPR, and we're really focused on AI applied to exploration, mining exploration. Where, I don't want to take too much time because there's many of us, but where do I see AI and how it's going to change exploration? I think AI, just like beer, will change the world, but I don't really know how. No, I'm just kidding, but AI will make a huge difference in the level of productivity that exploration, on how we do exploration. But it will have some downside, especially when it comes to level of unemployment. In our company, we've implemented some AI processes with agents, and I can tell you, like what we used to do, let's say in 200 hours, now we could do in maybe 20 hours. So that's a big change. So yeah, there will be very important changes in the future. And when I say in the future, I mean in the next year.
Thanks, Alain. Doug?
Okay, so SEMI is a small organization based in Sudbury, Ontario. We originally were focused on developing technologies for deep underground mines and for tailings. Now we run a network of 60 companies that we fund with federal funding to develop new technologies that can be applied across the board in terms of productivity, energy reduction, automation, and tailings and waste management. So that's the program that we run. The important thing to remember about mining is its primary role is to meet the needs of the industrial complex globally. And right now, we are on track to fail epically to do that in the next 10 or 20 years. because of the increasing demand for metals for the energy transition. So if we're going to meet that demand, we have to change things radically. The first one that needs to be changed is we need to get to a place where we can mine, do the mining we need to do, and leave no toxic or injurious waste material behind exposed to the environment, number one. That has to be a fact, an executable fact for every operation. Second of all, ore production in our mines has to become fully autonomous, not automated, not partially automated, fully autonomous with no people operating the equipment. Because we cannot actually hire young people to come and do the equipment that we have now, so they're not coming to do that, and the conditions are already roughly 40 degrees centigrade, 100% humidity for a 10-hour shift in the dark, and your average 20-year-old is not coming to do that. So we're not going to be laying people off. We actually have to do it in order to keep these mines productive. And the cost of that kind of technology means the cost of production would drop by more than half. So that's what we focus on. That's it.
Okay, thanks, Doug.
I'm part of Atkins Realis, which is a sort of 40,000 strong global community of designers, creators, builders of large-scale infrastructure, everything from roads, rail, port. We heard some reference to our burgeoning nuclear business earlier on in one of the other panels. And I sit in our minerals and metals division, and I think from my perspective, from an engineering services perspective, the future of mining for us really has to be do a much better job in delivering capital projects, and I think has been sort of historically evident. And I think from us, it's how do we really use that technology to transform our relationship with our customers, whether they are global super majors or at an exploration level, and tailor those services really to better manage risk around schedule and cost at a fundamentally different level, right? And I think for us, that's around a mixture of internal productivity tools and really sort of unleashing the creativity of engineers to do what engineers should be doing, and that is not focused on the more menial tasks. It is really getting creative about how we deliver engineering solutions, modularizing plants, standardizing plants, so that there's much more surety in the early stages of mining capital projects around the capital required. And then when that capital is actually deployed, is reducing the risk of that capital deployment to a level where we're creating long-lasting partnerships rather than a sort of revolving door of engineering companies who may or may not be next in line to be hated by their customer. And so that's something that we're looking forward to over the next few years.
Thanks. GP?
All right, thanks. So at Verify, what we do is mostly software solutions. So you might have seen our traditional business on stage just prior to this talk. So we provide a tool to communicate 3D models across the industry. The goal for that and the future for that is really to be more transparent in how you communicate and sort of be able to attract people from outside our traditional investment base. So one of our success metric at Verify would be to be able to attract capital from the outside of the traditional capital sources that the mining industry relies on. And for that, we just need better communication, better transparency, and sort of get people understanding how mining works, how mining investment works, but more crucially, how exploration works, which has always been, people talk about the AI black box, but if you're not from the geology sort of echo chamber, mining exploration is a really, really like a really tough black box to crack, to be honest. So you have companies are selling exploration projects or trying to sell targets, and they're mostly relying on how good their geologist is, which is pretty hard to sell if you're talking to people who are metric-oriented. Which comes to our second business at Verify, which is an AI exploration tool. And the goal is to be able to integrate a whole lot of data that's not sort of been integrated in the past. So we're sifting through a lot of data. We're building a huge private database as well to train exploration models. So this environment provides you with an online platform where you can generate models, so exploration models, test hypothesis, go through your data, but more clearly produce something that is a heat map to where your targets are. And this provides a tool that's much better suited for the investment community to understand, as opposed to a geology map with colors and a mag survey over top of it and some points for soil samples, and then you're trying to communicate that to somebody who doesn't understand the geology. Now you can provide a tool that's much more sort of transparent in terms of where you're most likely to find exploration targets, You have metrics that you can sort of qualify your model with, which is a new thing in the industry. If you ask a geo, they'll never tell you their uncertainty of their targets. They'll never come up and say, well, this is a target, I'm about 50% sure of it. Whereas if you use a data-driven approach, a quantitative approach as opposed to a qualitative approach, then you can actually accurately measure risk and communicate that risk across your investment base.
Good. Thanks.
Hi. Thanks. It's Matt Granger with Verai Discoveries. Just some background on the company. So it's again, it's an AI platform, but our model is quite distinct in that we're using our technology, leveraging our technology to make new discoveries, but very much working in partnership with the industry. And I think one of the things that we feel is that there's a lot of noise around AI just now, but we think that the industry, we're still going to need technical people, we still need geologists, and so our model is very much working with partners, an iterative process to generate new discoveries. My prior background, I was a founder of Altus Strategies, now Elemental Altus Royalties as a geologist, and we had the same partnership model where we worked with earn-in partners, JV partners, to make discoveries and finance discoveries. And I think at Verai, we're taking the same approach. The difference is that we're utilizing technology now to make those discoveries.
Okay. Thanks, Matt. So briefly, the other question, just a brief answer from your part. What technology will disrupt the mining industry that's coming right now? What would you say, Matt, if I start with you?
Well, unsurprisingly, I think in our space, in the discovery space, I think some of the things that we're seeing, some of the things that we're doing, we think have that potential to revolutionize the sector. Obviously, we are hamstrung by a lack of discoveries, very well understood, poor track record. Things that are at surface are now very hard to find, and so we're going to have to look subsurface to make new discoveries. So I think that's an important theme for us. But I think in general, I think it's there's other things within technology, within AI, that are going to impact the whole mining space and lead to great efficiencies. I think one thing we haven't seen in the mining space, in the industry, is the step change that we've seen in the oil and gas industry. We're still broadly doing things the same way we've been doing them for 100 years. And so the industry moving away from the discovery space needs to find that pivotal moment where we're doing things smarter in terms of the mining side.
Okay. GP?
Yeah, for me, it's more a concept than a technology that's going to solve the issues that we have, and that concept is all revolving around optimization. So optimization of any processes that we do. Like right now, nothing is optimal, from exploration all the way to production to processing plant. Nothing is really optimized properly. We don't have any digital twins. If you look at other processing factory just process, there's a lot of optimization going on, so you could use AI to optimize, but just general things that aren't done right now in the industry. So it might be AI that solves it, but it might be just the fact that we start building digital twins of plants, we start building digital twins of mines or exploration projects, and that allows you to iterate and test a lot of concepts on your projects and be able to sort of find the optimal way to do it. Yeah, so like mine planning is sort of what we call optimized, but how many projects do we see failing on the first 5 years of production? It's most projects, right? So I think there's a lack of optimization in the industry, and I don't think that's a single technology is going to solve it, but more of a change of mindset is going to be needed for an industry to change.
Okay, thanks. Ed?
I think for me, it's not a single technology, and it's a little bit conceptual. And I've had the real privilege to be part of some really big technology transformation programs in oil and gas, utilities, mining as well. And for me, I'm an AI optimist, and for me, I really see the next few years being the chance where we actually fully unleash the most important technology in all of this is the AI augmented superhuman. I think it's all of us becoming far more productive, and I'm looking forward to an age where people aren't trapped in 9-to-5 jobs in their silos by their technology, but actually we're truly looking at pan-system optimization with people's creativity unleashed because the menial components of the jobs have been taken away. And then that's leading to some fundamental transformations in the business model. And I think that's going to be a profound influence on all companies. And one of the biggest, how you handle that is going to be one of the biggest moral and ethical equations of our generation over the next sort of 3 to 5 years.
So it's a bit scary from an industry that waits the last minute to change their version of Windows.
Totally.
So,
totally.
Okay. And you done?
Yes, I think exactly what Ed said. We have to eliminate a lot of the menial tasks that are done on a daily basis by human beings. We can no longer do it as we go deeper because the conditions are getting hotter and hotter all the time. The energy that we need to use to cool that down to make it tolerable for humans is now prohibitively expensive. So that all has to change. We also have to stop trying to cool down the entire space that we open up because most of it doesn't need to be cool. It's only the pieces that have particular components that need to be cool. Cool those pieces and don't cool the rest of it. And that reduces dramatically the amount of energy you use for ventilation, which is the second biggest cost after labor. So making those changes are the kinds of things that need to be done. It's not a single magic bullet for them all. It's a sequence of different components that need to be sewn together. So we've been identifying for the last 8, 10 years now all the individual components. Now we've got all of the pieces we think we need. We've got them kind of identified and tied together. And what we've done in the last year is identify what we would call the disruptor companies that will come in and actually implement those pieces of technology to make it change. Because there are vested interests who have no interest in changing what we do now to something new and different. And they're not going to change it, therefore a disruptor has to come in and make that happen. But if we don't do that, there will be no energy transition to a low-carbon economy because you need a hell of a lot more copper and a hell of a lot more nickel plus all the other metals. And if we don't produce those, then the rest of the planet melts and burns.
Yep, good point.
I think core technology has all the solutions. No, I'm just kidding. I don't have a crystal ball, but nor am I a specialist of the whole sector. But I would say in exploration, core technology has really a really clear vision on what we think will be the really disruptive technology or a combination of technologies. So predictability mapping, there are many companies doing that. And basically this is more or less based on how big your database is at this stage. So we're pretty good at that. And when it comes to other geophysical techniques for exploration, we're going to need to be looking at depth. That's for sure, because the deposits, the surface deposits have been depleted, most of them. So we developed a technology which is based on seismic. We've been in business for 50 years with geophysics GPR, and core is a spin-off. So we're going to be using a passive seismic technique, but there are other passive techniques. So I would say in general, passive geophysics, where you don't have to cut lines in the bush, so environmental is no longer an issue, where you don't need 6 or 10 people to carry out a survey during 3 months, and you could do the same thing, let's say, in 4 days, and provide a 3D model up to 3 kilometers in depth. I think that's very disruptive. And that's what we want to scale up. That's what, yeah, so I don't think there are many companies out there doing that kind of stuff. So, yeah, I might be a little bit presumptuous here, but I think we're going to be part of the solution.
Can I just cut in here? You said something that sort of tickles me a lot, and it sort of goes against what we're doing. It's kind of funny, but like everyone's been saying that we need to go deeper, and we need to go deeper undercover, and we need to go in these unexplored areas because that's where all of the deposits are found. I don't believe so, and I think there's still a lot of things. Because if you were to say that, that means that you were 100% efficient at finding the deposit and the data sets you have, and to me, I don't think it's possible because humans look at 4 or 5 dimensions of data at the same time. So you could look at your soil. There's no gold anomaly. everything else is there, but then you walk away because, oh, there's no gold in my soil. But there's other processes that could remove that gold in your soil survey. So you might be missing a deposit right there. Might be a swamp over top of it. So you weren't able to soil sample it. So you don't have data. You're like, oh, I'll walk away. And as like Verify, our core, the way we were started was with the triangle zone discovery at Sigma-Lamac, which sat 2 kilometers away from the 2 biggest producing mines in Quebec, right? It's sitting right there. Nobody else explored that area. For some reasons, there's a swamp. There's a different model, but also it was sitting at the boundary between two historic and big properties, so no one was willing to go and explore there because you don't want to find half a deposit, right?
And I think Matt agrees with you.
Yeah, look, I was going to say, and I sort of agree with Jean-Pierre then, it's sort of interesting listening to potential solutions around heat with deep mines and solutions at 3 kilometers. What about if we make some discoveries that are just below surface? We've got a really good, I'm talking my own book here, but we've got a very good example in Arizona where we have staked a high priority target based on training on those mines in the area, porphyry copper deposits. Just up the road, you've got a management team that's looking to spend $9 billion on a mine 2 kilometers below ground. And to me, I think we're maybe looking at the wrong problem in the industry. We need to be finding things that are near surface, at surface, faster, better. I mean, that's what we need to be focusing on as an industry. Less energy, easier to permit. So many reasons why that should be the focus of us.
But yeah, if I may, I would say that I totally agree with you. That's why I said a combination of predictability mapping, which is surface stuff, combined with a technology that can allow you to go to, let's say, 3 kilometers at depth or something like that in a blink of an eye almost, let's say 2 weeks versus 6 months, that's the solution. Because then you're not just skimming the surface, which, and I agree, there's a lot to be seen. All I'm saying is that if you combine that with a technology that allows you as well to look at depth, then I think you have the winning solution. And so that's why I would welcome to work with you guys.
So I guess you're all talking about AI and exploration. Is it AI alone or AI with a combination of another technology, or how do you see it, G?
For me, it's AI combined with domain expertise. There's no way, and you see it happening right now. Trove of people are getting out of Google, Stanford. They're pure data scientists. They try to tackle the exploration problem. And we've hired a lot of these people as well with postdocs and machine learning. They don't understand the data we're dealing with. And our data is such a particular data set where it's not actually data. So like the data would be, like if you run a MAG survey, the data is what come out of the MAG, like the measurements. We provide things like grids, which are models of that data. So for like a data scientist, that already like blows their mind because typically you're not supposed to feed in models into models. So I think it's really important to have domain experts in the loop. So it's not like an AI you could unleash and just to have a bunch of the best coders out of Facebook gonna solve the industry. And there's a lot of claims around that right now. And you'll see it fail pretty soon just because they just don't know the domain in which they're working. So for me, yeah, it's AI plus a geo for sure.
But that's a good thing, because I remember we had a discussion and you say all the experts going to disappear with AI, so...
No, but I had a conversation with Chief Innovation Officer of one of the GAFAs, and and I asked him, what's going, where's going to be the, he basically, if you listen to Eric Schmidt and all these guys, they're saying you have the best mathematician right now in a box right now. The next thing's going to be the physicist, so I mean 2 + 2, so where's going to be the geophysicist? So basically what he's told me is that by the end of the year, the best geophysicist will be in that box. And he thinks 9 out of 10 entry level or geophysicists, or they'll be replaced. So yes, so there will be a huge disruption in the requirement of university grads or whatever. That's happening, whether we will want it or not. I mean, we're able to get like easily 100% improvement in our QA QC when we do MAG, we do IP, and we're doing that with agents. So that's happening. So I'm not saying the human factor will not be there, but instead of having 10 people, you might just have 2. So there's something happening there as well.
There's going to be a case of adaptation, I suspect, adaptation to survive. You're going to need geologists, you're going to need engineers, you're going to need all of these people, but they're going to have to adapt because you can see what's happening in parallel universes. You can see what's happening in pharma, other industries where AI is becoming transformative. And there's a lot of hype around AI, as we know, but you can see that in industries, similar technologies that are having a profound effect, and it's not going to stop. It's only going to accelerate.
Okay, thanks. And Ed, on the AI and operation, how do you see it? And is there other things that we're missing? Is it just AI or?
No, I think for me, and I think we've been doing this for the last decade in various sort of success, right? And I think many companies have had, especially in the mining space, everything from digital twins, predictive maintenance, optimizing the process plant, all of this sort of good stuff. And then I think, as you referred to earlier on, nothing's really changed the business model. The way we're looking at it from an engineering services perspective, everything that we're looking at is changing how we're going to be contracting. It's going to be changing how we deploy resources. Things like project controls and things, we can now almost democratize the data, make it so easy to do that. You could offer that as a free service to everybody, right? And I think that changes our business model. And so for me, and I think you touched on this as well, is around you're moving from point optimization in operations where you're really trying to drive those jaws of margin apart. You're looking to get more cheaper ore tons, into your processing plant, whilst generally reducing your cost of power and ventilation, everything else as well. There's of course an ESG dividend, a safety dividend, and everything else that comes with that. But actually, again, it's still very point optimized at the moment, and I think we're moving to a space in operations, again, unleashing the power of sort of human creativity in some ways by giving them whole system optimization capability. Where maybe you're going to run your plant at a slightly different speed because of the cost of energy that's coming in at that particular hour, right? Which you wouldn't necessarily be able to do these days. So for me, operations is about that whole system optimization. And again, and why it's not stuck previously is the business models haven't changed. And I slightly wonder, a little bit like self-driving cars, look at the rise of Waymo and potentially others. Are any of us going to own a car in 10 years? Or is the insurance company going to own the car? And I'm just going to summon one. And maybe we're starting into that realm in mining. Maybe I don't own a fleet. I don't want to have the responsibility of owning a fleet and covering the maintenance of that. Someone's going to provide me a fleet as a service, right? And where else might that apply elsewhere down that cycle? And I think that for me is an exciting space to be in right now, and it certainly is for us in the capital space. Capital projects delivery.
And I know, Doug, we've talked about it. You said, well, AI is fine in certain sectors of mining, but not everywhere. So what are the limitations for you right now?
It's not a limitation. It's just a best use. When you have a very complex data set, you need multivariant analyses to get to the answers, AI is ideal for that. Most of the things we do underground, I'm sorry to tell you, is not rocket science. It's pretty well arithmetic. It's not that hard to do. You can do it and you can figure that out. What has not happened is we have not introduced a new technology platform for ore production or for mine waste disposal in 40 years. There is no other industry in the economy that has not changed its fundamental production platforms in 40 years. That's the industry that we're currently in, and that's what has to change. Yes, we'll have a lot more deposits discovered, and we will discover them much closer to the surface. But it's still going to take 5, 10, 15, 20 years to get it into production. So that's not going to change very quickly. There are things that can accelerate, and one of those is social license to operate. We keep talking about permitting time. There is no regulation that was ever introduced by a government proactively before something happened. Every regulation we have is in response to some mistake, some safety event, some financial crisis, etc. That's why it was brought in. So the regulatory framework we have is the one we deserve because of our misdeeds in the past. I'm sorry, that's just it. The solution to that is to come up with better and new technological solutions to overcome those. And the one that's going to be the killer for all of us in the near future is license to operate. I don't care if we take 6 months off the permitting time, because more than that is going to be required to persuade local communities to accept the waste management profile that you intend to implement. And if it's the same answer as it was 10 years ago or 20 years ago, your project is already dead because it's not going to get licensed to operate from almost any community anywhere. That's why that's the fundamental shift that has to take place. And what we're actually discovering, shockingly, and I didn't anticipate this, is when you actually develop the techniques to separate out some of the material in the waste stream, you now access all the other minerals that are locked into the tailings facility. Because you only mine 1% gold, 2% copper, or 3% nickel. The other 97% is all in there. I actually had a client come in looking for a new solution for her business to extricate it from the US, finding a solution for different types of clay. And I thought, well, this is pretty menial for me because I'm used to big copper mines, big nickel mines. Why should I be concerned about this? In actual fact, the tailings deposit we were looking at extracting the remaining gold from was worth less than her annual production of her product for pet care. So you just need to recognize there's a whole other economy happening out there, and they all need minerals of different types. And we have locked up billions and billions of tons of minerals that could be used in the industrial economy that we've simply allowed to fester in toxic ponds for over 100 years. So that's the fundamental shift that needs to change and change fast.
Thank you. So we're pretty much done here. Thank you all. It was a very interesting conversation. Thank you for being there.
Thank you.
Thank you, everyone. Now, please help me welcome Lucas Dow, Chief Executive Officer and Managing Director of Sayona Mining, for a fireside chat with Ben Peary of Atrium Research.
Well, Lucas, thanks for coming. Good
Thanks
to
for
have
having
you
us along,
here.
Ben.
We're on the clock already, I see. So maybe to kick it off, you can give us a couple-minute overview of the company, where you guys are at. I know you have a merger ongoing, and so maybe we can touch on that a little bit and then get into the asset-specific stuff in a sec.
Great, thanks, Ben. So Sayona Mining, ASX listed. We're North America's largest spodumene producer. We're proud to say that our assets are here in Quebec, and we're operating at North American Lithium. We've got a number of projects, and we'll touch on that in a moment, but I think probably just a headline and some of the very exciting news we had in November last year is that we're merging with Piedmont Lithium. We announced that back in November last year. We expect that to conclude over the next few weeks, which will be great, and really sets Sayona up and will be known as a Levra, really as a very uniquely positioned lithium-only player, given that we're an incumbent producer and with a really great and we'd say unparalleled set of growth options as well. So really, and a very strong balance sheet. So we're in a really unique position.
Mm-hmm. Well, and maybe just while we're on the merger, you can talk about the balance sheet, how that is structured and why you're going to be in such a strong position going forward.
Yeah, so I think one of the key things and with the merger, and one of the catalysts was really some of the exploration success we had at North American Lithium, and I'll come to that, but the other key aspect was an opportunity to be able to really materially move our corporate costs, particularly in this low price environment. So on the back of that, we both raised 40 million Australian at the time of the announcement back in November, and RCF, Resource Capital Fund based out of Denver, they'll be coming with another 69 million Aussie at completion. Really sets us up with a really strong balance sheet to be able to move forward. And importantly, we don't have any secured debt on the balance sheet either, so nice strong balance sheet without any debt really has got us positioned positioned very well in what is obviously a challenging price environment. But as for those of you in the audience that have seen this lithium cycle before, you'll know that when it snaps back quickly. And what is really fundamental is that you've got to be there and producing. And as North America's largest producer of spodumene concentrate, we're uniquely positioned.
Mm-hmm. And I do imagine it will spike pretty quickly when that time comes, and hopefully some investors are part of that ride. But getting into the assets specifically, NAL, the North American Lithium operation, maybe you can talk about that. You guys are producing right now. Tell us a bit more about the project.
Yeah, great, thanks. So North American Lithium, based here in Quebec, just near Amos or Val d'Or. We're up and we've been producing at sort of nameplate capacity a little over sort of 12 months now. We're knocking out around 200,000 tonnes of concentrate a year. Sylvain Collard, our Chief Operating Officer and President here in Canada, great operator. He's built a really exceptional team there. We're really proud of what we're doing. We're seeing mill utilisation in excess of 90%, recoveries of 69%. In fact, we've seen months that have been sort of closer to sort of 70 or 73%. So those underlying elements are really going quite strongly. And I think for those of you that are unfamiliar with North American Lithium, the asset's been around, and this is actually, we're the third owner, and the obvious question is, well, what's different this time? We've taken a very different approach to the way in which the operation was operated previously. Specifically, we've approached the mining activity in a manner that's more analogous to gold mining, whereas previous owners have tried to really bulk it out. The consequence of that is we've got much less dilution, meaning we've got cleaner ore going to the mill, which means we get more material through the mill. We've also had significant capital upgrades, putting in things like a crushed ore dome to give you capacity between the crushing circuit and the milling facility. Consequence of that is we're seeing more mill utilisation and uptime. And the reality is that we've had months where we produced in excess of sort of 19,000 tonnes of concentrate. I think previous owners had sort of got in the order of about 13 or 14 on their best days or best months. So you've seen a step change. Consequence of that is our unit costs are obviously much improved from where other owners. So I think the long story short is really saying NAL, very different asset to what it's been previously. And as a consequence of that, from a volume and a unit cost basis, we're in a much better position. Combined with a strong balance sheet, we're uniquely positioned to be able to see this low price environment out and importantly drive growth options forward.
Right. And yeah, low prices force you to be responsible, and you've got time to lower those costs and ultimately take advantage and be highly profitable in the future. So maybe you can quickly talk about the 2025 production sort of guidance, what you're expecting for the year, and maybe even touch on 2024 production.
Yeah, so we're in the final quarter, or actually final month of our financial year 2025. Right. So we'll close out. We've had guidance out sort of that 190 to sort of 210,000 tonnes of production. We reiterated that. We've had a really strong start to the fourth quarter, so we're coming home with a wet sale, which will be great from a unit cost perspective as well. As we look forward to FY26, which will kick off 1st of July for us, sort of more of the same people can expect. We've got some further improvements that we expect to see flow through, which is great. I think other key aspects that people should keep their eye out for as we move through the remainder of calendar year 25, particularly catalysts for us. Completion of the merge is obviously a key one. And I might just take a step back. One of the key elements and drivers for the merger is previously we'd raised money through flow-through share funding, which we put to work in terms of exploration at both NAL and also at Moblan. Those programs have been wildly successful to the extent that we'll see increased mineral resource estimates out in July and August for both of those projects. But more so, the reality is at NAL, it's a much larger resource base than any of us had imagined when we acquired it. Consequence of that being that we can, and we've got a scoping study underway, and we expect that to be out in August, that contemplates expanding NAL. Now, why is that important? A couple of things. One, it's a brownfield development, and so effectively, the utilities, the infrastructure's there. We'll have to duplicate some processing capacity. But the exploration work has also proven up resource along strike. So long story short, if you think about it, the geology's, all those things that you're worried about on a greenfield project, those risks effectively won't be there for us on a brownfield project because we know how the geology works, we know how the metallurgy works. And I tend to think that you'd be hard-pressed to find a more capital-efficient way of being able to bring additional spodumene production into play here in Quebec than what we're going to have at NAL with a brownfield expansion. So we're really quite excited about seeing that or getting that work done and being able to inform the market on that in August. So, really a lot to like at NAL and very excited about that. I'll come to Moblan in a moment, but that's, again, another tier one long life, low cost asset that we're very excited about.
And maybe on the MRE, you can touch on how much drilling you've done since the previous one, just so people can kind of get an idea of what to expect going forward, and then ultimately these expansion projects.
Just in calendar year 24 alone, we'd sort of put in over 70,000 metres across sort of both those projects. So, people can expect that we're going to have an exciting amount of information to be able to come up with that updated MRE. And that'll underpin the resource base at NAL and the potential expansion. And I think the other component, we had a DFS out for Moblan back in 2023. Resource base has grown appreciably since then. We're going to take another lap at that. It may well be that Moblan can support close to 600,000 tonnes a year. So that's another piece of work that we want to do. In addition to that, we've kicked off environmental baselining studies at NAL to be able to sort of get the permitting underway for a potential expansion.
Great, and then pivoting to Moblan, maybe you can tell us a bit about the project. You mentioned where it's at right now with the DFS out, but maybe you want to talk about what that DFS looked like and tell us a bit about that project.
Right, thanks, Ben. Yeah, so for those that aren't familiar, Moblan's a little further north, but of all the projects that are proposed for the James Bay region, we're at the southernmost end, and we've got great connectivity with Chibougamau in terms of rail connectivity and so forth. Really is a fantastic deposit. It just continues to surprise on the upside. The more exploration work we've done, again, we expect a real improvement in the mineral resource estimate that we'll have out in July and August for Moblan and also for NAL. The reason we really like Moblan, very low strip ratio. From an environmental perspective, relatively benign. If I compare it with some other projects that are further north, they're battling with a lot of water and so forth and lakes. We don't have that. Great connectivity with highways, rail logistics out of Chibougamau, access to power. There's a lot to love about that project, and it really is a world-class deposit, long life, low cost. We're going to take another lap at the DFS, as I mentioned earlier. We think it'll support a much larger production volume. We'd probably do that in a staged approach, but it'll continue to drive unit costs down, and our unit costs during the DFS were around $555 Canadian on an FOB basis, which is pretty phenomenal and will really rival the lowest cost hard rock spodumene producers in the world. So, great deposit and very excited about it.
Right, and I imagine, a lot of that development could be funded internally, ultimately, if the lithium price can get where we want it to be. So maybe, because we do have a little bit of time, can you talk about the management team, touch on that, and then we can get into the cap structure and such from there?
Yeah, thanks, Ben. Yeah, as I mentioned, the team here in Quebec, led by Sylvain Collard, who's our Chief Operating Officer. Sylvain's a really experienced mining professional, maintenance or mechanical engineer by training. Worked in West Africa and then obviously here in Quebec. He's from the Abitibi region, so he really understands, gets the local community aspect. He's assembled a really great team, and if you've got to remember, whilst we're North America's largest hard rock spodumene producer, there's not another operation here in Quebec. So Sylvain has been able to manage to assemble a really crack team that, those folks didn't have the experience, but he's been able to drag them across from the gold sector. And again, it's a highly competitive area, particularly with gold on a tear around employment and competition for talent. So Sylvain's done a really great job in getting a crack team together in place, and particularly the metallurgists, the mining engineers, they've done a fantastic job. So, we're very appreciative of what Sylvain's been able to do. And he's a great example of the capability that we've got here in Quebec around mining professionals. So we just really want to continue to drive that forward. And I know we're in really great hands, and we're looking forward to being able to continue to drive NAL's unit costs down, get our volumes up, and move Moblan along in a meaningful way.
Right. No, certainly exciting. And again, for those lithium bugs out there, this is one that's going to be able to take advantage once those prices do get going. Maybe you can talk again, you mentioned the cash already, no debt, but the cap structure, maybe the share structure, just touch on that for a second.
Yeah, thanks, Ben. Our market cap's around 200 Aussie, so on a pro forma basis when we merge with Piedmont, so it'll be sort of 400 to 450 Australian. ASX listed, we'll also have a NASDAQ listing. One of the key elements that we'll do as part of the merger as well is we'll undertake a reverse stock split. We've got an obscene amount of shares on offer in Australia. Just as an anecdote, we described that number to Ben. It's about 11 billion shares. And Ben looked at us yesterday and he sort of said, well, is that 11 million or 11? Yeah, no, so we've got a bit of work to do. So we'll do a reverse stock split, and then that'll give us, what, as Andrew Barber, our head of investor relations, describes as sort of a grown-up share price. And then we'll have a NASDAQ listing here with ADRs such that certainly investable quality and pricing. So, really looking forward to being able to bring that to the market and build upon our existing shareholder base.
Right. And I guess the share price obviously down quite significantly over the last couple of years, but again, there lies the opportunity. The ones that bounced back when gold started ripping in the last couple of years first were the producers, right? And so you guys are producing, and you'll be able to take advantage of that as that comes. Just to cap off, we've got 1:30 here. Maybe you can give us a quick overview again of what's sort of coming in the pipeline from a catalyst standpoint and what investors can look out for.
Yeah, so as I said, merge completion, so in terms of those real catalyst events, merge completion, really strong, robust balance sheet, no secured debt on the balance sheet. MRE updates for Moblan, also for NAL, scoping study, and then obviously we'll also be delivering our quarterly results, which will be a testament to the work that Sylvain and the team have done. So quite a bit to come, I think, and just touching on it briefly, lithium price has taken a bit of a nosedive in the last few weeks. These prices are not sustainable, so the market's going to come back. And in fact, we've started to see funds purchasing shares now. Also, talking to traders that had been short lithium, now taking long positions. So, the question is, how long is that going to be? We can't predict that, but we certainly can control our unit costs, and we've got a balance sheet that will be in a position to be able to weather the storm. So, Levra, which will be the merged entity, uniquely positioned, and in fact, will be exceptionally positioned to be able to take advantage of when the price turns.
And I think the last thing, we got 30 seconds. What's the name of the new company? And then people can look it up in a couple months. So we'll be branded as a Levra. So once the merger goes live, we'll be there, and then the tickers in NASDAQ will be LVR. So and we'll have plenty of branding to go around about that. But we're looking forward to being able to get that out. Awesome. Okay, Lucas, thank you very much.
Thanks very much, Ben.
Thank you, Lucas and Tom. Next up, please help me welcome Alex Campbell, Vice President of Corporate Development at Fireweed Metal. Fireweed is advancing critical mineral projects in northern Canada, including the Macmillan Pass zinc-lead-silver project and the Mactung tungsten projects, one of the largest of its kind. Alex?
Hi, how are you? Hi, can everyone hear me well? Good morning, my name is Alex Campbell. I'm the Vice President of Corporate Development for Fireweed Metals, TSXV FWZ. Just some cautionary statements. Fireweed's two core assets are the Mactung and the Mac Pass project, both adjacent to each other, located in northeastern Yukon, right straddling the border with the Northwest Territories. The Mac Pass project is a collection of polymetallic sediment-hosted zinc, lead, silver, notably gallium and germanium deposits. And the Mactung deposit, which I like to call our accelerator or our unlocker, is the world's highest grade, the largest highest grade tungsten deposit out there. We also have the Gaina project, which is 200 kilometers north in the Northwest Territories. It's a high, it's quite remote, so but it has potential for high-grade mineralization, polymetallic zinc, lead, silver mineralization. Our two core assets, Macpass and Mactung, are accessible by road through the North Canal Road. They're 230 kilometers away from the nearest community of Ross River. We also have access to the port, deep sea ports at Skagway, and also railhead in Alaska, in northern BC. In terms of the investment highlights for Fireweed, I'd say we're probably going to be building on the momentum that we've gained through 2024. At Mactung, our tungsten deposit, we received $15.8 million from the U.S. government under the U.S. Defense Production Act Title III to advance the project to a final investment decision. That really turned off the lights turned on the lights for our project and created significant momentum and development traction in the region. At MacPass, last year we essentially doubled our resource up to 100 million tons and 7.3% zinc equivalent. We also conducted a comprehensive drill campaign of 16,000 meters, identified extensions that are existing deposits at Tom South, Boundary, and Jason. And maybe more notably, we also conducted a very comprehensive field season, which included ground gravity, soil sampling, VTEM, LiDAR, in the 1,000 square kilometers of property that we have, and identified new targets that we are planning on drilling this 2025 season. We're a Lundin Group company. The Lundin Group, the Lundin Family Trust keep supporting our project, and as a Lundin Group company, we are, we benefit from all the traction that the group brings, and they've been successful in raising capital for exploration, and also constructed and developed true districts all over the world. In terms of our capital structure, just quick snapshot, our share price as of yesterday is $2.27. We are roughly 100% up in the last 12 months, so that's quite a big uptick. With the Lundin Family Trust owning roughly 25% of our company and a market cap of $450 million roughly, I'd say I'd like to call ourselves a Lundin Group microcap. We have roughly, $12 million in our balance sheet, but this is not inclusive of the financing that we announced in early May. And we'll end up having significantly more. We're fully geared up for this 2025 season in terms of availability and accessibility to cash. Our leadership team experienced significant changes over the last year or so, maybe more notably with Adam Lundin joining as chairman of the board. Ian Gibbs also joined as CEO. Ian, I'd say probably Ian has been involved in more transactions than any other executive within the Lundin Group. He started his career in oil and gas, and now in exploration, copper exploration in South America, being the CFO of Josemaria Resources and the CFO of Filo Corp. Some notable additions to our board include, Jamie Beck, the former CEO of Filo Corp, Ron Hochstein, the CEO of Lundin Gold, and Wojtek Wojcicki, the CEO of NGX. So as you can see, it's pretty evident Fireweed has become a core company within the Lundin Group. In terms of regional geology, MacPass and Mactung are located within the Selwyn Basin. It's a highly prolific zinc basin that hosts historical assets like the Faro mine, which at the time was one of the largest open pit mines of zinc out there. There's also Howard Pass, very large scale, maybe a little bit lower grade than MacPass zinc deposit. And also the Selwyn Basin is overprinted by the Tombstone Tungsten Gold Belt, which hosts deposits like Dublin Gulch, like Keno Hill, and maybe more notably Snowlines Valley deposit. By the way, our claims are touching Snowlines, so we're close neighbors. Mactung, our project accelerator, our district enabler, that's how I like to call it, is the world's largest high-grade tungsten deposit out there. It's a fairly mature project with a feasibility study in place from North American Tungsten, a reputable tungsten producer from 2009. The company, unfortunately, North American Tungsten, went bankrupt. We picked this asset from receivership from the Northwest Territories. Thankfully, we have an environmental impact assessment in place with decision documents from the federal and territorial governments. So it's a pretty mature project. Maybe more notably, in late 2024, we received, as Fireweed, we received $15.8 million under the U.S. Defense Production Act Title III to advance Mactung to a final investment decision. So just today, we announced our 2025 drilling program, which includes 11,000 meters of definition drilling at MacPass to set the groundwork for to trigger a feasibility study by year end and potentially a final investment decision by year 2028. We believe that this award from the US government is just one layer of what we believe will be a multi-layered, non-dilutive financing cake. There's various other mechanisms by which we can access further financing, government financing, and Fireweed will be actively pursuing that. In addition to the US grant, we also received, in conjunction with that, 12.9 million Canadian from the Canadian Critical Mineral Infrastructure Fund. Of course, subject to due diligence. That's still subject to due diligence, but that's ongoing. The purpose of that other grant from the Canadian government is to plan for critical mineral infrastructure, so road and power up to site. And as you can see here, I love this chart because it shows Mactung's relative position relative to other tungsten assets out there. And it's a beast. Its size and grade just it just compares incredibly favorably versus other assets out there. And we believe that Mactung could be the answer to North American tungsten needs for various decades. In terms of timeline, as I mentioned earlier, this year we just triggered our program at Mactung, which will include 11,000 meters of drilling with the purpose of doing geometallurgical studies, geotechnical studies, hydrology studies, optimize our flow sheet, and finally gather all the information necessary to feed into an updated feasibility, which we will trigger by end of year. And finally, a final investment decision expected by mid-year 2028. MacPass, this is where we believe the core value of our portfolio is. It's a collection of polymetallic zinc, lead, silver, and notably gallium and germanium deposits hosted at the Tom, Jason, Endzone, and Boundary. Last year, we declared a 100 million ton resource at 7.3% zinc equivalent. Also notably, we declared for the very first time germanium and gallium resources. I believe, given the quantity that we have right now in our resource, we could be placed within the top 5, I'd say, deposits worldwide in terms of content of gallium and germanium. Also notably, we conducted a quite comprehensive exploration program in 2024, 16,000 meters, which defined extensions to what was declared in our resource in 2024 at known deposits, and also, and maybe more importantly, it set the foundation for what we will be doing in year 2025. All the regional work that we did was distilled into identifying various deposits, not various deposits, various targets that we're planning to drill this season, both zinc, lead, silver deposits, and for the very first time, reduced intrusion-related gold deposits. I'm just going to skip that. This is our land package at MacPass. It's 1,000 square kilometers, mostly untested, and the assets that you see there highlighted are 8 zinc, lead, silver, high priority deposits, and 4 gold reduced intrusion deposits. At MacPass, we're planning to drill approximately 12,000 meters. And as I said, we'll be focused on expanding known deposits at Tom, and primarily at Tom South and Boundary, and also regional targets, both polymetallic zinc and reduced intrusion gold. And finally, Gaina. Gaina is, the Lundins do not shy away from high potential, high impact exploration, and Gaina is an example of that. Gaina is located in the Northwest Territories, approximately 200 kilometers north of Mactung and MacPass. It was previously explored by Rio back in the time, but they were looking for horizontal style of deposit, and we reinterpreted the geology of this deposit and noticed that there's only 2 areas in the world right now that have this style of style of mineralization, of reef-style mineralization, as we call it. One of them is the Kipushi mine in the DRC, which has 36% zinc grade, just incredible zinc grades. And the other place in the world that has a similar geologic setting is Ghana. So again, we did a ton of work in 2023, 2024, doing ground-based gravity, airborne BTEM and LiDAR, soil sampling. We've identified the margins of these reefs, and we've identified coincident gravity highs with coincident high-grade soil sampling. And as you see there, we have a handful of targets which we are planning to explore this year. We are allocating 3,000 meters of our program this year to identify high-grade, potentially high-grade polymetallic zinc, lead, silver mineralization at Ghana. As a summary, this season will be quite comprehensive. We will be conducting a 12,000-meter campaign at Mac Pass, targeting extensions of known deposits, regional targets, and also for the very first time, reduced intrusion gold systems. 11,000 meters allocated for Mac Tang, mostly definition drilling for the purpose of fitting into a feasibility. And finally, 3,000 meters allocated to Ghana. Thank you very much.
Thank you, Alex. Now, please help me welcome Brian Penny, Chief Executive Officer, and Tanya Barreto, Director of Investor Relations of Wallbridge Mining, for a fireside chat with Ben Peary of Atrium Research.
Hello again. Thank you. All right, Brian, Tanya, thank you for being here today, and everyone else in the audience. So Brian, we only have 15 minutes. Maybe you can kick off with a quick sort of high-level company overview, and then we can get into some specific questions about the assets after that.
Okay, well, thank you very much, and thanks to the team behind the event for organizing a great conference again this year. We appreciate the hard work, and we've been here for 4 years, and virtually certain we're coming back next year. So a little bit about Wallbridge. Wallbridge is a explorer/developer that's been around for 25 years. We started off as a explorer in the Sudbury Basin, base metal assets in the Sudbury Basin. That went on for about 17 years, and then we acquired a position called Fenelon. It was about a 10.5 square kilometer property that we explored, and that was the initial discovery. We liked the area so much, we acquired a company called Balmoral Resources, which owned, most of the property we own today, subsequently disposed of the base metal assets. And we're really excited because we completed a PEA on Fenelon most recently. It was published on March 27th. The full tech report is on our website and filed under CEDAR and available. It focused on a smaller size operation than the last study, 3,000 tons a day, focusing on raising the cutoff grade to mine and process the highest margin tons. And looking forward on de-risking, the new study includes dry stack tailings. The new study focuses on paste backfill underground. At the end of the mine life, what little waste stockpile on surface winds up underground. It has a 16-year mine life. The annual production is 107,000 ounces of gold a year. In the first 5 years, it's 127,000 gold. And some of the summary economics at 2,200 gold, which was analyst consensus price when we went pens down on the pricing in February. of 2,200 US, and it has a 21% IRR and NPV of $750 million. But at $3,000 gold, the NPV goes up to 1.4 billion, and the internal rate of return goes up to 34%. And the exciting thing, I'm a financial guy, I'm a CPA by trade, is payback at $2,200 gold is 4 years, payback at $3,000 gold is 2.5 years. So, you know, nice mine life, attractive economics, which will help with project financing.
Well, great, and gold's already pushing well beyond 3,000. So Fenelon, great project, PEA recently announced. What are the next steps for Fenelon? I know you've got some studies ongoing, maybe you can talk about that.
Yeah, an excellent question, and thank you. Fenelon, you know, with the recent PEA, our next step is pre-fees. We believe that it's probably about 2 years to complete a pre-fees, but as we get into the details, we'll aggressively look at improving on those timelines. We have an infill drilling program that needs to be completed to upgrade the inferred to indicated and the indicated to measured. So that will be ongoing. The geo team led by Mark Peterson, and Mark is a great economic geologist. I worked with him for 11 years when I was at New Gold, and him and Mauro Bassuti, who is a consultant that's working with us. He was the reserve and resource guy at New Gold, so they're working on that to determine how many meters of infill drilling we're going to need, what is the cost of that. And then I've hired a group out of Sudbury called Mayhew Performance. They worked on the recent studies on the Porcupine assets for Discovery Silver. And so they are going to look at all of the studies that we have and what needs to be completed by, you know, to get us to pre-fees. And our goal is to have that in-house sometime this fall.
Right, great. So pivoting over to your secondary asset, which is, if I'm correct, connected along the same property to Fenelon, but this is Martiniere. It does have a resource on the project. Maybe you can talk about the status there, and I do understand you did have some news Monday afternoon that you want to talk about.
Yeah, no, thank you. Martiniere is about 30 kilometers away from Fenelon. You know, Fenelon and Martiniere are on the same trend on the Ontario side of the border as Canada's largest gold mine, Detour Lake. So from Fenelon to Detour Lake, as the crow flies, is about 70 kilometers. Martiniere is in between. Martiniere has a resource that adds up to about 750,000 ounces. About half of it's indicated and half of it's inferred. We had some recent drill results there because right now, until we figure out what we need to do to get to a pre-fees, we're focusing on drilling. Most of our drilling budget this year is focused on Martiniere. There are two phases, a phase 1 and a phase 2. Phase 1 is completed. Phase 2 will start in mid-July. We've released assays from 9 holes on phase 1. The news release went out Monday night, and spectacular grades. You know, one of the intersections was 17 grams over 10 meters. You know, we've had hits of 28 grams, 40 grams, 29 grams, 28 grams. So, you know, very, very attractive. And, you know, at the end of the day, we need to figure out a way on how we finance the pre-feasibility. And, you know, that's our prime directive. And does Martiniere come into play with this, looking for a partner or something like that? Yet to be determined.
Right, right. But so there's another about 2,500 meters worth of assays to come in this first phase, and then phase 2, based on the results from this phase 1 program, you'll determine what the plan is for that. But that's another roughly 7,500 meters of drilling.
What we've released, phase 1 is 7,500 meters. The whole year is 15 to 18,000 meters.
Right.
Of these 7,500 meters, about 6 holes remaining, and we will have those results out late June, early July. But it's following up on work that we did last year and some of the extensions that we had. And there was one hole that was drilled Nothing really exciting, but it was north of the Lac de Soil fault. And, nobody has ever drilled north of that fault. And it hit, 4 grams over 6 meters, including 7 grams over 3 meters. So kind of exciting as we piece this together. The difference between Fenelon and Martiniere, Fenelon's been around and explored since the early 80s. Historically, there's about 500,000 meters of drilling on Fenelon, and Martiniere is a little north of 150,000, so some catch-up work to do. Fenelon is in sediments, Martiniere is in volcanic, so a little bit different metallurgy.
Right, right. And again, it's nice to have two assets where as you develop Fenelon and there's not too much news flow in between, you can fill it in with some drilling from Martiniere. So let's talk about the team. What does the team look like right now? Maybe a little background on yourself.
Well, myself, my first senior role, I've been in this business for 40 years, so I could spend the last 6 minutes talking about what I did in my career, but that's in nobody's best interest. But my senior position was in 1993. I was the first CFO of Kinross from 93 to 2004. After I left Kinross, Randall Oliphant and myself got together. We took control of a junior called Western Goldfields. Western Goldfields owned the Mesquite mine in California. We financed it, got it into production, got off the bulletin board up to the TSX and onto the New York Stock Exchange alternate. So we went through a process of upgrading it, increasing our audience, and then we merged it into New Gold, which I became the CFO of New Gold and ran with that for 11 years. I was ready to retire, and a good friend of mine who was on the board of Wallbridge at the time said, we need some help on the financial side, so I joined that with a goal of, spending 5 years or so and then further retiring. But 2 years ago, the Mars Cord, the previous CEO, retired, and I was asked if I wanted to run with that, and I said, sure. So, seen a lot of projects, built projects. Western Goldfields was a screaming success, and looking forward to unlocking value for our shareholders for Wallbridge going forward.
Absolutely. And then with that, so I know we talked about the work that you're doing over the next 6 months or so. What is the cash balance, sort of balance sheet of the company right now? How far does that cash get you? A big question people like to ask is, do you need to raise money in the next 2-3 months?
We closed the first quarter with $16 million in the bank. We filed our tax returns early to claim our Quebec refundable tax credits. The claim was for $4.8 million, so we're expecting to receive that, at the latest sometime this fall, but hopefully a little bit sooner. And that gives enough money to take us into the first quarter of next year.
Great, great. And I imagine, depending on what gold continues to do, the stock price does start to wake up here. Might pull that trigger sooner rather than later, but nonetheless, what about the shareholder base? What does that look like right now?
Well, we have 3 large shareholders. Agnico Eagle, who has been a supporter for us over the years. Kirkland Lake did the first equity investment in Wallbridge. Subsequent to that, Agnico has participated pro rata to hold their interest at 9.9%. Eric Sprott owns about 15% of the shares through his numbered company, and William Day Construction, a contracting firm out of Sudbury, owns about 5%, and they've been longtime shareholders. They actually invested when the primary focus of New Gold was base metal exploration in the Sudbury Basin.
Great, great. And that did remind me, I'm not sure why, but Fenelon and Martiniere, maybe you can talk about the infrastructure just quickly, the location. Obviously, there could be some upside to the PEA based on possible power. Maybe you can talk about that.
Yeah, there is a road to the exploration site. It's a gravel road which is upgraded as part of this study. We upgraded the bridge last year because it was a little tired. So that infrastructure is in place. The Quebec power line, James Bay power line, runs about 27 kilometers south of the property. And so we have included in the study a power line to seek electrification. We've had on and off discussions with Hydro-Quebec in the past about the potential for electrification. So we're building the relationship, and the decision will be made once we have a feasibility study done at some point in future. But the current plan is based on LHD underground equipment. The prize here is the current rate that industrial customers pay is about 5.5 cents per kilowatt hour. And, with that successfully in hand, we would, really focus on electrifying as much of the underground fleet as possible. Helps with ventilation, it helps with, health and safety, everything.
Right.
It's the right thing to do.
Absolutely. So we're coming close to time, and I will get you involved in a second, Tanya, but I do like to summarize quickly with what investors can look out for over the next 6 months or so in terms of catalysts.
Well, the catalysts are the ongoing results from the exploration program at Martiniere. As I mentioned, phase 1, we should have the assays out late June, early July. Phase 2 starts July 15th. We will have a couple of news releases between now and when we shut down the operations in November sometime. The operations will actually shut down in October, but it'll take us a little while for the assay turnaround. We'll have some news flow when we collect the refundable tax credits, because that's pretty important. And, put ourselves in a position to announce what our next steps are as we talk about our plans for next year.
Right. Tanya, so just to finish off quickly, I know there might be some people that haven't had a chance to speak with the two of you in a one-on-one. How can people get a hold of you? Are you attending any other conferences? Tell us a bit about that.
Sure, yeah. So we're just wrapping up a pretty robust spring marketing and conference season, but we'll be at One-to-One in New York next week. We're based in Toronto, so we're always happy to take meetings locally or virtually, and contact information's on the website. So happy to fill or answer any questions or fill in any gaps with anyone.
Awesome. Thank the two of you.
Thank you.
Thank you.
Thank you, Brian, Tanya, and Ben. It's now my pleasure to welcome Matthew Zolonsky of Greyfriars, who will be moderating the Quebec Spotlight panel and the role it plays in global critical metals.
Good afternoon and welcome. We are your lunchtime entertainment. So please keep a little bit of the food left for us afterwards, just because we're coming right up on time. But that being said, I am delighted to welcome this distinguished panel, representatives from across the government of Quebec. In terms of our plan for this early afternoon, I'm going to have just a little bit of opening remarks. Then I'm going to hand it down to my colleagues here to introduce themselves and for a few minutes of opening remarks on their part. We'll then go into a guided Q&A session and then turn it over to the floor for any questions that you may have. So first and foremost, not to cast any aspersions on the other provinces of Canada. In my opinion, Quebec is far and away one of the most forward-leaning provinces when it comes to both supporting and advocating for their critical minerals projects in the United States and globally. Sometimes I would say even to the chagrin of our friends in Ottawa. Now, advocacy aside, that's very important. But the fact of the matter is that the province of Quebec offers a wide array of both financial incentives and non-financial incentives to support resource discovery, project development, mining, processing of critical minerals. Now, doing anything in the critical mineral space is very much a long-term undertaking. Even if you remove permitting from the equation, there's just simply no substitute for the amount of time it takes to engage with communities, with First Nations, to do your environmental baseline studies and to prove what it is that you have in the ground. So with that in mind, one of the tremendous value add that you find from the province of Quebec is a stable and predictable jurisdiction that ultimately enables that long-term planning by industry. So with that being said, I'm happy to turn over my colleagues to introduce themselves and some opening remarks. So.
Well, good afternoon, everyone. I hope you're enjoying the conference. Thank you, Joanne, for the organization. I'm Amio Chaquette. I'm Senior Director Investment at Investissement Québec. I've been involved in the mining industry for more than 20 years on the mine finance side of it. And basically, I'm in charge of the mining portfolio at Investissement Québec. And we're obviously looking to support projects within the province of Quebec. So I'll hand it on to my colleagues.
So hi everyone, I'm also from Invest Quebec on the international side, so Invest Quebec International. Basically, it's the role is regarding exporting technologies and services from Quebec to other regions, but also attracting investment. So I'm Senior Project Director for Minings and Metals on the FDI side at Invest Quebec International. So basically my background is less extensive than my colleague Emio, but I've been involved in the mining industry for the past 5 years, been in touch with the Quebec ecosystem on the mining side and all the Quebec technologies and expertise. And now I use it more on supporting the projects here in Quebec. So basically the support is more on helping the mining projects finding tools and incentives in Quebec, so connect them to programs, to ministries as well, making sure that they're known, their challenges are known as well, and we can support them overcoming those challenges they have. And one of them is surely financings as well. So I'm connected also to the Quebec delegation around the world. So we get in touch with a lot of potential partners for our mines as well, and I can be a key contact between potential investors and the Quebec projects as well. So, in a nutshell, that's basically my role at AQ.
Hi everyone. My name is Patrice Roy. I'm from the Ministry of Natural Resources and Forestry. I'm director for the geological information and promotion mainly of the critical minerals. I've been at the ministry for almost 25 years now. So, well, I'm at the base, I'm a geologist, so I know a lot about that field. But I also was the editor for the first critical mineral plan in Quebec, which was the first also in Canada. So.
Good afternoon, everyone. Thank you for the invitation. Joanne, congratulations for this great event. Fantastic. I'm Tony Brisson. I'm a geologist, president and CEO of SOQUEM, which is a subsidiary of Investissement Québec. I'm working in mining and exploration for the last 35 years, mostly in Abitibi, but also elsewhere in Canada and in Africa. So very happy to be here today.
Thank you very much, gentlemen. So to kick off the Q&A, so I'm sure that fairly everyone in the audience is familiar with the Lassonde curve, but just very briefly, it's a very basic graphic representation of the value of a mining enterprise over its life cycle. Starts out very low, then there's a rapid growth in valuation from its initial discovery, then projects descend into the purgatory of various feasibility studies, and then once those feasibility studies are complete and you're ready for an FID and construction, rapid growth once again in the value of the company as it transforms from a developer into a producing asset. Now, again, we talked a little bit before about all the various arms of the government of Quebec, or I'll say quasi-governmental organizations of the province of Quebec that offer an array of incentives for project developers. But that being said, the capital needs of an initial exploration company or a project developer or a project operator are very, very different. And similarly, the level of business and technical sophistication for those three different kinds of companies are also very different. And so with that in mind, rather than telling us what your individual organizations can do, although certainly, please be sure to do that, can you explain to the audience how a company actually transfers from one organization to another and those incentives grow and mature with the company as it also grows and matures?
Maybe I can start? Okay, so as an exploration company, we cover the entire exploration cycle from, let's say, the first portion of the Lassonde curve, so from project generation to economic studies, which is the easiest part, I would say. In the course of this exploration cycle, we often seek and find partners just to share the risk, the expenses, but also the expertise. The next phase of development essentially are generally managed and funded by the partner and the support of Investissement Québec also. So that's where they start to work in the next cycle, the other one.
And if I may continue, while SOQUEM is working to have a leverage in exploration, we also support at that stage. We will acquire and make information on the geology available through our CGM database. CGM is recognized as one of the best database on geology in the world, so that's a great asset we have in Quebec. We also offer tax credits throughout the mining development chain. It begins at the exploration stage, and since we launched the critical mineral plan, we also have tax credit for the development stage, which is, in the Lassonde curve is maybe the critical part. Also, we also have a flow-through share regime, which is a federal and provincial part on that regime that applies for exploration and development. And aside from that, we also offer various subsidies for mining companies. It begins with a program to support mineral exploration for critical and strategic mineral. We know that critical and strategic minerals are often more complex ores than we see for gold and base metal, and we don't know as much as about those ores, so it's important to have a better understanding at the exploration phase. And we also have other programs, and we know that it's a challenge for the critical mineral project, all the processing and all the processing of the minerals. So we have programs to support processing, to support also the scaling up of those processes. And that includes not only mined ore, but also recycling and utilizing the industrial waste from production, where we can sometimes get some metals that are in lesser quantities, like those used in semiconductors.
So, as Tony mentioned, I guess in the Lassonde curve, I guess there's the development stage. Once a company issues a PEA, that's where Investissement Québec can start supporting projects. But before and during that same cycle, There are other financial institutions in Quebec that can provide financing as well. There's SIDEX. I think Andre is, I don't know if he's in the room here, but he is at the conference. There's as well NQ Mining Investment. Sylvain is here as well. And there's the CDPQ and Fonds de Solidarité des Travailleurs du Québec that can provide financing for projects. At Investissement Québec, my role and my team's role is to support mining projects through the development phase, which some call sometimes a dead valley, but in the Lassonde curve. But that's where the government decided to support projects, obviously because there's some challenges to raise capital at that level. So we can support projects from PEA until construction. And that's our role. We can support projects through equity investments and debt financing when we're close to cash flow generation. There's another government entity that is present here, my colleagues from Société du Plan Nord. The Société du Plan Nord can provide financial assistance to develop the infrastructure of mining projects and other projects on the Northern Territory. We all work in conjunction with the Ministry of Natural Resources and SOCAM as well to help all these projects progress through the Lassonde curve. And obviously, to mitigate risk, we never invest alone. So we want to invest with other partners, strategic partners, more and more, with especially in the critical and strategic minerals, because as Patrice mentioned, there are some additional risks that all of the processing and metallurgy it's done. The expertise is developing in Quebec, but it lies overseas as well. So that's how we can support the mining projects. And then my colleague.
Yeah, and that's where I can come in to support those projects, is depending on the stage of the mining project is at. Obviously, there's financing. There's less big of a financing earlier stage, but when we're near construction phase, we need a solid strategic partner to eat that big chunk of investment. And obviously, if IQ want to come in or other partners in the Quebec ecosystem, it sure add a lot of credibility if we have a strategic partner, a company with transformation expertise, processing, or simply a company that can be a big off-taker or client at some point. So I think it's always a win-win or a dance between the IQ financing side and the international one, when we can support each other. Because even for strategic partners to know that there's support from the Quebec government at the same time, it eases the relationship and it comforts both sides. So that's the way we see it on our side.
No, thank you, gentlemen. Now, perhaps showing my age a little bit, when I first started coming into what I'll call the critical minerals or the critical materials world in the mid-2000s, at least in the United States, the discussion around critical materials was talking about titanium and steel. Then towards the end of the decade, 2009 to 2012, the story was rare earth elements. As the prices for rare earths cratered, those went away. And then through the middle and certainly in more recent past, the story of critical minerals is effectively synonymous with the battery sector. So lithium, nickel, cobalt, graphite, phosphate, etc. And it seems that just in the past 6 months, we've almost come full circle again. We're talking about rare earths, we're talking about steel, we're talking about aluminum, and a little bit less so about battery materials. So now on the one hand, I'd submit that this is just a reflection of the junior mining market, where to some extent your ability to survive as a company is your ability to raise finance and to demonstrate that you're relevant to whatever is the hot topic of the day. But that being said, all of you on the panel here are either governmental organizations or quasi-governmental organizations that, strictly speaking, don't need to turn a profit in the same way that a mining developer has to do on a quarter-over-quarter basis. And so with that in mind, what I wanted to tee up for the panel to discuss is how you've experienced either success or setbacks in maintaining that kind of consistent demand signal to industry, or in some cases, a counter-cyclical demand signal to industry on those things that are priorities for the province to develop, number one. And then number two is where there may have been, setbacks in the past. What are those things that you think you could improve on the going forward?
Maybe I can start again. I'm going to leave the setbacks to Amio. So just speaking about a little bit of a story of SOQUEM. So we were created 60 years ago to create wealth for the Quebec province. At the time, there was only iron, gold, and copper mines in production. So quickly, SOQUEM developed a salt deposit, niobium deposit, which was pretty unusual at the time. So speaking about more recent initiative that SOQUEM bring up to an advanced level, early 2000, we just started to work on a lithium project called the Mont Blanc project, which was not the flavor of the month at this time, okay? And we developed it until we find a partner in 2010, bring it up to feasibility study prior to leave it to Investissement Québec. So this is an example of innovation. So we were in advance in our time. Another element that we work on was a rare earth project called the Quijibo project. It was discovered in the early 90s. We started to work on it until 2010 when we find a partner and advance it to PEA. And then that's another type of initiative without paying attention necessarily to the cycles, So you need to be innovative. You always need to be in advance of what would be the next commodity that will be used in electronics, energy, medical equipment, aeronautics, or whatever. So we need to be always aware of, via scientific papers and stuff like this, of what would be the next thing. Considering the fact that we have a stable and recurrent financing from Investissement Québec, we are definitely less sensitive than the average exploration company to mining cycle and flavor of the month commodities.
Maybe
you want. I can go because you mentioned that I will handle the setbacks topic.
Or room for improvement, that also works too.
No, exactly. So, I guess I've been, like I mentioned earlier, I've been involved in mining for more than 20 years. Obviously, in the last 20 years, there's been a number of different parties at the government. So I think 3 different parties were in power since in the last 3 years. Some came back, some new parties emerged, but at the end, all the political parties are supportive of mining. Investissement Québec has been involved in mining for more than 20 years before I joined, and prior to joining Investissement Québec, I was another government institution that invested in mining as well. So we've been supportive of mining. The Quebec government, SOQUEM was, as you mentioned, was created 60 years ago. So I think through the cycles, one thing that the mining industry can say is Quebec is supportive of mining, and we foresee that going forward as well. As to setbacks, and I think our programs are, tailored for the mining industry, but obviously there's some cycles in different metals, different minerals. So of course we've lived through setbacks. I guess there are probably 2 examples that can show how the government is supportive. Is One, when the iron ore industry struggled in 2014-15, we partnered with Champion Iron to buy the Bloom Lake mine. It was I guess, we bought it from Cliffs Natural Resources that was on court protection at that time. We reinvested, co-invested with Champion and restarted the mine, and now it's a success. They implemented their phase 2, and they still have other projects to improve the quality of their iron ore. So that's one setback that was a success. Another one is Nemaska Lithium. We invested in the Nemaska Lithium 1.0. At that time, the market wasn't so good, and I guess the company had faced, I guess, cost overruns and needed additional capital, but the markets weren't there at that time. So we decided to partner with Livent and a private equity firm from UK to buy back the assets and reinvest in the project. That Livent became Arcadium Lithium. Now it's Rio Tinto. So I think that's a testament to, I guess, the support that the government of Quebec wants to give to the mining industry. We've lived through other setbacks that didn't turn out as good as these two projects, but we're there to support. Obviously, I guess the business case has to make sense, has to bring economic benefits for the province of Quebec. If we can learn from the past, I guess errors or mistakes, is that today we, as much as possible, not always possible, but as much as possible, we want to partner with strategic investors that have deep pockets and knowledge. So our partnership with Livent and Nemaska Lithium was I guess, a consequence of the first setback. And with Champion was a junior company at that time, but the management had a track record, so at least they proved that they can build a project and make it profitable. So I would say from my side, that's my side of the story.
One thing I can say that Amio mentioned, and that's, I think, one of the key factors is stability in Quebec. You mentioned it with the experience, and I just learned that you've been on the ministry for the past 25 years. So the fact that the mining faces of Quebec are known, and you go to PDAC, and I've been going to PDAC for the past 5 years, and this guy is probably the most wanted guy on the show floor. So that says a lot. And on the other side, I think the promotion team that Patrice is leading with John Lafontaine, I think he was in the room, and Jocelyn as well, like being out there for the past 5 years, I think. Like you've been to IMARC, you've been all across the world promoting Quebec, and I think it shows and it pays. You have the numbers, I guess, on the level of exploration, that the investment exploration that was increasing in the past years. And what I can say on the export side as well, I've been involved in the mining technologies in Quebec, so I was supporting Quebec expertise, finding clients in the US and the rest of Canada. And one thing I was always surprised, like visiting companies in Arizona, in British Columbia, and my colleagues from South America and Africa as well, is there's always someone from Quebec on the board, as executive management, could be on director of anything in the mine itself, drillers. So Quebec is always out there. So I think that expertise that is known around the world is also making Quebec a great jurisdiction for investments as well, because people are seeing all the expertise around the world as well. So.
I would add to all of that, well, of course, as a province, we can't influence the markets, so we have to do with the market, with not China, where we can influence the pricing. However, we also have one of the most diversified production in terms of commodities in Canada, and I think that's a strength we have in Quebec. Amio talked more about the mining development and the most advanced project, but for exploration, well, we offer the tax credit. The advantage of the tax credit is you get it after the work is done, so it can extend a bit into the lower cycle and help you go through it. But we also have other investors like Amio mentioned earlier, Sidex or NQ Investment, that comes into play and can also help in those periods. And we did in the past, there were some specific programs to help companies go through these cycles. But I think an important thing is, well, as we said earlier, we have to see the next, you called it the shiny object of the day, what will be the next shiny object of the day, but you have to be ready when the time comes again and have projects ready. So it's how you manage to leverage one of those periods for the next one coming also, if you have not profited from the first one. And well, we can, for example, take the example of lithium in Quebec. 5 years ago, there were 3-4 known major projects in Quebec. Now I think it's 8 projects. So we had some projects that progressed really well during the last peak of lithium. And these projects are still advancing right now because they are developed enough that people are still thinking that when the market will go up again, but these projects can be opportunities. So we have to work in that sense. Also, if I look at on the mining side, when you're already in exploitation and the price of the metals is going down, well, the taxes are also going down because they're based on the metal price. So that can also help to go through these periods. Yeah.
Well, thank you, gentlemen. So certainly for all of you on the panel and for the rest of us in the audience, we've been to dozens of mining conferences during the year and over the course of several years. But one of the topics that seems to be discussed relatively infrequently on panel discussions like this is the concept of risk tolerance. On the other hand, certainly when I talk to folks in the junior community, risk tolerance is something that comes up all the time. Now, I do want to be a little bit even-handed about how we talk about risk tolerance because we have lots of different stakeholders on the panel, and so if you are engaging in small-scale R&D, contracting activities, that's going to be one very different level of risk tolerance compared to a project finance, for example. And so with that in mind, I have kind of a twofold question. So the first one is, based on where your organizations sit, what is your baseline level of risk tolerance simply because you are investing in critical minerals or metals and mining in general, knowing that metals and mining is not the same as automotive, commercial aerospace, or the next killer app, for lack of a better way of putting it. And then the second is, as you look within the critical mineral space, what are those elements that raise or lower your risk tolerance when you are looking at a project? So, for example, is it commodity-based if it's something related to a base metals project, or is it related to whether you have a strategic investor in the project? So first, baseline level of risk tolerance, and then second, what makes that tolerance go up and down?
I can start again.
Okay, go ahead.
In our side, I mean, the risk tolerance is mostly associated with partners considering stable recurrent financing, or as I said, less sensitive to market fluctuation. So in that sense, we can work on a specific commodity for a long-term view. As far as our sole shareholders support us, which is the case since the last 60 years, it's going well. When you arrive with a partner, they are more sensitive to this kind of fluctuation, financing, and stuff like this. So more often, it happens that you finish your project with a sleeping partner, which is not very good for the development of an advancement of a specific project. And I mean, other than this, you can certainly go and find a specific commodity without having any markets. That's the other thing that you have to think about. Is there anything you can do with it? And other than this, we are not that exposed to the risk on our side.
If I look on the governmental standpoint, well, we have tax credit and subsidies. So if we look at the tax credit first, well, the tax credit, to get your tax credit, you've got to do eligible work that will give you access to the tax credit. So you may have to prove what you did and how, and then you will get your tax credit. So that's one way of mitigating the risk. If there's no work, there's no credit. And normally, if there is work, well, we will have more knowledge on the mineral potential. That's the first. And for the subsidies, well, normally the program have a certain scope. So we will look if the projects that are applying, are they in the scope of this program? Will they bring results that will make the project go forward, and other similar projects also go forward? And what basically is the quality of the project on science base? And so we will we'll have committee with experts that will also check if the science is sound behind that project. So.
From our side, I would say the risk tolerance hasn't really moved because we're now investing in critical and strategic minerals. It's about the same, and it's a balance between, I guess, economic benefits as well for the province of Quebec and the amount of the investment we want to invest in a project. Obviously, critical minerals or projects today come more often with a component on conversion transformation. So mining companies don't have necessarily that expertise. So some want to develop that expertise in-house, and others want to partner with other, I guess, companies that have that knowledge. So obviously, I mentioned earlier, but having strategic partners that know the conversion transformation business coming into a mining project is a plus for us. But one thing I think I mentioned earlier, we never invest alone, so we want the private sector to put money into projects. So so the risk tolerance is it's a balance. Like I said, it's a balance between economic benefits and obviously development of a new industry is. Maybe we're taking a little bit more risk at the end, but you know, the private sector is taking the same risk. So, but it's to mitigate that. Like I said, strategic partners, quality of management. Obviously, in any project doesn't really impact the risk tolerance. But as a government institution, we're looking for social acceptability of any project, whether in critical minerals or gold or whatever base metals. But So yeah, basically that's what we said. I don't know, Jeremy, do you have anything to add on your side? But, no.
Maybe one thing I can add is, and it goes back to the last question on setbacks and how we can prevent them, is to, and since I'm more connected to market and application of those commodities to market, is to be more proactive on what's the next shiny object, like you mentioned. So having convey more studies on what's next and where is next. So and be more have more knowledge on what are the next application for the commodities, and with that in mind, we can definitely ease the risk on projects as well, and yeah. So that's what I would say, because I'm not involved in financing directly.
So to pull on this just a little bit further as a follow-up to all of you, because it's come a little bit from Patrice and Tony, but to pull on a little more, one of the specific risks that often comes up with critical minerals projects is just general opacity of pricing, in large part because in many cases, the single largest market for many critical minerals is the Chinese market. And sometimes they're the largest producer simultaneously. And so as you think about, for example, a copper project or a base metals project versus, say, a rare earth project, or arguably even a lithium project, can you talk about how you've tried to address some of those challenges around how do I establish the cash flows that this project is going to generate, or is this worth pursuing if the lithium price is here as opposed to 10% of whatever it is today? So you don't necessarily have to have an answer, but can you walk us through the kind of the thought process of how you address that kind of a challenge when we don't really have a lot of good mechanism to understand what the actual value of the commodity is?
Yeah, well, I guess we're long-term investors, so obviously there's some challenges when the price fluctuates on a short-term basis. But we look at over a long-term period. But obviously, if there's a downturn on a short-term basis, the project needs the capital to support, I guess, the deficit of cash flows for at some point. So I'm coming back again to the strategic partners that have deep pockets. That's what we're trying to have in our mining projects. In lithium, graphite or others, we see now, I guess, well, maybe less in lithium today, but OEMs are still interested in securing supplies. So some of them are willing to sign agreements, with some floor prices or other mechanism that can help the project go forward and be able to raise project financing, and the banks will require that, and they have to get comfortable with the projected cash flows. So and we have a similar thought as well. So but it's some cycles are more challenging than others, and especially in critical and strategic minerals, it's all mostly based on offtake agreements and less, the spot market. There are some spot market, but it's not a big of a. It's not like gold. You know what price you're selling, or nickel. There's always the LME, and same for copper. So yeah.
Okay. Tony?
Yeah, maybe I want to fly on this question also. One aspect is, as a Canadian, we have pretty good experience in mining, okay, but also in the primary transformation. Let's speak about gold, copper, zinc, base metal, whatever. We have very good experienced people. when you speak about rare earth lithium, well, the real expertise is not in Canada, as you know. So that's where strategic partners are very important to help us to bring this expertise here. And we're still in the learning curve in some of these commodities to bring it up to the final client, you know. So that's something that you have to pay attention to. So.
Okay, so I have two more questions I want to get after, and then we'll hand it over to the audience for any questions that they have. So the first one is about strategic partnerships. First and foremost, I don't know if I should apologize or not, being the American asking about opportunities for international collaboration on critical minerals, but I'm going to go after it anyways. Certainly, even through the first Trump administration and through the Biden administration, there was significant growth and certainly cross-border collaboration on critical minerals projects. And certainly the province of Quebec has always looked for international partnerships to develop the assets that are here in the province, be it from the United States, East Asia, or even European member states. So with that in mind, from your respective organizations, to what extent has your approach to international collaboration and international partnerships changed since January of 2025? Or alternatively, is the strategy fundamentally the same as just simply the dancing partners on the other part of your activities has simply changed?
Well, I can begin on that one. Well, our strategy is basically the same, no significant change. Of course, well, with the situation in the US, we are more cautious with our approach, but of course, the US it's our neighbor, so we want to do business with the US for sure. But we were also already active, as we said earlier, in the rest of the world to have partnerships with Europe, with Eastern Asia, Australia, and other jurisdictions. We signed 2 agreements, one with France in 2024, I think, and one with in 2020, yeah. And this year we signed another agreement with the Netherlands on collaboration on the critical mineral development. So we are already doing business with other jurisdictions. There may be more interest now with the political situation, which also affect those jurisdictions. So for us, we continue in the same direction, and hopefully it will bring us more new opportunities that weren't there before.
Yeah, but maybe the government in 2019, 2020 launched a battery initiative. So you saw Bécancour, there are a number of investments that were made. The expertise in the battery sector comes from Asia, so that naturally the initial partnerships that were made were with a component of Asian companies and sometimes in joint ventures with car makers. So I think the strategy remains the same. The dancing partners can change from time to time, but I guess today what we're facing is hopefully a short-term situation, and over the long term, we can all find, I guess, agreements that will be satisfactory for each country. But at the end, we're facing this in the mining industry, but it's other industries in the economy of Quebec that is facing the same problem. So the government has put in place some initiative to help companies export to other markets, and so I guess that's maybe what is changing right now. But I guess the U.S. will still remain a close partner because we're neighbors, and it's easier to do business with your neighbor than if you have to go through Europe or Asia. So.
I think one thing I can say about that is the countries are seeing the relationship between the U.S. and Canada from a distance, and what that came out of it is it's spiking an interest from them to see like, are you still working with the U.S. because we would be happy to work with you. So that's what I'm seeing is like they're scratching more to get information from us and seeing, are you interested in working with us and like changing the flow of the feed that was probably supposed to go to the U.S. And now there's potential partners that are not on the traditional scheme of things.
So a rapid fire question for the panel, and then we'll open up to the floor for any questions. And so this has come up through a couple of the different responses in the course of our conversation, and that's the idea of looking forward to whatever is either the next technology or the next shiny object or whatever it is we want to call it. And so with that in mind, certainly battery materials has consumed a lot of our time and energy over the past 4 years, but just kind of going down the panel, start this way, and then we'll go to the audience. What is your, say, on the horizon critical mineral that you're focused on that could be the next thing that we should be paying attention to?
Well, as for the critical minerals itself, it's difficult to mention, but I would say aerospace, energy, renewable energy are definitely, and defense are probably the three sectors that, that are on our radar today that, can support the demand for critical and other minerals. So that's my view on it. Pass it on to you.
you said most of the good answers. What I can say is maybe the idea of the battery shift a bit toward storage as well, and it's way more important in the discussion. And from what we're seeing in Quebec with the scarcity of energy, so those kind of battery system will be more and more needed in our industry. So I think it's getting a lot of traction. So that would be something I would add.
Okay. Well, if I could add, base metals, specifically copper. Copper is one of the metals where we're struggling to maintain world reserve. So certainly that copper is a metal to look at in the future. Yeah.
I would be bullish to say uranium. We have uranium in Quebec, but we don't exploit it, and there is potential. Eventually, we have to open our mind to this type of energy, very efficient.
All right, so we have about 5 minutes remaining. We have a couple of microphones set up in the room. So does anybody want to ask a couple of questions of our panelists? Otherwise, we'll cut them all loose so we can get some food in them. No questions. You're
there's one at microphone number 3.
Yeah, far away.
Good afternoon. I have 2 questions, 2 separate, considering critical minerals. Graphite. You have Masson, LLG, hasn't lifted off, great resource. And the second question I have is Sherritt. If you Google nickel resources, largest in the world, Cuba doesn't even pop up. But if you know the answer and you Google it, you realize it has over 5 million ounces of nickel reserves. What's up with that? I don't understand it. You have to know the answer to get the results.
Yeah, I had trouble hearing your questions. Can you repeat the first one at least?
Closer to the mic, maybe.
It's both about critical resources. First one is graphite. Masson is a great resource, hasn't lifted off. It's pretty well at the bottom of its chart. It was evolving, and now it's like almost like dead in the water. My second question is about nickel, which is another critical resource. My question is, I Google a lot, I look it up a lot because natural resources is my passion. And if you Google the biggest resources in the world, Cuba doesn't even show up. You have Canada only has 2 million ounces. Cuba has over 5 million. And it doesn't show. But if you know the answer, and because I follow Share It, you end up with over 5 million ounces. So it's kind of strange to me. So maybe you have an answer for that.
Well, I can maybe answer your first question. When you talk about Mason, you're talking about Mason Resources?
Yeah.
So,
yes.
So this project, well, it was I guess, under Mason Graphite a few years ago, but now it's owned by Newfoundland Graphite. So the Newfoundland Graphite has, obviously, they're focusing today on the Matawini mine and their battery anode material plants in Bécancour. So they're looking to raise the project financing to start this project. So once this project is started, I don't want to speak for them, but once this project is started, they want to develop the old Mason project, La Guéret. Now it's known as Watnan project. And one of the requests from their stakeholders, Panasonic and GM, is for them to have a further supply of graphite above the mine life of the Matawini mine. So that's why they bought that asset. So the plan over the long term is to develop that project. But obviously the Matawini mine is the first step. But as for nickel, I don't know if you want to answer that question, but
I don't know. I didn't understand the question, so.
It's related to supplies of nickel from Cuba and why it doesn't appear on a lot of research reports.
Oh, in Cuba, okay.
Yeah.
It's a good question. I think we have the same question, but obviously the government in place might have an impact on that, but
okay. Well, thank you very much.
Well, in Quebec, I guess there's two mines in operations. There's and there's the Dumont Nickel project that is looking to raise project financing as well. So within Quebec, well, Glencore owns the Raglan mine, and Canadian Royalties the Nunavik nickel mine. So these two projects are in operation, and like I said, Dumont Nickel, they're looking to develop or build the project within the next year. I don't know on the exploration property
there are
side.
some other exploration projects with a lot of potential, and about Raglan and Nunavik nickel, actually these are not mines but mine complexes, so there are many deposits. There are still new deposits being discovered, defined, so there's still a lot of potential too in these trends. So, so we don't have a complete image of all the reserves that are in Quebec. We're still discovering, we're still advancing new projects in nickel. A lot of very interesting discoveries recently for nickel. Maybe Tony, you could add on that.
Yeah, just 2 years ago, we discovered a new nickel deposit between Chibougamau and Lac Saint-Jean, which shows very good potential to advance. There's some decent PGM associated with. And what I see actually is the James Bay area, the USG area, will begin to be a new nickel district. When you look at the power metal deposit, for example, and I mean, the potential is huge and remain to be exposed in the near future, hopefully.
Well, ladies and gentlemen, thank you for listening to our panel. To give our panelists
Is there a question at mic number 1?
Oh, just if it's a quick question, go ahead.
Yeah, quick question. I think everyone here agrees that Quebec is a great jurisdiction, but a lot of people were really caught by surprise when the last federal budget, or rather Quebec budget, made significant changes to the flow-through share rules, taking away a couple of enhanced deductions that had been available and making some other changes that could particularly impact those looking for metals and minerals other than critical minerals. Do you have any comment on that?
10 seconds, go.
I don't have any comments. I'll leave it to the Ministry of Natural
Yeah,
Resources.
regarding the I think it reflects the what the governments wants to put more emphasis on the development of critical minerals. So that's why the credits are higher, and it also reflects what was done at the federal level of the government, but there are still credits for other commodities, which is mainly gold, I think, that is not covered with the critical mineral tax credit. So that's why they adjusted these credits. That remains, I think, among the most advantageous in the country and probably in the world right now.
All right. Thank you again, ladies and gentlemen, and that is it for our panel this afternoon. Get a quick round of applause and we'll be on our way. Yep.
Good afternoon, everyone. My name is Ibrahim Chandra. I'm an analyst at IBK Capital Corp. So I'm going to give a little brief introduction before our panelists come up. So IBK Capital Corp is a boutique investment bank based in Toronto. Since our inception in 1989, we've been successful in raising over $5 billion for our clients. Some of our success stories include Canada Nickel, Great Bear Resources, which was acquired by Kinross in 2022. So my time with IBK began in 2022 as a summer analyst, where I had the opportunity to attend this conference for the first time. And now I'm back here as a panelist, so I'm very pleased to be here. So I'm going to introduce our first session. So our first session, please help me welcome Troy Boisjoli, Chief Executive Officer of Atha Energy Corp, for a fireside chat with Matt Gordon of Crux Investor.
Fourth seat? Hey guys, hi. We're going to talk uranium, the nuclear fuel cycle. So, Troy, well, you better tell them a little bit about yourself and the company, and then we'll kind of dive into some questions.
Yeah, you bet. Atha Energy, relatively new, listed in 2023, large-scale uranium exploration company. When I say large-scale, we have the highest degree of exploration exposure in terms of exploration projects across the Athabasca Basin, the Thelon Basin, the Anjikuni Basin, and the Central Mineral Belt in Labrador. We grew materially in the last year through acquisition. We acquired Latitude Uranium and 92 Energy in a three-way transaction, which closed last year, and that brought our flagship project into our portfolio, which is the Angulac project.
Right, and don't be shy. Where were you working before this?
Yeah, as you know, Matt, I've been in the uranium space for a long time. Came up through Cameco Corporation, exploration geologist there. Spent time in operations as a chief geologist at one of their operating mines. After that, had the opportunity to join NextGen Energy and help develop the Rook I project from maiden resource right through to feasibility as Vice President, Project Development, Operations, Exploration, and Community, which is a bit of a mouthful, but we were growing rapidly at that time.
Right, okay. So that's the background. Let's talk about the setup for uranium and nuclear. Executive orders flying off the shelf with your neighbors. That's got to help.
Yeah, it's excellent. That's off a backdrop of a uranium sector right now that is unlike we've ever seen it in this generation. I think you have to go back probably to the early 70s and the initial adoption of civil nuclear energy across the US, Western Europe, to see demand growth like we're seeing right now in the nuclear energy space. That was pre-10 days ago executive orders. Now you layer on the executive orders on top of that, and you have the largest nuclear market in the world that's talking about and committing to quadrupling of nuclear power domestically and abroad within the US. That's going from 50 million pounds on average, that's the demand of the US, 50 million pounds per annum, to 200 million pounds. That's substantial, considering the entire uranium market right now is about 195.
Right, and it gets worse because there's a bifurcation in the marketplace, right?
Yeah.
So maybe explain to people what's happening, east-west divides, etc.
Yeah, breaking down where uranium is produced globally. Kazakhstan is the largest uranium producer. About 40% of uranium supply comes out of Kazakhstan. There's been the emergence of a bifurcation in the uranium market over the last 3 to 4 years, which is materializing and solidifying now. What we see now is that about 85% of the Kazakh production is earmarked for China and Russia. You then look across some of the African projects. Niger, obviously, a difficult time right there geopolitically currently, into Namibian assets, kind of parceled off, offtake agreements, et cetera, going to China. That leaves, a growth profile that's growing in the U.S., needing to look domestically, and when I say domestically, within the North American sphere, for that fuel supply chain, because as it sits right now, it can't be satisfied in the U.S. I think even with significant continued investment in the U.S., they still won't be able to meet the actual demand that they're building. They produce around 1 million pounds of uranium right now, plus or minus, consume 50, projected to go to 200, and peak of the last cycle, I think they produced about 6 million pounds per annum.
They need some friends.
They need some uranium.
They need some uranium.
Yeah.
Right, okay, so I think the picture we're building up here is there's a definite supply issue. The demand, if it stopped today, if we had no more demand than is on the table today, we couldn't supply that.
That's right.
Right? Yeah. So, and it is continuing to grow, and we perhaps we'll stay away from the demand story because it's kind of baked into this conversation. Yep. The supply has got to come from Western sources. There isn't enough.
There's not enough.
Discovery, let alone pounds in the ground today. So what are we going to do?
Yeah, that's not unique to uranium, but I think probably amplified in uranium. We haven't had sustained influx of risk capital into exploration sector, et cetera, for a decade or longer. As a function of that, you look at the project pipeline in uranium, and it's very, very linear and it's very narrow. Okay, so you've got a few development stage assets that are moving forward. Underneath that, there is not a resource base to backfill those. There just isn't. There's not that pyramid of projects. So exploration, development, discovery needs to happen. It needs to happen in earnest. We're in an absolute structural supply deficit, and that's only going to get solved through continued investment in exploration and discovery, especially in geopolitically favorable environments to feed this growing market. That's ATHA's thesis. That's what we're built around. That's why we have the largest land position, exploration projects, over 17 projects across the best uranium jurisdiction in the world, which is the Athabasca. Sister basin to the north, the Thelon Basin in Nunavut. Very highly underexplored uranium jurisdiction in Canada. Right in between that is the Anjikuni Basin, and that's where our Angulac project is. And that's where we've been working over the last year. It has a historic resource of 43 million pounds, 0.69% U3O8. contextualizing that, with Cameco as the chief geologist at Eagle Point, the grade of that deposit is 0.7. Okay, so for those that aren't familiar with uranium grades, 0.69 is a good grade. It's high-grade uranium. We like the framework of the story. Last year we stepped out, did 10,000 meters of drilling, 25 holes, intersected mineralization on every hole, expanded the footprint of mineralization there materially, and did a bunch of generative stage exploration work as well. And that all sets the stage for where we're at right now, which is, as of this morning, we're back drilling.
Okay, and so how do you move towards the end game? So you've got a historic resource, significant size, I mean globally significant, not just for Canada. And you've got to you've got to chase more pounds for start.
Absolutely.
So how do you go about doing that in an environment like this where money's so hard to come by for juniors?
Yeah, it seems to be a common theme. I think it's interesting at ATHA because we came to market in 2023. We've raised over $70 million into the deal. I've got a colleague sitting over there that's on his phone right now, but
taking notes.
Yeah, he's on the capital market side. We've got a good combination of a highly experienced technical team and good capital market strength. And there is money out there for good projects. Right, and good opportunities. I look within the Canadian uranium landscape and outside of the producers and nearing those groups nearing production, there are really two companies that are working on actual deposits, and so it's very narrow, Matt. And so the appetite. Everyone understands the macro. When I say everyone, there's a growing awareness of the macro. There is a growing awareness of the opportunity within the uranium space. That trailed off and fell off late 2023 throughout 2024, correlated to the spot price. But spot price kind of found a bottom, I think, right? About 63 bucks a pound, came through 70. Sentiment is changing, etc. But to your point, how do you go from here to where we need to go? Expansion work. The drilling that we're doing right now, started the drill today about expansion around the deposit, the LAC 50 deposit. Last year, on the ground, boots on the ground, 3 kilometer long outcrop right at the edge of the deposit. 47% mineralization on surface and outcrop samples that hasn't been drilled. That'll be a key target area, obviously, naturally. And then this whole system sits right at the edge of a very large sandstone basin that's completely unexplored, not underexplored, it's unexplored. We did a bunch of fundamental work last year, geophysics, geochem, structural modeling, etc., to find a 31 kilometer long trend across the basin, high grade mineralization on one side in historic core, about 5.5%, 31 kilometers away as the structure trends through the other side of the basin, 30% in outcrop, high grade unconformity style targets within a completely unexplored uranium jurisdiction. We like it a lot. Our technical team's view is that it's analogous to exploring in the eastern Athabasca Basin in 1960, prior to the discovery of Rabbit Lake, Key Lake, etc.
So, it sounds like you feel there's a lot there, and I want to get to it, but I also want people to understand the kind of commercial imperative for you, right? So, if I look at the gold space at the moment, got developers who are saying, do you know what, at these sorts of prices, I'm incentivized to get into production earlier. I'll start with a small starter package, and we'll build it from there, get some revenue flowing. How does it work in the world of uranium? You've worked at Cameco, you've worked at NextGen. How does uranium compare to gold, and how does that drive your ambition with regards to the scale you need to demonstrate to trying to drive those economics?
Yeah, I consider, just pulling this back to uranium specific, okay? We look at, I look at anything around 100 million pounds at the grades that we're seeing as a tier 1 asset, tier 1 uranium asset. And that's kind of the lens we view this through. The work that we've done to date From an exploration potential perspective, gives us a direct line of sight to the scale that we're after. That's within the deposit.
LAC 50.
That's LAC 50. That's within the deposit
Not
area.
the other 16.
Yeah, then you go across the basin, and we're talking about an area that we believe has multiple discovery potential.
Right.
Discovery of multiple deposits.
But
based
how
on
do
the targets we
you,
built
but
up.
again, an environment like this, certainty versus expectation, right?
Yeah.
So does that shape the allocation of capital?
Exactly, and that's what it is about. It's about making decisions on how you allocate capital in a risk-adjusted approach. Okay, high probability expansion work around the deposit, high probability of outcome there. The forcing function we believe for growth there is work. We've de-risked it significantly with the drilling that we've done to date, with the work that we've done to date within the LAC 50 deposit area, and then call it the torque, right? Like that we're explorationists as well, and get excited about drilling exploration targets.
Okay.
The opportunity to drill an exploration target in a basin that hasn't been tested, that has the setup that we're seeing, the geophysical signature that we're seeing, the structural signature that we're seeing, 30% mineralization in outcrop in the sandstone sitting above these targets. It's really, really compelling. So that'll be the mix.
Let's convert that into actionable activity from you. So you've got this 10,000 meter drill program?
10,000 meters, yes.
So 2 drills. So talk to me about how data flows into decision making with that example.
Yeah, 2 objectives. Expansion at the deposit area, discovery focus with the other drill. We aren't going to get pinned down on allocation of meters in one area or the other because of a dynamic, we built up a process. I've implemented it at a couple places. Get data from the drills, feeds right back into live dynamic models. That allows you to make real decisions in real time in the field on how you're allocating capital. Okay, so we go into these targets. We hit Athabasca-style mineralization at KU, the target we're about to drill. We're obviously going to allocate more meters there, right? Base case, continue to expand at LAC 50. So 10,000 meters, those will be allocated throughout the course of the program.
Okay. I guess final words, your hope for the sector, because we need more companies like you to do what you're doing, to find these pounds in the ground. They're struggling to access capital. They're struggling to make the discoveries, therefore, and it kind of looks like very bleak for the North American uranium space at the moment. Will it all work out?
Oh yeah, I could not. I think we're in the best spot, in the best commodity, in the best space, period, right now. The outlook for uranium, we can't. I don't know the time. Right? Like, is it tomorrow? Is it a month from now? Is it 6 weeks from now? When the uranium spot price is going to move? I wish I knew that. I don't. The directionality of it, though, is extremely, extremely strong, moving one direction. And look back to 2006, 2007 timeframe. You look at spot price, action in spot price, it goes parabolic. You look at the underlying equities associated with that. I think we're going to be all right in the uranium space, Matt.
That's what I want to hear, Troy. Thanks very much for your time. Appreciate it.
Thank you.
Thank you. Thank you, everyone.
Thank you, Troy. Now, please help me welcome Ernest Mast, President and Managing Director of Cygnus Metals Limited, for a fireside chat. So I saw a recent press release about the late 2024, I think, about the merger with Doré Copper. You want to tell the crowd a little bit about that and a little bit about Cygnus and what you guys are up to?
Yes, great to be here. We had 2 companies that started discussions, in fact, at this conference about a year ago. And one of the companies, Cygnus Metals, ASX-listed company, with exploration properties in Australia, as well as a portfolio of lithium properties in northern Quebec in the James Bay region. It's a part of a bigger group of companies, and it was decided that this would be the lithium vehicle for the corporation. With the downturn in the lithium market, the group started looking for assets in Canada, and they focused on copper gold to see if they can identify an asset for a corporate transaction. Dory Copper Mining Corp, TSXV listed company with a copper gold project in the Chibougamau region of Quebec, about 5.5-hour drive from here, had completed some previous work, and we're looking for a transaction whereby control would not be lost of the asset, where the shareholders of the company would stay involved in the company, but would be a transformational transaction. And we decided that the merger with Cygnus was that type of transaction. It's played out to be true, whereby Dory Copper Mining had a market cap of approximately $15 million Canadian, tremendously undervalued like many other Canadian peer companies. The transaction with Cygnus put our asset on the ASX, where we're the highest grade copper deposit on the ASX, one of the more advanced copper deposits. And there's quite an appetite amongst Australian investors for that type of vehicle. And we've seen a re-rate occur whereby the combined company has a market cap of approximately $60 million Canadian. And obviously that puts the company in a much better position. And then on top of it, the combination of the copper assets with the lithium assets really makes us truly a critical metals company. And so we think we're very well positioned by doing that merger. So it was a merger which really, or a transaction which worked for both sides. The board of the company is composed of 3 representatives from Cygnus and 3 representatives originally from Dore, but we're working as a cohesive unit moving the project forward.
Okay, what was the work Dore Copper had done on the project? So what was the work Dore had done before the acquisition?
So Dore was listed in early 2020, and the main focus of the company was first to build up the resource base. Our principal deposit was Corner Bay, or is Corner Bay, and during Dore's time, the Corner Bay deposit increased in size from 1.5 million tons to 8.6 million tons, always keeping the grade over 3% copper, making it one of the highest grade copper deposits in North America. And it's really just copper, gold, silver. There's no zinc associated with it, so it produces a very tight premium product. The other thing we did is, upon completing that resource, we went ahead and we did a PEA on the project, and we established a 10.5-year mine life, producing copper equivalent of 50 million pounds per year, all-in sustaining cost of $2.24 per pound. Meaning at today's copper price, we would have a margin of about $100 million US per year. And obviously that's one of the reasons why we're frustrated with the previous market cap, and we're looking to do a transaction, and as I mentioned, the transaction whereby we would keep skin in the game. Right. And so that was principle. The other thing that we had done was we also commenced the permitting process. In the province of Quebec, the permitting process is that you send the province a notification of project, and then they respond with an evaluation of your project preliminary called a project directive. And that kind of spells out all the work you need to do for your ESIA. And our project directive was very straightforward because our project is actually a brownfield project. And that would allow us to give us the parameters we need to move forward with the ESIA study.
Okay. So the 2025 exploration program, so what work are you planning to do for the rest of the year?
During 2025, we started the project, or we started the company up after the merger with Cygnus, and have a new geology team, or many components of a new geology team, and that team has really looked deeply into the Chibougamau camp. Chibougamau camp had 17 past producing mines, and we had Dore Copper, we had scanned about 120,000 mine drawings, and we'd only really scratched the surface of what is the potential of the camp. And it's great having fresh eyes look at the project, especially from a geological point of view. And indeed, the new geology team have identified some extremely interesting targets. We have drilled some, and those results have been press released. So there's a couple of deposits about 3 to 4 kilometers from our mill, whereby there currently is not a resource on it, and we drilled from the ice, which was the first time we'd ever done that. And one of the intersections was really interesting because the deposit's called Goldeneye, previously called Doré Ramp, and there was some work done on it in the late 1980s, early 1990s, where about 92 drill holes were put into the property. And those drill holes were a combination of drill holes from an underground ramp, which was built, and drill holes from surface. And it was determined that the deposit at about 400 meters essentially was no longer there. Again, as a new group, we looked a little deeper into the situation, and we realized that the deeper drill holes that were done in the 90s actually probably didn't hit the structure, and therefore the structure should be still open. And so we did a drill hole about 360 meters deep, and we had an intercept of 7.4 meters, 0.9% copper and 4.6 grams per ton gold and about 15 grams per ton silver. And so that was a great success. We had some other intersections into that deposit, which also were very promising, and we're still waiting on a couple of assays. So that was one of our major initiatives during 2025. Another major initiative is infill drilling at the Corner Bay deposit. As I mentioned, we had built up Corner Bay resources to 8.6 million tons, and about 2.9 million tons were indicated and 5.6 million tons were inferred. Following our PEA in 2022, we did some infill drilling, and then we commenced some infill drilling again last year and this year. And I fully expect that those numbers to become flipped, whereby we'd have the vast majority of the deposit as indicated resources as opposed to inferred resources. And as we build up the indicated resources, we can obviously then start talking about a feasibility study for the Corner Bay deposit. And also around the Corner Bay deposit, we've done a number of downhole EM surveys. And the Corner Bay deposit is essentially an intrusive vein structure. There's a number of veins in the area, and most of the exploration has been done on the principal vein where we do have those resources. And the downhole EM work that was done has identified other potential targets. And so for the remainder of the year, we have about 3 or 4 excellent EM targets to drill at the Corner Bay deposit. In addition, Doré Copper had a deposit, or has a resource on a deposit called Cedar Bay, which is just, in fact, very close to this Goldeneye that I mentioned previously. And the Cedar Bay deposit has a resource of 360,000 tons at about 1.82% copper and 8.6 grams per ton gold. So a very rich deposit. Wow. And that deposit sits under a past producing mine. We had drilled some drill holes in 2020, weren't as spectacular as the previous work we had done, and so we decided not to update the resource. But again, the importance of having fresh eyes look at a deposit, the team has identified that those drill holes that we did in 2020 that we weren't that thrilled about, when you put it in a 2025 context with gold at $3,300 an ounce, suddenly becomes really interesting. And so we're going to do a couple of other holes at Cedar Bay and tie everything together and come up and look to come up with a resource there. And so those are some of the, and so the Cedar Bay deposit, the Corner Bay deposit, and we have some other deposits as well, which are interesting and exciting for us to work on this year.
Right. So just to take a little macro look at this, so it's a challenging environment for juniors. How is Cygnus navigating it, and what sets you apart from other juniors?
Our biggest advantage right now is, in fact, the ASX listing and the association we have with the Cygnus Group, where access to capital is not as challenging as it was when we were just Doré Copper. Mm-hmm. And that's really the main strategic advantage we have. However, we have some other advantages, and that is We're one of the more advanced development projects in North America. The previous panel talked about the support from the Quebec government to certain mining projects, and we're definitely in line for that. And so we have good government support, not only from Quebec, but also from Canada. We're one of the companies who were fortunate enough to receive Canadian Critical Metals Infrastructure Fund funding for our feasibility study. Another factor which I say sets us apart is the low capital intensity we have in our project. Typically, copper projects have capital intensity of $20,000 to $30,000 per ton. Our project, because of the high-grade nature, the existing infrastructure in place, our capital intensity is less than $8,000 a ton, making us one of the lowest capital intensity projects, copper projects in the world. And that's another advantage that we have. Another great advantage is being in the province of Quebec and being in the Iwi-Ichi territory, we've established a very good relationship with the Cree Nation. And the Cree Nation are a very sophisticated First Nations group who welcome investment done right in their territory. And we don't see really any impediments on the permitting process due to dealings with the First Nations. And Quebec is set up, or the First Nations in Quebec are set up in a very structured way where there's no issues with territories. So you don't get really overlap of First Nations, which you do get in other jurisdictions around the world. And when that occurs, there's really a lot of confusion and it results in delays. And again, in Quebec, we have essentially a very clear path of how we're going to move the project forward from a permitting and from a social point of view. Yeah, so those are some of the things that set us apart from
exciting
from others.
So we just have about a couple of minutes left, 2 minutes. So is there anything else you'd like to add?
Yes, I'd like to add, in terms of when we look at the copper supply around the world, there's a very interesting dynamic going on where we see copper consumption increasing 2 to 2.5% per year, as it has for the past 40 years. And the main catalyst over the last 40 years may have been China, may have been some areas in the developing world. We see that probably repeating now with maybe India and Indonesia and other populous nations. The current mines in operation around the world are quite old. And I was in fact at a conference a couple of weeks ago, and someone in the audience challenged the thesis that there is lots of copper supply. You just have to go to the massive porphyries that exist and you can expand them incrementally, indefinitely. But I brought up the point of the Chuquicamata mine in Chile, which, you know, for about 100 years was the largest copper source in the world, and they've now transitioned underground, and their production is about a quarter of what their production was previously. And the same thing's going to happen with the Escondida mine and the Palambres mine and the Collahuasi mine and the Morenci mine and many other mines around the world. So we do need new mines to come in. The incentive price to build a new mine for most companies, the price needs to be north of $5 a pound. That's not the case for us because of our low capital intensity, our high grades, the stability of the Quebec jurisdiction, the low energy prices, availability of experienced mining labor. And so I think, again, we're very well positioned in a macro environment. We're not a big copper producer, producing about 20,000 tons per year of copper equivalent. However, we will be a very profitable producer when we get back into operation.
Well, good luck.
Yeah, thank you very much.
That's about our time.
Okay.
Thank you, everyone.
Thank you.
Thank you, Ernest. Now, please help me welcome Daniel Gordon, Investor Relations Manager of Lift Power Limited, for a fireside chat with Matt Gordon of Crux Investors.
So Daniel Gordon, how are you?
I'm good, my brother from another mother.
It is. We're not related. Obviously, we're not related. How are you? Enjoying the show?
Yeah, conference has been good so far. A lot of meetings, so a lot of networking. The parties are good. It's always excellent to come to Quebec City.
The parties are good. Right, we're going to talk lithium today. I think for most people, lithium seems to have taken a fall from grace from the highs of a couple of years ago. What's going on out there?
Yeah, I mean, you're definitely seeing lows, definitely low lows. Lithium is, an immature market. It's been the best performing commodity 5 of the last 10 years. It's been the worst performing commodity 5 of the last 10 years. But there's also been some positive movement in the market. I mean, you saw Rio Tinto make the acquisition of Arcadium Lithium last year, Pilbara Minerals acquiring Latin Resources, Piedmont and Sayona merging. So, depending on who you talk to, we are either at or near the bottom. And, there's still an oversupply that they're forecasting, but there's still a shortfall that we're expecting to see it probably start up in 2026.
Is it a case of last man standing?
Pretty much.
Right,
yeah.
Okay. Because a lot of people jumped on the bandwagon in the highs. They're doing something else now.
Yeah.
So serious players left at the table. So how do you guys intend to kind of play this market?
I mean, lithium's not an unabundant metal, right? So it's really a race to get a mine built and into production. So for us, we've focused on an aggressive kind of focus. We had one of the largest drill campaigns in Canada for a lithium company in 2023-2024. We did 50,000 meters of drilling at our Yellowknife project in 10 months, released our initial mineral resource estimate, which put us as the 10th largest hard rock lithium asset in Canada, or in the Americas, 3rd largest initial resource in Canada, and also have put out our metallurgical testing. So we're trying to, expedite this project quite quickly.
Right, and do you think hard rock has because there was a fad for brines. Those are the ones attracting the money, I think, sort of 5-6 years ago.
Yeah.
Hard rock in Australia, well known. Canada, it's just come out of the blue, it seems, but there's a lot of it.
Yeah, there's a lot of it. I mean, for the brines, they typically are lower costs, right? But it's harder for those to scale up. For hard rock, it's, typically it's traditional mining methods, so, higher costs, but for you to double production, it's quite easy.
Right, but because this is the bit that intrigues me, is in a market like this, you're trying to attract attention, it's hard. You've got to kind of sell the vision, sell the future, and you've got to be around to be able to, do that.
Yeah.
So what type of money is still attracted to lithium?
I think from a money standpoint, I mean, you're still looking at like the retail world is definitely still interested in it. From an institutional side, they seem to have kind of backed off. I mean, we saw it in us, and like we were quite heavily institutionally held at the peak of the lithium market. But there's still a lot of retail investor appetite, to get into the lithium space.
Right, and I know you're going to hate this question, but you've got to show kind of commercial intent, right? And you've always said our intent is to get into production as soon as possible. The speed is the name of the game here. When the market kind of goes away from you, I guess, does ambition change, or do you just stretch it out a bit? I mean, how do you come at it?
Yeah, I mean, for us, it's not really changed anything. Our goal is to speed is still the case for us. I mean, it would depend on each company. For us, it's definitely our focus still. So we are moving the project forward as quickly as we can. I mean, we're well cashed up. For a lithium exploration company, I mean, we still have $19 million in the bank. So, we can weather this storm as well, too. And there's obviously a lot of things that we can do to even continue that if it stretches further.
Right, so you get a choice as to how the pace at which you move, which is great. As you said, it's a fairly nascent industry in many ways. People have learned that perhaps not to get too excited next time around. So do you expect a sort of slow, steady, accretive growth going forward? Do you see the automotive sector just calming down a little bit Any more clues as to how to play this?
Yeah, I mean, if I had a crystal ball, number one, I wish I did. But I mean, for us, I mean, the automotive sector, you've kind of seen them slow down a little bit. You've seen like Ford pull back from their electric vehicle facility in Oakville. You're seeing this kind of factors from even the U.S. kind of impacting the automotive space in Canada. So, like, I think those are going to be contributing factors to how the lithium market kind of moves forward.
Right, but what do you think? Do you see if they're doing that? Like the growth in the EV sector is still good, right? Like, let's not knock it, but it's not as crazy as people thought. What are the other kind of drivers for this?
Battery storage. Storage. So if you look at it like CATL, so CATL just recently announced that they're going public on the Hong Kong exchange, and they actually, in their prospectus, which they're the largest battery maker in the world, they're forecasting huge growth when it comes to battery storage. So you're going to see this kind of by 2035, battery storage be a huge contributor to that. On the electric vehicle side, yes, it's in North America and even Europe, it's still not great, but in China, I mean, China's still the driving factor in it, and you're seeing 20 to 25% compound annual growth there. So, overall, the market is still growing quite significantly. And you're starting to even see in Europe, like BYD overtook Tesla for being, the largest, foreign electric vehicle car maker there. So they're starting to see growth back in Europe as well. And a $20,000 vehicle is kind of a sweet spot to be getting in there.
Right, so let's go back to Yellowknife. Okay, grades are good.
Grades are good.
You got a lot of it.
Yep.
And you're trying to find more.
Yep.
Right. So that's a good start. But tell us a little bit about the project itself in terms of like how you're going to like evolve things. Like you've done some met work and the recoveries are good as well.
Yeah.
So it's kind of like more of the same as what you're going to be doing. To what end? To what point?
Yeah, I mean, we're doing the less sexy stuff up there now, right? Like the stuff that doesn't get investors super excited. I mean, we're working on the environmental baseline data collection, which obviously is a huge factor to get us to the permitting phase. We're currently ongoing with the PEA. We're expecting that to probably come out in 2026. And then we will be doing more resource definition drilling up there in the fall. So, it's a 50.4 million ton asset as of right now. It has the potential to be, the gold standard in hard rock, which is the 100 million ton asset. It's our resource is only 8 of the 13 deposits. 6 of those 8 remain open in multiple directions. We made that acquisition of 3 other deposits from North Arrow Minerals in December, so we have even more that we can work towards growing that.
Okay, I know you got money in the bank at the moment, but lots of chat at this conference certainly about critical minerals and the essential nature of it for the Canadian market by provincial and federal government. Are they doing anything for you yet, or where have you got to get to before you can maybe qualify for some of that?
Yeah, I mean, so it's definitely on our radar. I think from a project standpoint, I think we definitely should be on their radars from a critical minerals, infrastructure standpoint. We are looking at potentially doing something with a partnership with our Indigenous partners that are around the project. So we've looked at doing a renewable energy or solar project that could contribute, clean energy to the communities, but also they could sell us that energy back at a fraction of the cost. So we are examining different angles. As of right now, it's still TBD.
Yeah, we've seen a few companies come out with announcements. I'm working with First Nations groups, I think Canada Nickel with their nickel project, where actual money, not just support and endorsement, but actual money kind of coming forward. Do you think you'll see a bit more of that in this sector?
I hope so.
Yeah?
I really do. Yeah, I think it's definitely, it would be a positive.
Right, okay. So challenges for you for this year with all your money?
Spending it.
Spending it, right.
Spending it. So I would say, 19 million, there's a good portion of it that is flow-through dollars.
Right.
So that is all earmarked to be executed on before the end of the year. So that would be a big challenge for us, is trying to make sure that we get that all executed.
But it's like you got to spend it away once the market starts to recognize things.
Yeah.
Like, because you came out of the gate flying. You raised a ton of money. It was 60 million out of the gate.
In total, we've raised private and publicly over $100 million.
Right. Okay. Yeah. So you're very attractive. to the audience out there, but you got to show them now how you deliver kind of accretive growth through sensible spending and the right thing. And do you know what that looks like at the moment? Because I found it really hard to read the market in the last couple of years. Drilling with results that I thought are exceptional, certainly in your case as well. No reaction.
Yeah, I mean, it's definitely something that we're hopeful that like will continue. It's hard in this market, right? I mean, we were putting out drill results every week, and you noticed as the lithium market started to kind of wane that instead of us getting that love, we were getting nothing for it. Like you would see a bounce in the share price because we were consistent every week. You'd see a bounce, and now it's being more strategic about like what we're announcing to the market. What does that look like? Is it an acquisition that makes sense, that fits into our portfolio? Do we need to look at, we hold a lot of property, we have our Quebec properties. Would it be a JV with one of those properties as well too? So, it's all ongoing conversations about how, we're communicating to the market looks like now, but it's definitely not the same as it was before.
It doesn't make sense to spend any money on the other projects. Yellowknife is kind of the core, the flagship, right? And you talk about maybe looking at acquisitions, but flip that on its head. Are there any strategics still looking into this space? Because it was the Vogue. Piedmont did their deal, and that kind of looked like the way this thing was going. People want to secure this metal. Do you think it'll come back to that now?
I think you're still seeing it. I mean, we had a strategic investor come into our company back in November of last year, right? So, I mean, I think there's definitely still interest in the space. Yeah. But it's going to be, I mean, it's at these low market prices is when you kind of get those sweet projects as well too, right? So I do think you'll continue to see some more consolidation in the sector.
Can you say who the strategic was?
I cannot.
Oh my goodness.
I'm sworn to secrecy. They hold 9.9%, so they're under the requirements necessary. But for the time being, they remain unnamed.
Right, and do you think we'll see less and less lithium companies by this time next year?
Probably.
And is that what the market needs?
I think so. It's similar to like the gold market, right? You have all these gold exploration companies in. I think you definitely still need to see some significant consolidation in the market moving forward.
Right, okay. So do you want to look out 12 months ahead and tell us where you're going to be?
Everywhere.
I hope not.
I mean, I'm traveling all over the place. I'm actually going to be heading from here to Whitehorse to do some marketing up there for the company as well too. Obviously, being a northern-focused company, I think it's definitely important for us to be up there engaging with investors as well. So that's our next steps. After that, we'll be marketing all across Europe. So.
Okay. Yeah, I think what we need to hear as investors was just some sense of what the future holds for lithium, because it was everywhere and then it's nowhere. The automotive sector is, I guess, still finding its way, and is that demand going to be there for companies like yours? And I just need that kind of reassurance that fundamentally, the guys who survive, are going to be needed, and it's. The future is bright. Yeah. Do you feel that way, or is
I think so. Yeah, I think I think that it's been dark days. So I mean, it's hard to be optimistic, but I definitely lithium is needed. Like it's not going anywhere. There are technologies that they're working on, but they're not anywhere near replacing lithium as the main component for electric vehicles moving forward. So lithium is definitely going to be needed.
Okay, I'm reassured. Right, let's wrap that up, because I think say you've got the money to do what you're doing, and it'll be hopefully more of the same, but to some kind of end where we kind of, I guess, understand the economics or the economic potential of this company. So I'll see you soon.
Thank you, sir.
Okay, cheers. Bye. Thanks, everyone. Oh,
Thank you, Daniel and Matt. Please help me welcome Sam Lee, President and CEO and Director of North Isle Copper and Gold Inc. North Isle is developing one of Canada's most promising critical mineral districts on Vancouver Island, with a strong focus on copper, gold, and sustainability leadership.
Thanks very much for having us. It's great to be back in Quebec. It's been probably 35 years. I was last year playing in the Quebec Pee Wee Hockey Tournament, and clearly that career path didn't work out for me. But incredible city, incredible conference. Thanks very much for having us. So here at North Isle Copper and Gold, we have one of the largest, highest return, lowest capital intensive copper and gold projects currently not owned by a major, and it's probably one of the top projects in Canada, if not the world. I will be making forward-looking statements. What is justifying this comment is a PEA that we released a couple of months ago. It boasts at analyst consensus pricing at $4.20 copper and $21.50 gold, an IRR of 29%, an NPV after tax of $2 billion, a 1.7 times NPV after tax over CapEx ratio, so extremely low capital intensity. It's about an equal copper gold project, so if you want to look at it from a copper perspective, it's about 160 million pounds of copper production for 29 years life of mine. If you want to look at it from a gold production perspective, it's about 310,000 ounces for those 29 years. So second to none with a 1.9-year payback period. It is extremely sensitive to gold prices because there's about 7 million ounces indicated in the project PEA. At $2,900 gold and $4.60 copper, this boasts approximately a $5 billion after-tax net present value. This is something that is very, very rarely seen in the copper space and has really contributed to the lowering of our capital intensity and the increase of our IRRs. So my past profession was I ran CIBC's global mining practice based out of many regions, but most recently out of Vancouver. And when we look at projects, we look at 4 metrics. We look at capital intensity, obviously size, return, and life of mine, so materiality. And so usually when you look at projects, you see projects that are top of class, if they're lucky, in 1 or 2 of these categories. We are top of class in all 4 categories, which makes, again, this proposition extremely unique. We are now chosen to develop and move ahead with this project, given this very strong political environment in Canada. In 30 years of working in the natural resource industry, I have never seen such alignment around natural resource extractive industries in Canada and starting in BC. But we have not taken the eye off the ball as it relates to our 35-kilometer porphyry district, for which we've just scratched the surface with respect to the exploration potential. The reason why we're able to have generated this incredible PEA returns is through good exploration around the higher margin at surface areas, which we will continue to do at Northwest Expo and West Goodspeed. The drills are turning. We had a fully funded program last year in December, and we've been drilling for about a month and a half now, and we'll continue to drill throughout the summer and into the fall. We have been one of the top, if not the top performers across our peer group for many reasons, most of which I just described, but we also are big shareholders of the company. Our insiders own approximately 20% of the company, and among 5 key cornerstone shareholders and insiders, we own about 45% of the company. In addition to that, every raise that we do, we make sure we do not include warrants, which obviously have a capping structure on the capital structure. We do not issue traditional flow-through offerings, for which we all know that that shares come back at you after 4 months. So we are very protective of our capital structure, which has also driven our success. We're covered by 4 analysts, and across the board, we have outperformed our peer group. So we have very aspirational goals at North Isle, and some people, quite frankly, are scared of that. But if you take a look at our board and management team, and you recognize these are people that have led some of the largest, if not the largest, gold and copper companies in the planet. And so that's what drives our aspirational goals. And throughout the last 4 or 5 years, we have achieved stage gate every single goal that we set out. And we have consistently grown value, not only through the drill bit, but through our development strategy. Just to put that in context, every drill program we progress, and we've done 4 in the last 4 years, is approximately $7 million of drilling specifically. We have been able to surface about $20 to $30 million of value as measured by market cap for every program program. If you look at our share price chart, that is what has happened. And so now we're at a point where we have taken what we've been able to develop in the last 4 years and really activate this, this company through the great leadership that we have. So in terms of that political environment that I talked about in BC, there's been 18 projects that have been identified as priority critical metal projects. We are one of that 18. Just recently, the BC government has identified the top four to be expedited, and our goal is simply to be part of that next announcement of expedited projects within the next 2 years. So where do we live? We live on the northern part of the island. We're approximately 500 kilometers away from Victoria. So to put that in context, it's pretty much a further distance that Toronto is from Sudbury Complex. So quite a bit of a trek from the southern part of the island. Everything north of Campbell River was actually built for this mine called Island Copper, which was developed and produced for over 24 years by BHP. So none of this existed prior to the 70s. The BC government plus BHP used this opportunity to build this infrastructure across that, which includes power, roads, ports. There's one of the closest deep sea water ports from continental America to Japan, which is where they sold their copper and moly concentrate. That all exists within a very, very tight envelope of where we live. This is where we live. This is our 35-kilometer porphyry district that pretty much starts from the BHP historical Island Copper mine that was in production from 1970s to 1995. That's what it looks like today. That's the port just to the to the southeast there, and again, that port goes right through the island and to the historical trading partner in Japan. There's also a wind farm that produces an excess 100 megawatt of capacity generation. This is owned by one of the largest European power conglomerates, and this just gets wheeled into the substation, BC Hydro substation, which is only a few kilometers away from Port Hardy. Our PEA that we announced just a couple of months ago contemplates 3 open pits, 2 in the northern corridor, which I'll talk about a bit later, but that's essentially the area that has informed this 65-70% EBITDA margin as part of phase 1. So the reason why these numbers, these economic numbers are so eye-popping right now, it's because of that phase 1 high margin, high grade activity that we have discovered over the last 4 years, and we will continue to add on to that tonnage and grade in that phase 1 as we progress this project. Excuse me, as you can see here, there's been a lot of drilling, a lot of historical work that's been progressed on the project through about 40 to 50 years of progress, not only through the government, but through Utah, BHP, Lumina, a number of companies that for which the data we've inherited. The profile that really impacts the returns and lowers the capital intensity is through this phased modular approach. So phase 1 effectively is paid off within 1.9 years. So that $800 million US, 1.1 billion Canadian capital is paid off within 1.9 years of internal cash flows. And then past that point, the cumulative cash flows as identified in the green line here doesn't hit below 0 or below $100 million from that point on. And that's how we're able to fund the additional secondary capital that essentially gets you that phase 2 29-year life of mine. So again, we're not focusing just on exploration. That is a really key point here. We are focusing also right now, we're drilling on this northern corridor that we have identified, again, this higher margin rock, 65 to 70% EBITDA margin rock. Of the 3 discoveries we've made, we've obviously identified 2 deposits, Northwest Expo and Red Dog, as part of our mineral resource estimate. The third one is West Goodspeed. This hasn't been identified in the mineral resource. We made the discovery last year. We've now drilled over 23 holes on it. We've reported about 16 of them. And what we're seeing there is that this is holding the grade, it's holding the size. It's actually bigger in terms of its strike length, 1 kilometer, and it's starting to attach itself to the most southeasternly project at Red Dog. So it's only about 100 kilometers away, 100 meters away from Red Dog, which we now believe is attached to it. So that's the area of focus, one of the areas of focus. This is essentially the northern corridor that we talk about. This is West Goodspeed with a 1 kilometer strike. Northwest Expo is where we see the 1 to 2 grams high grade at surface gold zone that we believe is going to be extended towards the northeast. So the second phase of our program this year, which we're starting imminently, is to go after that causative intrusion of that high grade surface intrusion of about 1 to 2 grams per ton to the northeast. And then the third part of our exploration program, which is fully funded, is going to look to extend the strike distance of West Goodspeed, which is currently 1 kilometer. We're looking to connect it with Red Dog, which would add another half a kilometer. And so therefore this trend, which currently sits about 5 kilometers long, could be in fact a 5 kilometer strike by the end of this drill program, which would make it a tier 1 world-class discovery that we've made over the last 3 years. And then, of course, the third and the final proposition here is this big buried porphyry. So there's a number of companies out there, these copper companies out there, that just exclusively focus on these big buried deep porphyries. Obviously, they're all trying to emulate and trying to have the same success as the Filos that just got taken out by BHP for $3.5 billion. Well, we have that proposition in our contiguous 35-kilometer district. It's probably best said by Alex Davidson, who just joined our board about 2 months ago. For those of you who don't know, Alex worked at Barrick for many, many decades. He's pretty much responsible for all of their assets that came from the Barrick side, not the Randgold side. And he had to define this and describe this as a potential world-class district here. And so what would make this a district as opposed to just a project would be Pemberton Hills. That is effectively our deep buried porphyry that is pre-discovery, but we have advanced it to the point where we're quite confident now, where we believe there's a very targeted area to start drilling on. So that really is the overall nutshell as it relates to the project description. I think in terms of the political environment, we can all agree that whether you're the opposition party, you're the incumbent, whether it's municipal, provincial, federal, First Nations governments, everyone is aligned on the fact that the only way to reestablish our sovereignty or reestablish our economic independence is through natural resource extraction, and it's to find global partners. Well, we literally sit on tidewater on the west coast, and we have all of that infrastructure that's currently built within the context of a mine that is 80,000 tons per day, i.e. the BHP Island Copper Mine. And with respect to what is very important in Canada and in British Columbia especially, is that our First Nation partnerships are extremely important to us, and it's culminated into consent agreements that the government of British Columbia has in fact progressed as part of their mandate on how to expedite and prioritize projects within the projects. They took the model from our initial model, which is consent from First Nations first, then go through the permitting process. And what we saw as it relates to receiving our permits was that we actually received our 5-year, multi-year asset-based permits, which usually in British Columbia and other parts of Canada and Peru and Chile take about 12 to 24 months to receive. We got ours in 14 weeks because we had these consent letters in place as part of our applications, because we have the will, because we have the support of these First Nation groups. And that is what is going to drive the expedited nature of projects in British Columbia and in Canada. And we have been publicly recognized for all of this. This is actually me receiving the King Charles III Coronation Medal from our Premier because of the work that we do around consent-based decisions with our critical metals projects in British Columbia. So in summary, this is a transformational year. It is going to continue to be a transformational year. The next 6 months is going to be critical, pardon the pun, for the company. We are now walking and chewing gum at the same time. We're developing one of the best projects in Canada, if not the world today, and we're continuing to make it stronger as it relates to improving the economics, higher margin material through good exploration in the Northern Corridor. So in the next few weeks, we're going to start releasing our results, and in the next few months, our strategy around the development is going to become a lot more transparent, making the next 6 months most likely the most transformational period of North Isle Copper and Gold. I'm not sure if we have time for questions, but hopefully I got through that quick enough. Okay. Thank you very much, everybody. Have a great day.
Thank you, Sam. Now it is my pleasure to invite Armand McKenzie of First Phosphate on stage, who will introduce and moderate the Indigenous Women's Business Panel.
Kui. Kui kasano. Uti tayek namlandino te amdawat. Uti Quebec. Quebec cha inui munane. Ki namlandino te which in Chugo engine. Joan Yvonne Mac Jenny Lou. So welcome to you all. Bien sûr, it was a bit of a land acknowledgement. My name is Armand McKenzie. I'm president of First Phosphate, a wonderful company with a magnificent deposit. And the ticker is CSC double comma PHOS. So if you're interested to invest, please do so. So I said a few words in my indigenous language to talk about Quebec. So it's some sort of a land acknowledgement. And my Cree friends that I see over there would, and Matthew, Grand Chief Matthew can come back in the back, would acknowledge the fact that Quebec is an Innu word, meaning Ashtam Quebec. Quebec means come ashore, or come sit at a table, or come ashore. When we first saw the ships coming in, the sail ships from the Ile d'Orléans or Orléans Island. So Quebec is an Innu word, meaning come to the shore. Isn't that the case, Grand Chief Matthew can come? Ashtam Quebec. There you go. I have a validation over there. So we have a fantastic panel. I'm very happy to and the honor to have two fantastic guests with two fabulous Indigenous women who got involved in the mining industry, because I believe when we are part of the industry, it works much better. We discovered this a lot of debate, about the tariffs and so on and so forth, and how do we confront those tariffs and how do we develop major national projects? Well, it's always much better when you do it with the indigenous peoples at the table, and more importantly, when you have indigenous women who have been at the forefront of the discussions leading to resource development in the industry. So welcome Yvonne, welcome Jenny Lou, and the way we will proceed is like we'll take the full 30 minutes to talk and to explain about our the challenges, the gaps, and then the solutions or empowerment initiatives that we can build upon based on experience. First, I'll start with Yvonne and then Jenny. But Yvonne, she just published this book, and I had time to have a quick glance to it. Just around the corner, Yvonne Ribault-Jones. She was Member of Parliament from Labrador. And I'll tell you how I met Yvonne in Labrador, because I'm a proud son of Labrador.
Yes.
Yes, I'm very happy to be from Labrador, because this is my homeland, this is our homeland, it's beautiful, it's the big land, and I'll tell you why. I was skidooing from Shefferville to Goose Bay, to Churchill Falls, back in the days. And guess what I see on the pole? Yvonne's sign or campaign postcard on the pole. And I said, "Why? That looks fabulous." And I love the colors, the stripe. We have the most beautiful flag in Labrador: white, blue, and green, which is the land, and the leaf as well, the spruce, leaf. Yeah. So tell us about you, Yvonne. What brought you here in this field of the mining industry?
Nakamek, Armand, thank you, merci beaucoup. Atali hi, everyone, means welcome. Welcome to this forum. I'm very pleased to be here, and thank you, Armand, for inviting me. he is a very proud Labradorian, I can tell you that. He makes no bones about it. And we're very happy. And anyone who's in the mining industry in Eastern Canada, you're going to know Armand. He's been around many mining companies as an advisor, a facilitator, but more importantly, building those connections between Indigenous peoples and the corporations, which we know is fundamental to success for the mining companies, but also for Indigenous people. I've had a long career in politics. I retired during the last election, which was a month ago, after 30 years in elected politics, representing the people of Labrador, and I'm very proud of that.
30 years, folks, 30 years.
Yeah. And in that 30 years, I've had a lot of engagement with mining companies, starting with the fact growing up in Labrador, you had to know about Wabush Mines, you had to know about Rio Tinto and Iron Ore Company of Canada, but most importantly, you had to know about the Labrador Trough. And I always said my entire life, you can't have a better address in the world than the Labrador Trough. Yeah. One of the richest resources in the world today, and in iron ore. So my first engagement in government was negotiating the Voisey's Bay deal, the Valley project in Labrador. I was part of the government, part of the cabinet when we did that deal. And of course, it's really ironic that Matthew Cunningham is here today, because the model we use to do the IBAs at that time was that of what the Cree had done in northern Quebec. At the time, they were the model for the country. They had one of the most sophisticated land claims on the planet, and we wanted to get it right. And so between governments and Indigenous communities, we use that as a blueprint to move forward. Yeah. And I'd like to think we have, like the Cree, one of the best agreements that you can achieve in IBAs for the mining sector. Totally. So in my book, you'll hear a lot about the work I've done over the years, but mostly my book is about a young girl, who's me, who grows up in northern Canada in a very isolated community to a very Indigenous family. I was raised in a very cultural perspective community and a very cultural perspective life. It was a lot of great things that happened to me, but a lot of very challenging things that happened to me that I'm still seeing happening across northern Canada today. And so my book talks about how do you get away from the things that have happened to you, how do you build that resilience so you can move on to do other things in society. And I was able to do that. And I want to share that story with so many other girls and women in northern Canada and Indigenous Canada, and that's why I wrote this book. Over the years, I've been an ambassador for sustainable mining in Canada. I've did a lot of videos and speeches with the Mining Association of Canada, got engaged with PDAC, and even back in the early years when Matthew was the chair of the Canadian Mining Association, Indigenous Mining Association, I was participating in that. And it was in all of those processes that I ran into a guy named Armand McKenzie. And I'm very proudly like to say that Armand's love for the mining sector, for government and policy, also extends in his family. His daughter Alexis worked with me in the Department of Northern Affairs for a number of years. Very brilliant young woman, and I was very happy to have her on our team. So during my time in politics, I served as Minister and Parliamentary Secretary in the provincial government. In the federal government, I served as the Parliamentary Secretary to Natural Resources, to National Defense, with priority on the Northern and Arctic sector, and also for 10 years in Northern Affairs. I was also Canada's rep for the Arctic in the circumpolar countries of the world, and I don't have to tell you how challenging it is for many northern jurisdictions in the world today with regard to economic security, environmental security, food security, and economic security is very important. So right now I'm a retired politician. I'm promoting my book, and I'm doing my thesis on economic growth and sustainability in Arctic countries and subarctic regions. So I'm very happy to be here with you today, Armand, and I'm going to pass it back to you.
Nachumik, Yvonne. You know, she's very honest and genuine, and then she doesn't need to sugarcoat issues. She's passionate, obviously. She's a political person. When you pass the mic to a political person, be expected to try to save some time. So this is good. And actually, the book is here. It will be available for her at the exit at the lobby of this conference room. Jenny Lou, fantastic. She's from Ontario. And when I read her bio, I was amazed of all the things she's done in the mining industry. Because the purpose of this panel, really, beyond of saying that we need indigenous peoples around the table when you speak about resource development in the country, well, it's also capacity building, empowerment, and that's what I like. That's what I like to talk about. And then Jenny Lou is a perfect example of how an indigenous woman from young, humble roots can come up and be part in the mining industry. Please tell us about yourself.
Ani Bojo Kinawai, Jenny Lou Campbell, Nandishnakas, Ganapajing Nadonjaba, Wakwa Dodem, Nishnabé Kwe and Dao. I just introduced myself in my language, Anishinaabe Moen, also known as Ojibwe. I'm from Serpent River, a proud Anishinaabe woman, Bear Clan, and very happy to be here. So, a little bit more about myself is I've been in the mining industry my entire career. It's not something that I thought I was ever going to end up in. My community of Serpent River First Nation is downstream from some uranium mines, the Elliott Lake uranium mines that operated from the 50s until the early 90s. And back when there was very little environmental protections, our waters were contaminated. The animals that were drinking from the water that we were then hunting and consuming affected our well-being. So I come with a dual perspective because I've also been very fortunate to work in the mining industry. I was a graduate of Lakehead University, Environmental Sciences, and had this big dream of being on the land, doing environmental monitoring, and it just so happened that my father was also a miner, and so he worked at the Hemlo Gold Mines in Marathon. And as a student, if you're going to college or university, you got to spend your summers working in the mines. So that's what really piqued my interest. I was 18 years old. I was underground as a supplies handler, delivering explosives and vent tubing, and I had no idea what any of that stuff was back then. Little did I know, further into my career, I would, become somewhat of an expert in many of those things. So I drove haulage trucks, I worked in the assay lab, and that's what really, I think, got my foot in the door. And I began my career with Vale up in Thompson, Manitoba. So I spent about 10 years up there in the mines engineering department, working in a number of various roles, from surveying to ventilation, and then got into mine planning, right from short range planning all the way into long range planning. But home was calling, and after about 10 years, I decided to make the move back to Ontario, back to Sudbury, and I worked with Hatch for about 5 years in project controls as an estimator. So I was able to work on a lot of the major projects that were in the Sudbury Basin with a lot of the Vale and the Glencore clients. I also got to work on the Voisey's Bay project as well, so there's a connection here with with Labrador. And it just really opened my eyes to, I was sharing this with Yvonne earlier, when I was working as an estimator, it really bugged me that community engagement and business engagement was just seen as a line item within an estimate of a couple $100 million or $1 billion. So I thought, how can I really amplify Indigenous participation in the industry? So I kind of took a bit of a turn in my career and got into First Nations advocacy work. I was the lead on the mining file at the Snobbig Nation, and we represented 39 First Nations in Ontario. And that's kind of what led me to where I am today as the Executive Director for the Indigenous Centre of Excellence for Mineral Development, where our major goal is to increase Indigenous participation in the mining industry, but also bring together industry, government, and First Nations together to have these conversations that need to happen.
Wow. Didn't I tell you we have two fantastic people here?
Yeah, thank you.
You know, Jenny Lou, from a previous life, I had issues with a sedimentation pond with another company. It would have been great to have you on our team to watch over all the works, all the things that we should have done better back then. So, you know, one of the issues, and I don't want to dwell on this, but one of the issues at times, you know, we face is Indigenous women in the mining industry. We only have 30 minutes left. Please tell us what are the challenges that Indigenous women are facing before we go on other successful stories. Just tell us briefly.
Okay, so first of all, if you look at Canada today, 10% of the workforce in the mining sector is Indigenous people, and about 30% of those are women, Indigenous women in particular. When you look at the other workforce in Canada, it's only 4% Indigenous employed, and about 25% women. So the mining sector is really the largest employer of Indigenous people and of women in the mining sector than any other workplace industry.
Yeah.
So I think that's great news. However, there's lots of room to get those numbers up. I'm going to give you an example. Of course, Jenny Lou and I share our contact with Vale, and actually the first underground mine I ever visited was in Sudbury, and it was when we were doing IBA agreements with the province, and we took a full delegation of Indigenous people into Sudbury to show them what a nickel mine looked like, what it would look like once we go underground. And of course, 20 years later, we did go underground last year, which was great. So how did we get to, in Vale's case, 65% Indigenous employment, and over 40% of those are women? So how did we get there? We got there by partnering, first of all, with Indigenous communities, province, federal government, trade unions, and the company. And I always say that the first piece of money that the federal government gave us to start that was just 2 years before I moved to federal politics. And the money they gave us allowed us, it was like a seed money.
Yeah.
We could build on it. So the companies invested, others invested, and we started doing training with Indigenous people in communities. Keeping in mind that this is a fly-in, fly-out mine,
Yeah.
and also the communities around it were all isolated. The other model I see very much like it is in Nunavut, where we have Nico Eagle, where we have Baffinland. Those companies operate in very much the same way.
Yeah.
And of course, they're trying to get their Indigenous numbers up as well. But designing education and training programs that met the needs of people that wanted to go to work there and met the needs of the company. It was about bridging those two pieces to become successful.
Yeah.
Over the course of Voisey's Bay, the Vale mine, the federal government has invested, in my time as the Member of Parliament, over $50 million in training.
Wow.
It's a lot of money, but we've practically doubled that money with other contributions as well.
Yeah.
So how many people do you get trained for this amount of money? You get a lot. You get hundreds and hundreds of people.
Yeah.
And that's why today we have 65% Indigenous employment at the mine site, where nearly just under half of them are women being employed.
Wow.
So it's a great success story. And I really believe that if that model was used by other mining companies, and not just signing an IBA and say we're going to hire local people, local people can't work for you unless they're qualified to work for you.
Yes.
They can't work for you unless they have training. We train people in universities, in college and trade institutions. We train them at home in their own communities. It depended on the job that they were gearing themselves for and what the company needed people for. So it was various levels of training. Not everyone went to university for 4 years and worked at the mine. Some people just did on-the-job training and basic safety courses and things of this nature. So it was a combination of different training and education initiatives that allowed them to be qualified for those jobs, that allowed them to be hired for those jobs. I don't have to tell you that mining jobs in the north pay well. Mining jobs pay well overall. I watched whole communities of women turn their lives around by going from living on $25,000 a year to retraining, getting a job at the mine site, and earning $95,000 a year. It allowed them to be able to put their own children in universities. It allowed them to be able to buy their first homes, to do things they could never do before, and in fact, never dreamed of doing before. And all it required was time, investment, and wanting to make the employment of Indigenous peoples and women a priority. And when you do that, you find a way. So anyone want to talk about the model that we've used that have been highly successful? So successful, in fact, that we use it for the surface mining and to train people for underground mining. And where did we train the underground miners? We trained them in Sudbury, which Jenny Lou is very familiar with.
Jenny Lou, you have the final words because we're already almost, time's is almost up. I told you that would be a fantastic panel, you know, with a wealth of experience. You know, what are the key words for forward-looking statements, you know, like in terms of successful participation of Indigenous women? What would be your best advice based on your experience?
I think for Indigenous women to enter the mining industry, you know, it lands on everything that you just shared with us. You know, having the right tools and support to uplift Indigenous women, to ensure that there's more opportunities going forward for Indigenous women than there were for me, that there's more procurement opportunities for Indigenous businesses. And it's also about relationship building and building an understanding between the mining industry and First Nations and Indigenous communities, having an understanding of what our values are. Our values are the environment, the water, the next 7 generations. And sometimes that doesn't always fit into a financial model or a mine plan. But I think that's the work that needs to be done to de-risk projects and move them forward at the speed that they need to be advanced, you know, in this day and age. So I think it's just building the capacity within our communities, creating a pipeline of Indigenous women that want to enter the industry and be mentors for the next generation that are coming up. And, you know, it was probably 12 or 13 years into my career until I came across another Indigenous woman that was working in the mining industry in a technical, in the technical field. And that really stuck with me because I never had anybody to look up to that looked like me, that had the same experience as me as a First Nations woman. So I think that's really important.
Well, that's good. That's great. You know what? I think we, all three of us as Indigenous persons, we experienced that. We experienced the challenges in the industry. And then we overcame. You know, we were not sitting there just like, okay, oh, I'm a victim in here. No, no, we just came up stronger. And you know, Yvonne, it's an anecdote. While you were working on the Voices Bay Agreement, I was on the other side of the fence. You know, we were with the placards, you know, and then I was saying like, no to voice, INCO, no INCO, and so on and so forth, you know. And here I am now, you know, a mining executive for the last 20 years of my life, you know. And so I think that's how about you reach success in the industry. We have time for a short question, if any of you want to ask questions. Otherwise, I will thank our. Is there anyone in the group? Yes, please. Feel free to go to the mic. There's 1, 2, 3.
Everybody's good?
So I think our explanations were very clear. And then that's a clear example of how we can bring success in our communities and how women can be the strong leaders in the community to bring success in all those resource development projects.
Yeah.
I will leave you with a quote that I got from this book, okay, just around the corner. Communities, indigenous communities, need strong female leaders with vision to solve issues and support progress for generations to come. And that's a quote from your book.
Thank you.
Okay. Thank you, Yvonne. Yvonne. Miigwech. Miigwech. And then please feel free to have a discussion with those strong indigenous women from the industry. Thank you all.
Thank you, Armand. Great job. Okay.
Thank you all very much for being here today. I'd like to introduce myself. My name is Madison Tapscott. I'm an Associate Vice President of Equity Research at Stifel, and it is my pleasure to moderate the Critical Metals and Transition Energy session today. First up to the stage, I'd like to welcome Terry Lynch, Chief Executive Officer and Director of Power Metallic Mines. Power Metallic Mines is focused on the exploration and development of high-grade polymetallic assets in Canada, supported by the demand for critical and base metals. Over to you, Terry.
Thank you very much for that introduction. Great to be here in Quebec City again. It's always one of our fun times of the year, one of my favorite spots to come visit, and just love it. And we, of course, got some great weather, and I guess that's been a bit of a break for everyone here. So let's dive into Power Metallic and our world-class polymetallic discovery at Nisk, which is sort of by Nemaska in Quebec. We're not going to tell you anything we don't believe is true, but you should always do your own due diligence. We think we're a very smart money investment. We've been graced by having some of the most interesting and exceptional investors in mining participate in our recent financings. Robert Friedland, Rob McEwen, Gina Reinhardt. We've got probably some of the top mining funds as well. Why did they come? Generally, they came because of the discovery. So we'll get more into the discovery, but it's a high-grade copper polymetallic discovery. This morning, we announced 12.5 meters of 11% copper equivalent. That's just another extension of, as you'll see, some massive grades that we've reported. So that's continuing to happen. Why it's a great time to be looking is we're fully funded. So we're all cashed up. We raised $50 million. We'll talk to you a bit more about that. So no financing in our immediate future. We raised that money so we could drill. We're going to be drilling about 100,000 meters between here and the end of December of 2026. So about 6,000 meters a month. So that will drive assays, which ultimately impact valuation. We're going to do it in a sustainable way. It's always been a part of our motto, and we've certainly lived up to it. And we're doing it in we think is the best jurisdiction in the planet. That's Quebec. Quick snapshot on the company. So about a market cap today of around 250 million or so. The key thing I think to take away from this is that the key stakeholders have almost a 50% market stake. Myself and my family are the largest stakeholders, 16% or so. We've put a fresh $4.5–5 million in over the last 2 years, and all the key stakeholders have invested over the last 2 years significant sums. And I think that's always a great sign. The people that have the biggest stake are continuing to write checks. That means they continue to believe in the investment. The apologies for the formatting here, but Quebec is definitely a killer location. 3 big reasons we like it. Number 1, infrastructure. In our case, we're located off of Route North. You can drive right to the site. We're across the road from Hydro-Quebec substation. We've got power lines on the site, so we've got roads and power. We're 8 kilometers outside the town of Nemaska, which is basically got a regional airport. It's also home of the James Bay Cree. They're our First Nations partner. They're an exceptional group to work with. And I think Quebec's done a great job in working with the First Nations as partners and educating them as to the benefits of mining for their communities. The third reason we love Quebec is the fiscal terms. The fiscal terms in Quebec, Canada, are literally the best in the world. We recently raised $50 million. We raised 80% of it at $2.83 a share, 20% at $1.45. So the overall was around average of $2.50. So investors ultimately ended up paying $1.45, but we were able to leverage that into the $2.50 through the tax codes and the incentives built in Quebec and in Canada. So that's a tremendous advantage for our company and for our shareholders. You know, we talked about the energy transition, and basically, you know, the world's going to need a lot more copper. That's the takeaway from this slide. We're very underinvested in the copper, ultimately in nickel as well, but copper for sure. Boy, the formatting here is just crazy. We sent a slide and they couldn't take the format, so we'll have to fight our way through this. Bottom line, this is going to be a very big discovery. Right now, you can earn wave around 15 to 20 million tons of ore that we've discovered, or mineralized area. Sakatti is the next one up on the list. That's a really great orthomagmatic deposit, which is what we have, and it's about 41 million tons. Voisey's Bay is 140 plus. We'd expect to probably get to Sakatti size by the end of the year, and we think Voisey's Bay is certainly the next step for us. That's how big this thing can be. This is the discovery itself. So we started off as a nickel. We used to be called Power Nickel because it was a nickel company initially, and we had a nice nickel discovery that we have an MRE on. And we started out 3.1 million tons of 1.5% nickel. It's probably sort of 8.5 there now. The MRE is around 7.1. And looking for more nickel, we stepped out and drilled what we thought would be a nickel hole, and voila, we hit the line zone. So we talked just briefly at the introduction about, you know, hitting 12.5 meters today of 11%, but you can see the summary on this slide is 5 of our better holes, basically 21 meters of thickness, 8% copper equivalent. These are staggering sums, really, really amazing. There's nothing quite like it in the world. When you look at it, why we were able to raise the money, we went out and we basically, you know, looked at the polymetallic comparables out there. You know, Adriatic is probably the best comparison because it also has $500 rock, which is what we have. And we can see, you know, basically being at the same stage as they are. They just got taken out, you know, or are on the verge of a takeout. So we're trading at about 20 cents on the dollar. That's why we're able to attract capital. This is a really tremendously powerful slide. So it's basically, these are all, you know, the orthomagmatic nickel copper discoveries in the history of the world. So there's only been about 20 of them. Norilsk is the biggest, most valuable mine in the world. Oktябрьский right in the center, the red button there. That's the only $1 trillion mine in the history of the world. Voisey's Bay, who we all know well in Canada here, and Sakatti, and obviously now Power Metallic. So the interesting takeaway from this slide is that probably as we develop this project, we'll end up probably being about a third nickel revenue, a third copper, and a third PGEs. And the other point to take from this slide is that for every 1 ton of copper that we have found, or that was found in these 20 orthomagmatic discoveries around the world, they found 5 tons of nickel sulfide. It ranges from 2 to 7. So right now at Power Metallic at NISC, we're probably 1.5 copper to nickel, soon to be 2 copper to 1 nickel. So we're finding a lot more copper, but ultimately we're going to find a lot more nickel, and it's going to be rich. So that's why we think this thing will be, you know, in the 40, 50, 100 million tons before it's all said and done. The team is, you know, very focused, very lean. The key, you know, folks to focus on here in the bottom left-hand corner, Joe Campbell and Steve Beresford. They're our scientific team, both Western Mining trained execs. Steve came from First Quantum, MMG, and IGO, where he was chief geo when they went through their billion-dollar transformations. He's probably the top polymetallic scientist in the world. He certainly brought a lot to the team that's helped us to explore rapidly. So between having these great grades and the science team involved, that's what led us to be able to, you know, basically get the $50 million. You know, it's obviously great to have that. Allows us to really ramp up our drilling program. So we're gearing up right now. We'll have 6 rigs rolling over the summer. So it'll be a very exciting, newsy story. So we'll start, I would expect summer program drill results will be coming in mid-August. This is what the land package looks like at the moment, and basically we'll be stepping out from the Lion discovery, which is in the far right, to Nisk on the far left. There's about 5 kilometers in between there. We believe these things are connected. So we're doing a series of twinned holes, 300 meters across this summer, and each hole will have a borehole EM done. A borehole EM is a technique where you put down and test using electromagnetic pulse to see if there's a sulfide body out there. It's been highly impactful for us. We've been having a 50% drill record success as a result of using this technology. So we believe this will be a way to identify new Lion zones and connect the two deposits. So that'll be exciting news this summer. Metallurgy is always a question when you're in a polymetallic discovery. We don't believe that'll be an issue here, but we want to answer it for the market. Right now, we're running at an 80%, for our copper equivalency comparables. When I asked Robert Friedland what he thought on the metallurgy, he said, look, Platte Reef, which is a polymetallic in the Ivanhoe chain, is 88 to 90% sort of recoverables. He says, I'm sure you'll get there. So we think we'll get there, but we'll have some news on that. We're doing a full study right now. We'll probably have some updates in H2 and possibly the whole study out by the end of H2, but certainly Q1 of next year. One of the other things we've got coming is when we were just a nickel deal, we got approached by the largest nickel refiner in the world, CVMR, about doing a nickel powder plant and basically using Nisk nickel to create nickel powder. Nickel powder is basically used to make 3 things primarily. Batteries for EVs, it's used for 3D printing, and it's used for armaments. So they've got 2 massive contracts with the DoD for everything from frigates to missiles to bullets. And nickel powder is an exceptionally profitable business, $40,000 to $60,000 a ton for nickel powder versus $15,700 or so for nickel concentrate. So it's pretty interesting, the scale there, and it's probably cost you an extra $4,000. So if you can get in that business, it's a good one. So we'll have an update on that sometime this fall. One of the things we've talked about at the outset was always maintaining our trying to build the world's first carbon neutral, at one point nickel mine, now polymetallic. And we're going to be able to do that here because of, luckily, we've got Hydro-Quebec is on site, right across the way. We've got naturally ability to offset our ultramafic rock, and then the CO2 burn for there's 3 ways to process nickel. You can basically do it hydrometallurgy, smelting, or chemical metal vapor process, and that's what CVMR does. So it's a very low energy burn, no external air, no external water. We spun off our projects in BC and in Chile. These were exploration copper goals. We're quite excited about these. We're about to relist them on the TSXV in Q3. So we maintained a 50% interest, and our shareholders on the other 50%. So there'll be a nice little dividend kick coming for our shareholders there on that. Milestones this year is, generally the things that'll drive, I think, valuation and excitement for our shareholders is the ramping of the exploration. So we finished the year, in April with 3 rigs. We're scaling to 6. So you can expect a very steady stream of news and assays as we show the ramp of what we believe will be a massive resource expansion. Generally speaking, mining stocks run with the value in the ground. So as you prove more value in the ground, valuation should rise. We're doing some work on the land packages to enhance our land package. I think you'll see some news on that shortly. We're also looking at moving up exchanges, probably going to TSX, TMX, and possibly an American exchange as well, and possibly even Australia. So we're definitely going to reach out to the world. We've got a big story to tell. We want them to be paying attention. We'll have the metallurgy study comments sort of in Q4, possibly the full report, but certainly by Q1 of next year. As I said, we're relisting the spin-out, so that'll be good. We'll have the feasibility study in H2, and then there'll be some interesting global opportunities that we've definitely been talking to the Kingdom of Saudi Arabia about some interesting opportunities down there, and we'll have some comments of that in the not too distant future. So that's the story for Power Metallic. We were the top performing mining stock in Canada last year, and we're looking to do the same in 2025. Thank you for your attention. Hope you have a great day. Cheers.
Thank you very much, Terry. Now please help me welcome Jean-Philippe Paiement, Chief Technology Officer of Verify, to the stage. Verify is transforming the way that mining companies speak with investors, and this is through powerful, interactive 3D presentations, as well as digital storytelling platforms. Over to you, Jean-Philippe.
All right, good afternoon, everyone. The goal of today's talk was just to sort of give an oversight of why we believe at Verify, and I strongly believe that AI is going to change sort of how we explore and how it's going to change the future of mineral exploration. And really, I think the main things to take away from this talk is that AI will just give you the ability to be more efficient, more transparent, and just look through a lot more than you've done in the past. So I think the first thing to keep in mind is there is a lot of opportunities still hiding in your data. So we've heard and we keep hearing that the next deposits are going to be found deeper and deeper and deeper, and then you have to go to the end of the world to find a new mineral discovery. However, what we think is there's a fallacy in that assumption, and that fallacy is the fact that if you say that, that means that you were 100% effective at finding things you were looking for in the data set you acquired in the past, and I just don't think that's actually true. So there's still a lot hidden in the historic data sets that we currently have, either on sort of government database, but also in companies' data repo. So one example of that is the pegmatite, lithium pegmatite case in Quebec. So all the way from early exploration days in the James Bay province in northern Quebec, all the way to around 2015, people were looking mostly for gold and sometimes copper and sometimes nickel and then gold again. And this is always dictated by what the market is looking for, what's the hottest commodity right now, and what people are actually willing to fund for exploration. One thing they didn't know while doing all that exploration prior to 2015 is that at some point lithium would become a really important metal for battery production. So people and geologists were sitting on pegmatite dikes writing up their reports about gold exploration, mentioning there was a pegmatite here and there that were really, really important for the future of exploration, but they didn't even think of that, right? Comes 2015, the metal price of lithium goes up, people start looking for lithium, and there's a new commodity in the market. And what you're seeing here is basically all of these occurrences were mostly gold related, and comes 2015 when the market started asking for lithium, a lot of people starting to explore for lithium. So you see much more occurrences of lithium deposit being found in the James Bay. And that actually sort of prompt the fact that you need to be able to switch your focus pretty quickly when you're exploring, and you also need to test a lot of hypotheses. As I said, the market is asking for different things at different times, and right now what we're all talking about is the critical mineral push. So people are looking for different types of metal. So yeah, the copper, nickel plays are getting better. They're getting more traction. You're hearing things like base metal as well, or battery metals, or any of those metals become more and more important in exploration. However, we're greatly inefficient in our exploring, right? So if you look at the average times it takes to bring a project from sort of discovery to production, that's about 15 years or close to 16 years. On those 16 years, there's about 12 years spent for discovery to study, so meaning finding the deposit, drilling it, bringing it to a feasibility study. So that's a long time, and that's most of the time. And then you go into construction and production. And a lot of that time up front is spent on how to find it and finding deposits. And I believe that just due to the inefficiency in our processes, and I think if we're going to introduce AI into the exploration toolkit, it's just going to make things a lot more efficient and a lot faster. So what we're proposing on doing is allowing the user to be able to integrate data from different systems. So meaning that you're able to merge all of your different data sources together, a thing that's not actually possible if you're doing manually or the traditional way of exploration. By using AI and machine learning, then you're able to process through all of that data and maybe see correlation that you might have missed in the past. So meaning you might have explored using the wrong vectors, or you might sort of missed some underlying correlation. And then through the immersive visual communication, you're able to go and fund those targets. So you're able to take the findings from the AI, from the prospectivity map you created, and you're able to market those more efficiently as well to be able to sell and possibly fund your project for the next drill hole phase. So what we're actually trying to speed up is the exploration wheel, and I don't know if the crowd here is educated on the geology side, but basically this is how normally exploration cycle works in the industry. And again, what we're doing is we'll go and collect some data. So this is going in the field, either drilling, doing some surveys, doing some mag, soil sampling, whatever you're doing. Then you process the data, you post an exploration hypothesis. So maybe I'm looking for gold in that area, and that data is going to help me. Then you construct a model, and then you generate targets, and then you go back to data collection, which is essentially drilling targets, and this is what's going to tell you if you're successful or not. Before you do that, you have to come up your model, right? You have to communicate your model, and you have to have a model and talk about it to the market. And most of the time, what we're seeing is something like that. So you go out, you're on a road show, you're at the one-to-one meetings today, and you're presenting geological maps with a lot of drawings, a lot of information, but obviously, if you're not a geologist or even a geophysicist, sometimes it's hard to understand what's on these maps, right? So here, why am I supposed to drill that drill hole here? Why is it important that I drill that drill hole? And why is it important that you guys give me $5 million to drill this hole? It's really hard to comprehend if you don't have the geological knowledge behind it. Second thing is, as somebody who's trying to market your property, you're also relying heavily on sort of the quality of your team. So basically what you're selling is not the quality of your data, it's not the quality of your model, you're selling the quality of the geologist who came up with that target. It might be a good thing, but it's also really hard to quantify. So what we're proposing on doing is going from something like that, which is hard to understand, to something much easier to understand, and that is data-driven. So with AI, what you're able to do is generate prediction to where you're most likely to find a deposit. So that creates a heat map. Everyone can understand that here you need to go and explore these bright spots. These bright spots are actually in 3D, and they come with labels that explain how the data-driven approach sees the data and sees the prospectivity. So these go from some qualitative model where you're trying to sell how good of a geologist you have on your team to here's what my data is saying, here's what are the probability associated with my model, here's how accurate my model is, and this is why I believe we should go and explore that area. So it's much easier, much more transparent into how you're targeting and how you're sort of planning on making those discoveries. Overall, at Verify, we are the only actual platform that allows the users to do that. So we have an actual platform. It's cloud-based. You can log in and generate those predictions yourself. So people are able to experiment, and that's super important. As a geologist, what you do is you sit down, you come up with an hypothesis, you test it, and then you iterate on that hypothesis. Using a platform that uses AI allows you to really, really quickly generate those hypotheses and test them out really quickly. By quickly, I mean about 30 minutes. So typically an exploration cycle, and again, if you're doing exploration workshop with your companies, or if you hear your company's doing they'll say they do exploration workshop, it takes between weeks and months. Here you can iterate in a matter of 30 minutes. It runs off an iPad, so you could be sitting in your couch at home watching TV and still exploring, right? So you're always testing out different things with the platform. AI allows you to gather more data, train on more data, and keep your model evolving, right? So just like ChatGPT is coming up with a new version every so-and-so, every few months, it's the same. As you gather more data, as the platform ingests more data, the model's getting retrained, and then you basically increase the ability of the platform to make prediction, increase the reliability of your predictions as well. So in terms of hypothesis testing, this is what you could do. So this example here is from the BTB belt. What we're doing here is just testing different scenarios. So I have all of my data has been compiled. It's available into the platform. What you could do with AI is test out different things. So in my case here, I'm testing a prediction model. So basically, where should I be exploring? Where's the most likely area to contain a gold deposit if I use only the geophysics data and some fault model, so basically geological interpretation. So this is my hypothesis, I've tested it, this is my result. What I can do then is move on to the next one. The next one is the same, so I use geophysics, which has a broad coverage, combined with geochemistry, so soil geochemistry. Here, this is my prediction, this is what I get out of it. And then I can run it again with the full element geochem and some geophysics and maybe some interpretation, and this is what I get as a result. All of these results, they have an accuracy. No geologist in life will tell you that whenever they come up with an exploration target, they have an accuracy of 85%, right? You'll never see that. You'll never hear a geologist talk about how uncertain their target are either, because they're always sure that they found the next big thing. However, again, it makes it hard to communicate to the market, because you come up with people that want to know what is the risk of their investment. They want to know how likely it is to succeed, but you don't have the metrics to do it. By using AI and data-driven approaches, you can actually now start communicating these things to your market. So if we take a real-life example, and this is basically how we're integrating everything into one thing. So you have a property. This is your property boundary. You're seeing it here. I get to present it in 3D as well. The first thing you do is compile all the data that exists over top that area. So this is all of public data that's been compiled here. And just there, if you find any geo that tell you that they'll be able to find a correlation into all of these layers at the same time, using all of the data, they'll be lying to you. Because no human brain can work past about 3 dimensions of data, whereas a computer can go up to thousands of dimensions at the same time. So this is the original data set. That property also had other data sets that had partial cover. So again, through AI, you can generate broader coverage for these data sets. You can use them now. They're also part of what we call the data stack. And the data stack is really what it is. It's stacking all of the data on top of each other to allow for better decision making. From there, you can also augment your data. So there's a lot of different techniques that are available using either predictive model or automated fashion interpretation that allows you to just increase the coverage, increase the amount of information you're extracting from the data. So not only you're using all of the data, but you're also extracting even more information out of that data. So you're really milking what exists over top of your property. So that has 2 things. Once you're really sure you're getting all of the value of what the data you've acquired, the money you've spent on acquiring all of that data now is really put into value. The other thing is you don't need to go and acquire more. You have it here. You're milking everything out of it. So it just makes it a little bit better in terms of footprint, exploration impacts on your project. All of that gets distilled. You train your model. You make prediction. And everything gets translated into a simple sort of product to understand. And this is what it is right now. It's a prospectivity score that is going to tell you where you're most likely to find a mineral system. So here you're seeing where the model gave away their targets. So you can see that you have a big bright spot here. That's probably where you're already exploring. What becomes interesting are areas like this one. So this area doesn't have any drilling, any information surface, but it has a high likelihood of being mineralized. Same as this area here. Again, no drilling, but it has the same signature as this area that's been already explored. So basically you think that there might be other mineral system existing on your property without even setting foot on the ground, right? So now you've narrowed down your search field. You know where you should spend some time exploring in either your next field season or your next drilling campaign. More than that, we can take these surface predictions. So this is just a prediction on a map, and we can push them in 3D also. So from the drill hole, we can extrapolate how deep that target would be. And again, here, that's just saying to how much time is going to be spent exploring that target. So this is the existing one, right? One thing I see is there's potentially an extension, so I can communicate that to my investors because the prospectivity score keeps going farther away from my drill holes. But also, it's going to tell me how much effort I should put into exploring that. So if my target is way deep, if it's 500 meters below the surface or 1,000 meters below the surface, as opposed to another target on my property that's much closer to surface, then I can sort of decide where I want to spend my energy, my time, and my money in terms of exploration efforts. And it's easy to, again, it's super easy to understand. It's super easy to communicate across where you should be going for your next exploration campaign. Lastly, again, to stress the fact that we think there's still a lot in your existing data. When everyone's saying, and I think if you were in a panel this morning, you heard me say that I'm 100, or not 100%, but I'm pretty strongly against the fact that people are saying that they need to go deeper and farther away from known discoveries to find other deposits. There's still things lying in your data that you might have missed. And that's not either by not being a good geo or not being a good explorer. It's just because at some point it's impossible to understand this signal across 64 different layers of information as a human. So there are still things that you are missing in your data that might sort of bring you to better discoveries. And the other thing is a lot of people will tell you they have a platform for mineral discovery. No one's actually has a platform besides Verify, I think. So this is a web-hosted cloud computing service. So you log in, you have access to the platform, you can generate your models, you can iterate as much as you want. And really the goal is to allow people to play with their data, have a sandbox where they can test hypotheses, be quick, and change their mindset really quickly. So here, this is the model you're seeing here again, is the gold model for the BTB belt. But if tomorrow lithium becomes a thing and I have some training points for lithium, I could just switch, create a new experiment, use lithium as training points, use the same inputs, generate a predictive model, and now I've switched my exploration focus for that area really, really quickly. That took about 30 minutes to run. So it's super quick to iterate on again. And that's the key, and that's the real advantage of using AI and data-driven approaches in mineral exploration, is you could change your focus really quickly, or you could test different hypotheses as you explore. That's about it for my presentation, yeah. Thanks.
Great, thank you very much, Jean-Philippe. Up next, we have Abitibi Metals Corp. Abitibi Metals is a Canadian exploration company advancing both gold and critical metal projects in Quebec. Please help me welcome Jonathan Deluce, President, Chief Executive Officer, and Director of Abitibi Metals Corp.
Perfect. Hi, everyone. Appreciate your time today to learn about Abitibi Metals. We're traded on the CSC under the ticker AMQ and the OTC under the ticker AMQFF. So I'll be making some forward-looking statements in today's presentation. So a bit about myself and how we came to be at Abitibi Metals. I'm a member of a family office based out of Toronto and London, Ontario. We're most known for the airline business as the founders of Porter Airlines, in addition to Air Quebec, founding partners of Air Quebec. We're also in the real estate sector and in mining. So we've been in mining for 25 years, largely as a private prospect generator, developing a royalty portfolio, in addition to being financiers, directors in the space. But about 5-6 years ago, we decided to launch an early stage exploration company for this cycle to really take advantage on what we think is very strong market conditions, leading to huge demand for gold, copper, and commodities in general. So we're not perma gold or commodity bulls, but we recognize the opportunity currently in the sector, and we're diverting more capital into the space. So how we came to be, and what was really a company-making acquisition in November of 2023, was the acquisition of our B26 deposit, which we have optioned from SOCAM. SOCAM is essentially a government subsidiary financed by Investment Quebec, and they developed this project over 20 years. So this deposit had never been in a public company since we optioned this back in November of 2023. So from an unbiased perspective, I'm not from the province of Quebec, but when I was trusted with family capital to build an exploration business, there is no question that, in our point of view, Quebec is the best mining jurisdiction in Canada. You have great government partners like SOCAM that have led to really what has been the opportunity that we've leveraged to grow our company. In addition to strong institutional shareholders, we currently have investment from a CDEX and NQ, and also our strong First Nations partners. Whether it was in the airline business or today in mining, it's essential to build those strong partnerships for success. So really, within the first year and a half that we've had the B26 deposit, we've been able to accomplish a lot, but we think we're just getting started. So we've grown the resource by 63% in 1 year. In terms of copper, we've increased the contained copper by 39%. So on a combined basis, this is an 18.5 million ton deposit at just under 2.2% copper equivalent, or 3.5 grams gold. To put this in a gold perspective, in a gold-dominated Abitibi Greenstone Belt, this is 2,050,000 ounces of gold, so a very significant development opportunity within the province. So we have $18.5 million in our treasury. We are fully financed through to Q1 of 2027. We just completed a bought deal with the Bank of Montreal in April, $11.5 million with some large institutions, very supportive shareholders that I believe see the value in B26. So our market cap as of today is $38 million with $18 million in cash for an EV of $20 million. I'm not proud to say that today, but it's a real challenge and what I think highlights the opportunity of where we're at in the market as of today. So really, without financing pressure, we're really driven to get our story out there. This was an asset that was government developed for 20 years, and I think is still very unknown to the market, but we're excited to really highlight the hard work of SOCAM and what we've been able to accomplish in a year and a half. 153 million shares outstanding. We issued no warrants on the $33 million that we've raised over the last year and a half, essentially. And myself, my family office, we've put in over $4.5 million. We own 27% of the company, so we're really well aligned with our shareholders, because really why we got into the public markets is the lack of prudent management of capital. So looking at where we are in the Abitibi Greenstone Belt, we're in the northern Abitibi on the same east-west as Detour, so the northern portion of that slide. We have the historical Sal Bay mine within 7 kilometers, which is important because the Sal Bay mine produced 53 million tons of similar polymetallic material over 20 years. And we have a power line that runs through the project, all year access. We're drilling at less than $250 all in Canadian. So it's really an area that has strong supporting infrastructure in an area that everybody wants to see development. So looking at, zooming in, we have Fenelon, we have Detour Lake on the Ontario side, we have Casa Berardi to the south, we have the Matagami mine and complex to the east. So the Sal Bay mine and area is very underexplored, but it has hosted what is one very large-scale deposit, which is the Sal Bay mine. As I said, 53 million tons of production, resource sizes of 57 million tons, and SOCAM made a new discovery to the northwest of us on the other side of the Sal Bay mine, which is the Wakasik discovery. So still very underexplored area of the belt, and we're excited to be here. And really, this is 18.5 million tons in one continuous deposit, and we think we could be scratching the surface of a much larger system. So again, to put into context what is the value of what we've established as of today. This is already in the top 10% in terms of tonnage of felsic-hosted VMS deposits worldwide. So again, high-grade polymetallic is very hard to find, very few competing deposits within Canada, and really with a renewed focus on critical metals, especially copper, gold, you look at the majors that they say the most sought-after deposit right now is copper gold, especially with high grade. So that's why we're quite excited with the opportunity we have at B26. So zooming in, 130,000 meters of drilling went into our 2024 resource. Our phase 2 drill program was not included in the resource, so that's still upside that we had at the end of last year. 11.3 million tons indicated, 7.2 inferred. And to note, high gold credit for a primary copper deposit. So we've modeled the gold on its own. We think there's upside in the gold. Gold makes up 20% of the value of the deposit, with copper making 60%, with the balance being within the massive sulfide zinc-silver lens that occurs parallel. So this shows the orientation of the deposit. The majority, 80% of the resources in the copper-gold strainer, with the 20% balance within the parallel massive sulfide zinc-silver. So again, this is a 1.6 kilometer strike down to 800 meters vertical with widely spaced drilling. So really, this is a large-scale starting footprint, mirrors some of the largest systems in the Abitibi. So this summarizes what we were able to achieve in 2024. We drilled 30,000 meters. We were able to increase the resource, as I mentioned. We extended the deposit to the east, to the west. expanded the high-grade lens, 11.4% copper equivalent over 10.6 meters. We hit 5 samples in a row over 20 grams gold. So there is high-grade gold pockets of this deposit, and something that we're quite excited to understand and really hone in on the gold controls and how they differ from the copper stringer zones. So really taking a step back at the end of last year, and what we felt was a big disconnect in our market cap versus the underlying value of B26, is really when we meet with the majors, some of the metrics that they give us as to what would interest them to get involved. Some of the mid-tiers have said 10-year mine life, 100,000 ounce per year gold equivalent production, and a strong cost profile. We look at the deposit as of today, we have a pathway to those first 2 buckets. The key question is the cost. Is this an economic deposit to develop? That led to us modeling out the high-grade zone, as you can see on the slide. That is a core portion of the deposit above 3% copper equivalent. And one thing to note, if we were to use current gold prices, our copper grade on an equivalent basis would go up roughly 0.3 to 0.4%. So the impact of the gold credit is a significant item. But really, the high-grade zone is where we see the path to economic development as of today. We're doing scoping studies to influence where we're drilling. Breaking down our budget for this year and pathway through to 2026, we are fully funded for 45,000 meters of drilling. 20 of that will be done this year, with 25,000 next year. So we're in a very good position in what is still a tough junior mining market. We've removed the financing risk for at least a year and a half. We will start 2027 with $3 million of hard cash, so we can focus on delivering at B26 and getting our story out there. So again, with this being developed by strong government partners, if this was developed by a major or junior, this would have been drilled off before it was ever sold to us. So this deposit is truly open. We've identified key areas for our phase 3 drill program that's going to start in 2 weeks with 2 drills, ramp up to 3 drills in July, drill at least 17,500 meters through to the end of the year. So we'll have what we believe is high impact drilling. That is focused on expansional up to 500 meters away from the deposit, incorporating downhole geophysics to look at the larger potential extensions of the B26 deposit. We also, as you can see in purple, that is a gravity anomaly that we've discovered at depth in the 4th quarter of last year. Some of the intercepts that cut the boundaries of that anomaly had narrow, semi-massive to massive sulfide, very high-grade pockets of the deposit. And one of our theses is we have the massive sulfide unit in the zinc silver, but the copper gold is, as I said, hosted in a stringer zone, but we haven't seen a massive copper zone yet. But with the strength of this system, it is something that we're targeting as really a source of what is a very large deposit footprint as of today. So looking property-wide, B26 is a 1.6 kilometer strike of what is an 8.3 kilometer trend. We've identified other targets using ground gravity and a VTEM survey that will be released over the coming weeks. And we've been able to demonstrate that there's strong targets outside of the B26 footprint. VMS deposits occur in clusters. We have B26, we have Sal Bay, as you can see, on the northwest border, and we have the new exciting discovery by SOCAM at Wakasik. So we think the potential to make another discovery is there with the data that we have so far. And if we're able to make a secondary discovery on the property, it can really excite the market, whether that's to the west or northwest between us and Sal Bay. There really has been limited exploration here outside of B26. Looking at our option agreement with SOCAM, we announced that we now are 50% owners of the project on Tuesday. We are fully funded to earn 80% on completion of the 80%. It'll be a joint venture, 80% Abitibi, 20% SOCAM, and with them holding an underlying royalty of a 2% NSR with a 1% buyback. So very strong partners. They're aligned with us to see this developed into a mine and leading to a liquidity event for our shareholders and ourselves as the largest shareholders of the company. We pride ourselves on prudent management of capital. I think we have one of the healthiest G&A to exploration burns in the business, 16% this year G&A, 84% exploration. Our budget is published for 2026 of what is our current treasury position. We'll still have roughly $3 million of hard cash to start 2027. So really in a position with no warrants issued on the company, great opportunity to review the company on what I think will be a very high impact rest of the year. So a lot of juniors put 4N in their deck as a comparison. Very, very few have the grade and scale in comparison that we have at B26. So we have a grade that's higher as of today than 4N. We have 43% of the resource. But this is a good example of when you have the right financial backing. As I mentioned, we had a bought deal with BMO, bringing in some very strong institutional shareholders in the recent financing. But hitting that hole or getting potential economics out there, you don't know where that torque is going to come from, but we've put ourselves in a position to perform, and that's what we're excited about. And you can see that there's a lot of demand within Canada for these high-grade deposits. Again, looking at the size of the footprint compared to some of the other deposits, well, 4N and LaRonde, again, these are deep-seated systems, and we think we could be scratching the surface. So looking at our cap structure, as I said, 153 million shares out, very limited overhang on the stock, and myself, family office, own 27%, SOCOM owns 9.9%, institutions own 25%. Touching on the team briefly, Laurent and Louis joined recently with Laurent's background from Agnico, portfolio manager of Sidex, and also developed the Casperarty mine 45 kilometers to the southwest. Louis Garipri, with his success at O3 Mining, is as VP of Exploration, complemented by a very strong advisory board. And I'm out of time, but greatly appreciate all of your time to learn about our story at Abitibi.
Great. Thank you very much, Jonathan. Now, please help me welcome Brett Maddock, President, CEO, and Director of Max Resources Corp. Max Resources Corp is a copper-focused explorer operating in Colombia's Cesar Basin, targeting large-scale discoveries for the future of clean energy. Over to you.
And there's a pointer here somewhere. There we go. Hi. My name's Brett Maddock. I'm CEO of Max Resource. We're listed on the TSXV under the code MAX, M-A-X. Our capital structure is 180 million shares. We currently have about 3.5 million cash in the bank. Our major shareholders include Endeavour Silver, Franklin Templeton, Merck's Investments, and Eric Sprott. Collectively, they hold 20%, management around 10%. So our team, so the highlights of the team there, my experience in developing projects, in particular, there's 2 iron ore projects. One's called Koolan Island. It's currently with Mount Gibson. Extremely high grade, and that's one of the projects that we're looking at. High grade iron ore, the 2 largest producers are Australia and Brazil. We have Dr. Chris Granger. He's one of the co-founders of Continental Gold in Colombia that relates to our Colombian project. And we have Enrique Sales, who's operation manager in Brazil. He's experienced in bringing high-grade hematite projects together in development. It's value for the pathway that we are doing with the iron ore project. So this is where we are. We're in South America. Cerro Azul Copper is in the far northeast of Colombia. It's a huge sedimentary belt. It's been known for copper for quite a period of time. but it's only really been in a position to be able to explore it on a large scale up to about 8 years ago. Our claims cover a huge area. They cover over 1,300 square kilometres. The mineralisation spans for over 120 kilometres, and we completed an earn-in agreement in May last year with Freeport. Freeport are to spend $50 million to earn 80%. It was a pretty big move for Freeport. They've never been in Colombia before, and that sort of shows a bit of the credibility of the Cerro Azul copper-silver project. Our second one is in Brazil, and this is potential for, or we're looking at from a cash flow perspective for a junior company, and it's got significant margins if you compare it to the neighbouring operations. So Cerro Azul copper, like I said, it's in far northeast Colombia. It's a huge system. We had 3 goals in relation to this area. One was to establish a huge land position. So effectively, we cover the whole of the mineralisation of the 120 kilometres, and what ground we have not got has not been released. And we're in a prolific oil and gas and coal mining belt. In fact, the largest open pit coal mine in South America borders us. So we're in an established mining area. So as I said previously, in May 2024, we signed an earn-in agreement with Freeport. It's just been, our first anniversary's just come through. The dedicated expenditure for 2025 is $4.8 million US, which is around 6.5 million Canadian. And we're entering an exciting time at the moment because we're coming up to the drilling stage, and the market have been waiting for that stage. So we're coming into a quite an exciting 2025. So as we can see there, there's actually effectively 3 districts. The AM district, which we are looking at conducting drilling there, is it is a Mantos style of mineralisation, which relates to northern Chile. That's our focus for the first lot of drilling. And then we go 30 kilometres or midsection of the 120 kilometres of strike. We have the Conejo district, very high grade. You can see there the work that we've done. We're averaging 4.9% copper over an area of some 3 odd kilometres. And then the Ura district, again, high grade. We've had some our drilling that we previously did. We intersected 10 metres at 3.4% copper. So as I said, this is probably where Freeport have got really excited in relation to the Mantos-style discoveries. As a comparison, in northern Chile, you've got Mantos Blancos, 500 million tonnes at plus 1% copper. That's what we're sort of targeting, that style. And we're going through the drilling stage there at the moment. Again, so what we call, where the red line is what we call AM13, which is this discovery. It goes on for over 1.5 kilometres. We've got channel essays that have come through 40 to 50 metres wide, going at 1 to 2%. And we had a new discovery recently we call AM15, which seems to be, potential of a repetition there. And you can see both AM13 and AM15 on that map. This is, which we mentioned, Yuru with the drilling side. We did this drilling back in 2023. And the plan is to follow up here. Like I said, we had, I think it was 10 metres at 3.4% copper, plus an ounce to the tonne silver. So our second project is in Brazil. So where we are in Brazil is a prolific iron ore region and also steel making region. So one of the big differences between Australia and Brazil, in Australia you have to export all the iron ore, which predominantly goes to China and Japan. In Brazil have a large steel industry. They produce 9% of the world's steel, and it's used domestically. So that is a huge advantage where you don't have to deliver the iron ore to a port and ship it overseas. And in Australia, if you haven't got rail access, the mid-tier miners, 50% of their costs is getting the iron ore to the ship. Whereas where we are, our iron ore buyers are within 20 kilometres by road. This map explains it all. So if we look at this map, you can see where we are, the Florida DSO project. You can see Vale up to the north. That's Vale's largest iron ore mine in Minas Gerais, which is the largest iron ore producing state. And these are old mines. So the high grade at surface, which is potentially oxide enrichment, has been mined. So what they need is they're buying iron ore from mid-tier producers from 1 million tonnes per annum to 4 million tonnes per annum. 1 million tonnes might not sound that much, but when you're looking at iron ore at $100 a tonne, 1 million tonnes, you're looking around the $100 million mark of saleable ore. And where we are, you've got a company there, for example, called GSM. GSM deliver their ore to Vale, and they deliver it at a cost of $15 US a tonne, which is comparable to operations in Australia, is basically half the cost of what it costs to get the ore delivered to the ship. The mining costs are very similar, but the actual cost of delivery. And where we are, we've got existing haul roads to Vale, one to Mytel, and also one to an iron ore port, which to a rail link to an iron ore port. So we've got a number of choices there where basically we have the market at our doorstep rather than having to do all that haulage distance. And look, bulk commodities, whether it's iron ore or whether it's coal, it's all about logistics and distance of travelling the product to the buyer. Also as well, in relation to the iron ore terminal, the railway link for the iron ore terminal goes to, which gives us an option of being able to ship the ore overseas. There's a well-known trading company, Trafigura. They own the iron ore port. The iron ore port is capable of doing 50 million tonnes a year. Last year they did 27 million tonnes. So we do have the added bonus of having the option to be able to ship the ore overseas, which predominantly would be along the east coast of the US. So this is a video which gives you a bit of an idea of where we are. This is the historic mining pit. You'll see a number of roads have gone through. We just completed the first drilling program, which amounted to 5 diamond holes, 80 auger holes, and where we've drilled is we've basically been following the road network. We're finding that the high-grade iron ore is quite consistent, which is what we expected. In relation to ownership, the actual land side's owned by a corporation, so we don't have to go through native title and other various hurdles that you normally would go through. You'll see there that we're only interested in the oxide side, which is the high grade. It's the dedicated iron ore trains that go to the rail terminal, which is only 15 kilometres from us. So again, it's all about logistics. This is a mine that's 50 kilometres south, 1.5 million tonnes a year. That's just the basic plant they use, very simple. It's all dry processing. You don't need water. It's the big difference in relation to these high grade. This is the operation that's 17 kilometres west of us, who are delivering their ore over 3 million tonnes a year to Vale. This is another operation, same thing. We're not doing a lot different. We're the only public company to have a deposit like this. And again, we're going back to this map, which is all about the logistics and all about delivering the ore. So with the iron ore space, it's not as well known in Canada. We did a private funding on that particular project. We raised $3 million, which Max Resource now owns 75% of the iron ore project, and that's how we've completed all the exploration and drilling programs. We got results coming out over the next 3 weeks. As a comparison, our target is around 50 million tonnes. You can read these slides later. See, there's been takeovers in just 2025. There's been 3 takeovers there of junior companies ranging from 75 million through to 254 million. But the disadvantage they've got is, we look down the haulage side, is their distance that they got to take the ore to the shipping port, and they've been taken over by majors that actually got use of the railway line, and that's in Western Australia. So we've got a clear path to be able to have all operations in relation to being able to start digging ground in the first quarter of 2027. We've gone through those delineated drilling. We've completed. Environmental permitting is on the way. They're all being completed. Our next step is resource drilling, and resource. We've started the definitive feasibility study, and we started the development of mining approvals to be on track to be in a position to have all operations to target mine, or the authorisation we're getting is 1.5 million tonnes a year, which is quite substantial. Like I said, in relation to, if you're looking at iron ore prices of around that $100 US a tonne. So this is a comparison. The top slide is a high-grade mining operation that is owned now by Mount Gibson Iron. I was managing director of a company called Aztec Resources. We started with an old open pit that was flooded. It's on an island. We developed it. We developed it over 3 years. We're taken over for $300 million. And if you look at the number there, and this is how much demand this high-grade iron ore is, you're looking at 24.9 million tonnes, and we're taken over for $300 million. Our target is very similar, and as a comparison, we have the historical pit here. It's smaller than what was at Koolan Island, and the common denominator between these two projects is Koolan Island, the ship comes direct to the deposit. Our common denominator is the buyers are within 20 kilometres, and that's really the huge advantage that we've got. So just to review, Colombia, we're coming now to the exciting times of coming into the drilling phase. We've got an approved budget for 2025 of roughly $6.5 million in Canadian dollars. And then from Brazil, we're now coming up to the stage now where we're going to be doing the resource drilling, complete the components of the feasibility study to then be in a position to be cash flow positive in 2027. And that's it, a very simple story and two very simple projects. So thank you.
Thank you very much, Brett. Up next, we have West Red Lake Gold, which is advancing its flagship Madsen mine, as well as other high-grade gold projects in Ontario's prolific Red Lake Gold District. Please help me welcome Gwen Preston, Vice President, Communications of West Red Lake Gold Mines.
Good afternoon, everyone. Thank you so much for being here. I've got an exciting story. It's a really exciting story because we turned on our gold mine 2 weeks ago, a little bit ahead of schedule, which felt good for us to do. We did that after a month of significant news, including the results of our test mining program, which validated the workflow and supported our decision to restart the mine. And now that we're restarted, we are sort of on our way to unlocking the additional value opportunities that we see at this mine, not just that we see, but that are sort of in hand, in line for unlocking at the mine. So I will take you through it. I definitely make a lot of forward-looking statements. No, I don't, but it does take 2 slides to put the disclaimers on. Okay, so new gold producer, and I mean, I put that as the top point because just given what has happened in the gold equities space over the last decade, there just aren't a lot of new companies putting gold mines into production in 2025. So it's an unusual, it's a rare thing to be putting a mine into production in this phenomenal gold environment, and we feel very lucky to do it. It was the rationale for founding the company 2 years ago, is to give investors exposure to the value that's created with new gold production. And so that's coming to play right now with the Madsen mine, which is our first operation. And we hope to do it again when we find our next asset. But for now, let's focus on Madsen. Okay, so Madsen, to look back before we look forward, I'll keep it brief, but Madsen is in Red Lake, Ontario, on the western edge of the province, a storied gold district, to be sure, one of the most famous in Canada. 30 million ounces of gold have been pulled from the rocks of Red Lake over the last 100 years. They are, in fact, celebrating the 100th anniversary of gold in Red Lake this summer, and we'll be part of that for sure. Madsen is a mine that contributed to that production, produced 2 million ounces in the 40s, 50s, and 60s from nice high-grade material. Then the price of gold in the 70s came off. The mine shut down. It was largely quiet for quite a few decades. The next effort at the site that matters is a company called Pure Gold, which is likely a familiar name to at least some in this room. Pure Gold saw an opportunity to create a new high-grade gold mine in Canada based on the Madsen mine. They bought it. They did a lot of good work, especially at the beginning, including 180,000 meters of drilling that defined the deposit that we still work with today, which is 1.7 million indicated ounces, averaging 7.4 grams per ton gold. Then they proceeded to put that mine into production. They permitted it, they built a very good mill, and they put it into production. Unfortunately, in the latter part of that, they did cut some corners, and unfortunately those corners handicapped the operation enough that it went bankrupt after 14 months of commercial operations. The asset then went to the senior secured lender, which was Sprott Resource Lending, from whom we bought it exactly 2 years ago. The deal closed for $6.5 million, a 1% royalty, and about 20% of our company at the time. So that's the backstory there. What we have done, the reason that we bought this mine is because we saw that the corners that Pure Gold cut, the mistakes that they made, were fixable mistakes. The gold is there on the ground. The gold can be recovered from the rocks. There was incredible value in the permitted status of the project. This mill that already existed, 19 kilometers of modern underground workings, huge value in this asset that could be unlocked with the right approach. And so that approach really starts, there was two areas where we say that they made mistakes. One was on geologic modeling, and the other was on infrastructure. So, on the geologic modeling side, 30 million ounces of gold in Red Lake have been mined, and the rule of thumb there is that you have to drill your deposit very intensely. These are narrow vein, high-grade deposits. They're very nuggety, and so you have to do a lot of drilling to know accurately where the gold is. Pure Gold did not do the final stage of drilling, which is the stage of drilling that would have tightened their drill hole spacing from 20 meters between holes down to the Red Lake rule of thumb, which is 7 meters between holes. They mined a resource on 20-meter spacing. Unfortunately, that wasn't an accurate enough or high enough resolution model of the deposit, and so they weren't mining in exactly the right places. So they delivered 3.5 gram per ton material to the mill instead of 9 gram, and that certainly didn't work. You can guess where the next statement goes. A huge part of our effort over the last 20 months has been tightening the drill hole spacing from 20 meters to 7 meters ahead of final mine design so that we have an accurate high-resolution model of the deposit. We've done 90,000 meters of that drilling from underground, and that work has filled out 20 months of mine plan, which is to say that we have done all the work for almost 2 years of mine operations ahead of us. And what we did very recently, I say we had a month of very exciting news flow. That started when we put out the results of the bulk sample, which is what's on the screen right now. The bulk sample is that we structured the first 15,000 tons of mining as a bulk sample. We had an independent group watching. They looked at they came in-house, they saw our model, they watched us mine, they watched us process and run the numbers. And the purpose here was to compare what our model said we would get with what we actually got out of the ground. Pure Gold absolutely failed on that, and so we needed to demonstrate that our approach fixed that problem. And you can see from those reconciliation numbers, comparing them, that it does. These numbers, where the tonnage, grade, and contained ounces of the tons that we mined in this bulk sample from 3 different parts of the mine, the fact that they are so close between what we expected and what we actually mined validated our workflow, and that was a huge final tick mark before we could put the mine back into production. We wouldn't have been ready for the final tick mark if we hadn't checked off these projects as well. I say there was geologic modeling issues and there was infrastructure issues. On the infrastructure side, there were just projects that were deferred, not done for the sake of not spending money by that prior operator, and that led them to an inefficient, high-cost mine. We have done all of these projects so that we have an efficient operation. If you want a mine to work, you have to mine the right rocks, and then you have to move that material, mine and move that material efficiently. So a whole bunch of capital projects that all support efficient operations and are all complete on site. So we finished the bulk sample. This is a show me story. This is a mine that failed only 2.5 years ago. So we always knew that the market would need evidence that our plan worked. And so the bulk sample results were our first opportunity to provide that evidence. Based on that bulk sample result, we restarted the mine. And now I suggest that we are at the beginning of earning the value that Madsen deserves as an operating mine. So I'd say we're at the bottom of the second rise of the Lassonde curve. That's where the bulk sample put us. We have gained in the last month, which is really gratifying to see. I think the question then is, where does the rise take us? What is the value of the Madsen mine as an operating asset? To start that, I think you look at our pre-feasibility study, which is our official mine plan. That's something that we put out in January. It generated good economics, for sure. It put an almost $500 million NPV on the project. it said that we would get an average of over $90 million of free cash flow over the mine life. So those were good numbers. But, and this is an important but, that pre-feasibility study, the mine design part of that pre-feasibility study was done using a pretty low gold price, a gold price of $1,680. To be clear, the financial model, that NPV and cash flow, the financial model was done using $2,600 gold. But the mine design, which is where you decide what parts of the resource are in consideration for the mine, that was done using a 3-year trailing gold price, so $1,680. That's like a cutoff grade of just over, around 3.8 grams per ton, which is to say that everything that graded less than that was ignored. That really matters because that workflow that I described adds 2 really important pieces of information to final mine design. First, you do the definition drilling. In Red Lake, 20-meter spaced holes can often miss high-grade lenses of mineralization. That's the way that these vein systems work. When you tighten the drill hole spacing, you have a better chance of hitting those. So we are delineating more high-grade lenses as we do the tighter space drilling. So that's one impact on what the final mining shapes are going to look like. The other impact is mine design is an economic process. We use a gold price in mine design, just like they used $1,680 in the pre-feasibility study. That created a mine that was focused only on small mine shapes that were very high grade and required a lot of tunneling, essentially, to get between them. We're using the long-term consensus gold price of $2,350 per ounce in our mine design, and that's creating quite a different mine, a larger, more efficient mine. These are images from a news release that we put out yesterday morning. They compare the stopes before that workflow, which is the images on the left, with how the mining shapes look after that workflow, which is the images on the right. And so you can see that when you define more high-grade gold and then incorporate some of the lower-grade mineralization that is a halo around the high-grade, because it is profitable to mine at $2,350, when you incorporate those, you end up with much larger mining shapes. And that's really important for 3 reasons. The first is that the really selective, high-grade focused pre-feasibility study assumed that 60% of our mining would be by cut and fill mining. Cut and fill is appropriate for small stopes, but it is more expensive than the other kind of mining, which is long hole stoping. Now, when we end up with shapes that are the larger kind that we are actually ending up with, those are all amenable to long hole stoping. And I say that because our bulk sample was completely mined by long hole stoping, and our 20-month mine plan is only long hole stoping. And that matters because you can see the cost difference. These are the mining costs per ton, not all in costs, but these are the mining costs per ton for long hole stoping versus cut and fill. So there's a tangible difference in the mining cost when you can do the entire mine by long hole stoping instead of 60% cut and fill. The other 2 advantages to these larger mining shapes are you don't have to do as much access development, which is the technical term for tunneling to the area that you're going to mine. You instead do one tunnel and take a whole big chunk instead of doing multiple tunnels to get to small stopes. That's a benefit to sustaining capital needs. And then there's just efficiency. Mining larger spaces is a much easier thing to schedule and operate when it comes to personnel and equipment and how you're going to move material around the mine. It just all works a lot better. I know there's a lot of numbers on this slide, but these are just our last 4 sets of definition drill results. They're all from a part of South Austin, where we're defining like a 350-meter panel of really high-grade gold. And I would point out that in the 20-meter spacing mineral resource estimate, only snippets of this panel exist in that model. That's one of the reasons why you do the definition drilling, to find out where the high-grade gold really is, and it can really benefit you as you're doing that economic mine design. Okay, so if we want to talk about what the Madsen mine is worth, if we're being re-rated towards the value of this project, You have your PFS as a base case. You have the reality of what the mine is actually operating as, which is a larger, more efficient entity. And then there are 2 deposits that are in hand, but are not yet in the mine plan. One of them is Fork, which is, you can see the word Fork right beside, on the left side of the second image there. It's right beside the mine. It was ignored by us and by the prior operator because it's a low-grade thing, but we've recognized a high-grade core to that deposit, which you can see in the purple colors there, and it's only 250 meters from the closest workings. So we will incorporate that into our mine design, and it's a nice near surface, near infrastructure potential for mineral inventory, which is nice optionality when you're doing mine design. And then there's the Rowan project, which is 80 road kilometers away, only about 30 kilometers away as the crow flies, where we have a 300,000 ounce resource, 2/3 of which is in the indicated category at 13 grams per ton. So that's a very nice deposit that also is nicely shaped for mining. It starts at surface, it's steep, it's relatively wide, and it's nicely continuous in the areas that we've defined. And so we are working on a PEA to capture what value that can add as a source of supplemental mineralization to Madsen. So when you put all of those together, these are the considerations that you need to have in your mind when you want to understand what Madsen is worth as an operating entity. And I say we're just starting, I believe, to unlock that value because we've now given the market evidence of our plan working. And so I think that these opportunities are starting to be valued in the market. I'm out of time already. I would love to talk to you about our team. Our real power is operational experience, and it's deep on this team. So I'd be happy to chat with you about some of the backstories of the faces that you're seeing here, and also about our share structure. We put $130 million into this project in the last 20 months. We did financings to do that, and we took on a $35 million debt facility. But we are now in a position to ramp up this mine from 500 tons per day right now to our production target of 800 tons per day, hopefully by the end of the year, and then onwards from there. That is the fast version of the West Red Lake story. Thank you so much for your attention. And anybody with any questions, I'll just be outside afterwards. Thank you so much.
Great. Thank you very much, Gwen. It is now my pleasure to welcome the Geopolitical Critical Metals Pipeline panel, moderated by Matthew Zanlowski of Greyfriars.
Good afternoon, everyone, and I do realize we are the second to last panel between you and happy hour, so we will endeavor to be both entertaining and brief as much as we possibly can. But again, first and foremost, again, thank you to Joanne and to my fellow panelists for coming and speaking with you this afternoon and sharing your perspectives on geopolitical risk. Just a brief note about structure again. We'll have just some introductory comments by myself, introductions from each of the panelists, and then some free open remarks on their part, some structured Q&A, and if we have time at the end, we'll open it up to the floor for questions. So first, as we were assembling this panel discussion, the thesis that we came to was that geopolitical risk was the single largest driver in the mining sector today. But that being said, as we start to unpack geopolitical risk, one of the things that I'd encourage you in the audience to think about is just how much of this geopolitical risk is wholly new, or is it simply that we are struggling to keep up with the pace of the new normal? Moreover, it's relatively common to think of geopolitical risk as a negative or as a dragging down factor in the critical mineral sector. But on the other hand, is geopolitics actually opening up new doors and new opportunities for mining projects? So just to give a few examples of things that are not new and new. It's not new that tariffs are a key part of U.S. government policy on critical materials. This was certainly the case during the second Bush administration with steel tariffs, certainly during the first Trump administration with steel, aluminum, and other tariffs. However, what is a little bit new is the magnitude and the pacing at which those tariffs are starting to arrive. It is not new to see the Defense Production Act being used for critical minerals of all sorts of stripes. What is new is the clawback of U.S. government spending, for example, on clean energy projects, or possibly even the clawback of Inflation Reduction Act incentives for mineral processing in the United States. It's not new for the United States to harangue its allies on military spending, whether in NATO, East Asia, or anywhere else around the globe. What is certainly new is to see our European allies, and particularly the European Commission, step up in a very significant way to provide new funding for military spending and general industrial investment across the Eurozone. It's also not new to see tension between the United States and China on supply chains or critical technologies. In particular, think about the exfiltration of critical technology through cyber attacks. However, it is new to see critical minerals being used as a potentially deliberate tool of strategic leverage and strategic competition. So with that foundation in place, I'm going to turn it over to my panelists now to go one at a time for some introductions and opening remarks. So Bella, we'll start with you.
Yep, thank you. Appreciate it. So my name is Bella Onken. I'm from KfW. I'm responsible for the mining sector in North America, which is Canada and the US. And I mean, I think what you just said, I mean, yes, I see it greatly as opportunities now from the geopolitical perspectives. Just as a quick introduction, who we are, KfW Apex Bank is a bank owned by the German government, but it's operating as a full commercial bank. We have our own banking license. So we are acting as a full commercial bank, but with a clear mandate as well to support our purpose. And one of the purposes we support is to promote transatlantic business or transatlantic trade, or promote relations between the European Union and its allies, which has never been more important than today. So it's a time which was very exciting to be here. I've been with the bank 20 years. I've seen mining projects for a while evolving, but I've never seen so many mining projects building up in North America as now. I mean, it used to be that, I mean, we have been a big financier of mining projects on a global basis. Most of our projects used to be in South America, in Asia, Africa, politically very challenging jurisdictions where you have complete different geopolitical risk, what we're talking about today. And yes, I mean, we're here to support North American mining projects, which also have a link to Europe. So in a partnership approach where the projects benefit the region, the host country, be it the US, be it Quebec, be it Canada, but also bring some benefit to the European Union, which is our shareholder. So we like to have our partnership approach here, and we believe that is well done in our alliance, in our global alliance, and with our allies. And I see wonderful potential now working across the US, Canada, and Europe on bringing that supply chain together and getting more independence from China and other nations of concern, as we call them.
Francois?
Thank you for the invitation. François Vézina, CEO of Dumont Nickel, President of Minéraux Critiques Stratégiques Abitibi. Mining engineer by training, been with several mining companies. Newcomer to the critical and strategic space, I've always been in gold, so substantial change. I've been with Dumont for the last year. The Dumont Nickel project is a project in the Abitibi region, has been known for several years, has the permit, has an IBA with the nations. There's a new twist with the Dumont project right now with the critical and strategic space developing with an intent to provide material to the EV market lately. An open pit mine with the production about 42,000 tons of nickel annually, life of mine of 29 years, reserves of 1 billion tons. It's a rare project, a low grade. And you know, the EV market and critical and strategic new development and has opened up doors to the original project that intended to send the nickel to the smelters in Sudbury. So it's an interesting time, definitely. And Minéraux Critiques and Strategic Abitibi has been developed to support the Dumont nickel project, but other projects also in the Abitibi space right now. The fund, both projects are owned by Quintera Capital, a private fund that has envisioned and looks at the market before purchasing the project. A bit different than what we do usually in the mining space. You know, they look at the market, the potential, and I'll be discussing about that in this panel.
Yeah, and can you hear me? Yeah. My name is Keith Spence. I'm the principal of Global Mining Capital. We're a private equity M&A shop. We specialize in late-stage near development projects globally, or sweet spot projects that are shovel-ready and about to go into production. We like projects outside of the Anglosphere, which I'm going to talk about. So that's projects in Latin America, Africa, Central Asia, Southeast Asia, and a sprinkling of projects in certain European countries. In general, our appetite is for projects that are strategic. So we like all the critical minerals. We like gold, we like copper, and we like uranium. Our big three is gold, copper, and uranium. But we like all the other critical minerals. The only thing that we were not too particularly interested in is iron ore and coal. I touched on that bifurcation, and just to develop that theme later on, the world has now bifurcated into two camps, and I've talked a lot about this. I spoke about it recently in New York. We have what I call the Anglosphere, which is basically the old Western world, Canada, Australia, the EU, and the US, and some of their affiliates. And then we have the Sinosphere, which is dominated by China and Russia. And then sprinklings of a third camp, an emergent camp, I call it, the emerging opportunists, which used to be called the non-aligned countries, and that includes some of the BRICS countries like Brazil, India. I'd put South Africa in that group, straddling both camps, and I'll also put Saudi Arabia as a new player in that group. And what we're seeing is the two big camps, the Sinosphere and the Anglosphere, competing for influence and dominance among the former non-aligned countries, which is I say, the emerging opportunists. And what that means for the mining space, and that's the key point, you know, people, I used to be a project financier. I worked for three of the major banks, Bank of Montreal, RBC, and Scotia for a very short time. And I did a lot of projects around the world. But one of the things that we're seeing, the typical risk used to be, is the infrastructure there? What about the local political risk? Which is, I want to differentiate country risk from geopolitical risk. Geopolitical risk is the interaction of countries and blocks of countries, as opposed to specific in-country risk, like risk of expropriation, or creeping expropriation, or changing the tax regime, and some of the things that are done locally. What we're seeing now is that this big geopolitical risk is really the elephant in the room, and I'll talk about it more later. You know, it's affecting funding. I would say it's affecting valuations. It's affecting M&A probabilities. It's affecting a lot of possibilities within our space, because before you had one large pie, and now the pie is divided into half. And I would argue one of the reasons why the juniors are suffering so much and have been suffering so much until maybe I think the last month or so, where they're starting to see the light at the end of the tunnel, is because the pot of money that is available is only half of the pot of money. Some of the other things that I want to talk about is the China factor, but we'll talk a little about that. I ran a company, Alliance Pacific Resources, in Western China. I spent more than a decade plus in Xinjiang, which is the westernmost province of China in the Gobi. We were looking for gold and base metals. And that's when China changed from what we call investee country, i.e. people going to China. At least there were about 80 Canadian and Australian companies listed in China at one time. And now there's one, maybe two, you could argue two. And that whole dynamics have changed. And there's a lot of China dynamics in the bifurcation of the world. I'll talk a little more about it. So for now, I'll just keep it there.
No, I appreciate those comments. Now, we're certainly going to come back on that bifurcation topic as well. So first, actually start, Bella, with you for a question. And that is, certainly as a engineering-focused sector, it is very easy to turn negative when assessing a project or assessing risk in a project. But one of the comments you brought up in the introduction is that at the same time, geopolitical risk actually presents opportunities for companies as well. One factor that comes to mind is that also certainly, yes, rising energy prices in the Eurozone following Russia's invasion of Ukraine was decidedly not positive. But on the flip side, that probably formed some sort of a catalyst for the European Parliament to adopt the Critical Raw Materials Act. And so I want to pull on that thread a little bit about where do you see the opportunity space from geopolitical risk?
Yes, and that's an excellent point, and I like the way you phrased it, or you framed it, because I actually see and we discussed it before, I see geopolitical risk less as an obstacle today for the pipeline. It's more like a driving factor. It's actually an accelerator, and it's a big opportunity, probably one of the most historic opportunities for the Western world, European Union, US, and Canada, to come together and build a strong alliance in the supply chain, to develop jointly together critical minerals, which is needed to keep the Western world, the industrial world it is, and keep the competitive edge against China and other emerging countries. And I would say what you mentioned earlier, yes, it has been a wake-up call for the European Union, or especially Germany, my home country, with the Ukraine crisis, because Germany, as you all know, has been extremely reliant on the energy supply from Russia, getting the gas from Russia. And so when each of a sudden that supply chain stopped or was no longer as secure as it was, and electricity prices basically tripled or quadrupled in Germany, it was a wake-up call. I mean, fortunately now the situation has improved. I mean, the European Union learned, they diversified their sources of energy. They got sources from energy now from many different countries, including the US, which actually is a positive example how actually that helped to bring the US closer to Germany and the European Union. But that was a wake-up call. You don't want to depend on one country or one supplier. It's just not a good idea, and especially if that country you're depending on is not a friendly country like Canada or the US, but a country that can turn around any moment and show the ugly face to you. So that was a wake-up call, and I think that certainly stimulated the European Union to think about critical mineral strategy and supply chain, and now, I mean, Western nations have realized that there's extreme dependency on China. I mean, 1 year ago, I was hearing a US senator saying that the US has never been in such a situation before in the history, being dependent on one country, which is not even a country that is friendly to the US, on such a critical supply chain. So that's why Donald Trump, in his executive order, also said he wants to strengthen the US supply chain in critical minerals and ordered the US Exim Bank to support that projects. So I see that Canada has done the same, supporting massively projects. So the government of Canada, all entities of the Canadian government from the provinces. Quebec is doing a wonderful job working on several projects we're working on. And besides all the noise we see on the tariff front, what you mentioned, I see a wonderful opportunity for the US, Canada, and Europe to work closer together, getting a strong supply chain and bundle their forces. Of course, each country wants to secure critical minerals for their own country, but also we can do it together. And then I think that's the opportunity. And I think, yes, there's a strong understanding that Canada, European Union, and the US are strong allies, and doing something together is better than doing it against each other. And especially if we have, as you mentioned, such a big elephant in the room like China, who is basically, I mean, if you look at the processing facilities, and I mean, your project is a wonderful example for that.
Yeah, on that processing, I have some numbers.
Yes, I mean, 90% of current processing facilities, for example, in cobalt, is in China, which puts the Western world in a huge dependency. And I mean, we have seen it. We have seen in the last weeks where China used the poker card against the US, basically by putting restrictions on minerals, which are critical to the US. So I think that has been a wake-up call for everybody in Canada and the US. And so I see it as a wonderful opportunity. And to first, I love it because I love the European Union, Canada, and Europe, and the US working closer together. It's all nations I love. And so I think it's a wonderful opportunity for bringing them together closer, but also from a business perspective, I'm very excited because I've never seen such a strong pipeline of very promising, interesting projects in the US and Canada. Actually, Francois sitting next to me, representing one of the projects, Dimon Nickel, one project we're looking at as well, which is a wonderful example. And so I think that is exciting times, and I see it's overall is positive. Yeah.
So actually on that point, that's actually a perfect segue over to you, Francois, to talk about your nickel cobalt project. I mean, just one very quick framing, and that is certainly the past couple of years we've gone from, frankly, white hot demand in the automotive sector in North America to something that is either more muted, depending on your perspective, or something that's frankly just more sustainable as a long-term demand driver. And so in addition to addressing how you've perceived or experienced geopolitical risk for the Dumont project, could you also talk to, for example, has your strategy really changed at all? Or is it simply maintain the current strategy, but you now have new and much more interested partners? And I believe you also have some additional news about some strategic flag on your project.
You do. Putting me on the spot. So I'm privileged to be here with two gentlemen that knows more. I've been educated really the last year because my background is all gold. And, you know, I'm more mine builders. I've built mine in Abitibi, Finland, and Mexico for different companies. This is very interesting time. That's brought me to Dumont project. You're asking, and how Kinterra Capital approached me with this was, you know, everybody knows to build a mine, you need a lot of capital. They told me about that, but I was wondering because very, very different approach than from gold. You go on the market and you look at that, and I said, you know, I've been in Cisco Gold Royalties, and we've looked at the critical and strategic space, and the market is essential, and it has evolved drastically. So all this introduction to come to the point, I think one of the, as mine builders, as building the asset, one of the mistakes we're doing, most of us, is looking at the macroeconomics. I think you're going to talk more specifically, and I agree with Bella that you need to go more specific. And all minerals are different in the critical and strategic. Very, very different, very different space. I'll talk because I've been educated and I've read a lot, and they've been patient with me, but you look at nickel and cobalt. Okay, everybody knows nickel is mainly produced from Indonesia. We still have that tendency, and news goes out there. I've looked at numbers also from last year. Still 70% is going to stainless steel. And right now, everybody's bragging about, essentially, the market is increasing in its EV market, but it's still just 15% of the whole production of nickel worldwide. So it's not true that nickel produced in Indonesia essentially goes for the EV market. The other byproduct we have, and you could see the difference, is cobalt. So now cobalt, very different space also, coming from Congo, but 50% of all cobalt right now goes to the battery industry, the rechargeable battery. So 15%, 50% and 15%, very different market. I would say, and I'm not going to say I'm an expert on lithium, but people need to go and look at the market. Instead of, if we build it, they will come, the market will come. I think the critical and strategic is completely the opposite. You need to look at the market. There's regionalism also that you need to be attentive. You need to look at infrastructure. So for the Dumont project, the Quintera Capital partners have always intended to go to the EV market and the car manufacturers. And they wanted to use the momentum that is here in Canada for Bécancour, that's developing the battery industry in Ontario. Quebec also was supportive, very supportive of those developments. You had the panel previously about the investment that Investissement Québec, and they're supportive on that. And it is true, it's working. Ontario as well. It's funny, we've never changed the strategy, and car manufacturers are our main focus and our main client. We negotiate offtake. Very different from going publicly on the market to sell something. And I think that's one thing that everybody has to learn in the mining space. We're basically doing a concentrate. The mine doesn't add a lot of value. And I wouldn't say cost-wise or price-wise of this is there's offer, demand, and this is what we see out there, but there's need. And for the car manufacturer, just coming and having a deal, an offtake deal with them to secure the supply is what they want. I've been very surprised when we've done due diligence with the car manufacturers. The question were not technical, is secure this for 10 years. And it's a complete different angle from my past in gold. And I think you're going to see more and more of that, but you need to add value. The Dumont project has been around for 15 years. Actually, Keith, you were involved at a certain point.
With the Chinese.
Yes. He was talking to me about it. But I would say the Dumont version 2.0 is adding a processing facility, adding to it to produce an MHP. And not going to nickel sulfate, because that was interesting. That's essentially what the car manufacturers use, but every car manufacturers have a different type recipe for the nickel sulfate, but MHP is universal. And the Dumont project, they came to see that it had very interesting mineralogy. Basically, it's doesn't have any contaminants. So that's created the value of the project. But they went backwards, not looking at the deposit and trying to find a market, looking at the market and finding a deposit that could satisfy the market. So coming to your point, we've never changed strategy, and I think it's catching up to us positively right now at this point.
Yeah,
it's great.
Just one point I wanted to develop is with respect to geopolitics and China. There's lots of, I talked about risks and downside, but there's a lot of opportunities also. But one of the risks that I wanted to talk a little about before I talk about some of the opportunities is the fact that almost everything is processed in China. That's the bottleneck.
Exactly.
We forget that, everybody say, oh, I have copper mine or whatever, but almost everything is processed in China. We in the West, the Anglosphere, gave up that business because of environmental concerns. Nobody want a smelter or processor in California or in Canada, or we haven't been building, or even in Australia. So not only for environmental concerns, but one of the key things nobody talks about, we lost the skill set in how to process some of these critical minerals. It's unlike just normal processing of your classic base metals, etc., except, you know, in your unique case in Dumont, where you use high pressure and different kinds of. But in normal processing, it's almost like, I say, like a great chef, where you add a little of this, a pinch of salt, a pinch of that over time, maybe a little more pepper. And so the alchemists of refining and processing, the Chinese have have really exceeded and excelled in that area. And so, notwithstanding the environmental issues, I think if we try to do it in North America, and we're trying to do it, all the Anglosphere countries are trying to develop processing capability, and they might get over the environmental issue where people say, well, we're going to give you the permit. But I think they still have that alchemy of cooking the dish and having the chef. One of the things I wanted to talk about, just touch on, I have some statistics I did in New York last week. I think that these are quite profound statistics. A lot of, in terms of processing, let me see if I get it here. I had it here. Just when you need it, right? I had it before, and now suddenly I can't find it. Yeah. Okay. Here it is. Okay. China produces 65% of the world's rare earths, but China processes 90 to 95% of the world's rare earths. China processes and refines between 60 and 70% of the world's lithium. So we're talking about lithium here in Quebec, and we're talking about the lithium valley in Brazil. You know where it goes? It goes to, I'm doing some projects in Brazil, and everything is shipped to China. China processes 60% of the world's aluminum. That was a surprise for me, because aluminum, which is bauxite, is a power business, just like iron ore is a logistics business. And we have great power here in Canada, and you know, we had Alcoa and Alcan. And most of the downstream processing is China. China processes 40% of the world's copper. That's a big, you know, there's smelters all over the place. I didn't know almost 50% of the world's copper is China. China produces 65% of the world's graphite, but, and here's the key point, China refines over 95% of the world's graphite for EV batteries. So no matter what you do, we mine it here, we explore for it here, it goes to China. China processes and refines 73% of the world's cobalt. And I know you have some cobalt in Dumont. While the DRC produces about 73% of the world's cobalt, China controls 15 of the 19 cobalt mining projects in the DRC. China processes and refines 70% of the world's nickel. While Indonesia produces about 50% of the world's nickel, about 80% of Indonesia battery nickel production is controlled by China-related companies. And almost 50% of additional new production in copper and cobalt and lithium is in some form either comes from China or related to China. So the China factor is something that we'll have to deal with. And I see a lot of opportunities here, of course, opportunities here for building our own processing facilities, but it's going to take a while to do so. Some of the other big plays that I'm seeing because of this geopolitics is security for minerals. So everybody knows about the deal with Ukraine that Trump is doing with Ukraine in terms of a security package for rare earths and other minerals. But the DRC went to Trump and the US to do a similar package. And I just heard through the grapevine other countries in Africa are trying to get security for minerals package. And I laugh about this because the US has Canada next door, which has most of these minerals, and we already have a security umbrella of NORAD, the North America Defense Pact. It will be easy to just to go north and firm up your security package with your next door neighbor. That is another issue to look at.
I can't see Francois objecting to that at all.
Yeah, well, that is something. And one little point I wanted to say before I forgot. I wrote a piece last week in the Assay magazine, and I talked a little about how the tariffs on Canada is actually turning out to be a blessing in disguise. Because number one, it's forcing young people and others, and your taxi driver, to appreciate what mining is, and realize that resources are good. So the image is going to change. So we're going to gain a lot on the image side. And then the other key point, and which is as important as the image, is that permitting will now happen. And people aren't going to say, not in my backyard. It's not going to be 15 years to develop a mine. We might be 5 years or less, because this is high speed. And the new government in Canada is talking about one-shop stopping for one-shop permits. So that's some of the opportunities from the geopolitics. And so geopolitics has its negatives, and the negatives have been in play for the past few years, but I think some of the opportunities are coming to play.
So for the next question, it's going to be 2 minutes apiece. And then we're going to close out unless folks have some burning questions. But in this case, it's going to be my turn to play the contrarian voice. So certainly when it comes to critical minerals, we've seen them go through these phases. So rare earths are the most important of the critical minerals. Battery minerals are the most important of the battery minerals. Uranium is the most important of the minerals. And then they go through these 2 to 4 year cycles where they're hot, and then they're not, and then they're hot again, and then they're not again. And so with that in mind, does geopolitics actually have staying power? And I'll give you a for instance. So currently there's a tremendous amount of stress around rare earth element supply chains, in particular to the automotive sector. But the vast majority of automotive companies don't produce defense products. And so is this actually a supply chain problem that requires immediate investment to fix? Or is this simply a short-term schedule disruption until the Chinese can figure out their regulatory regime? Do we really need to set our hair on fire over this, or is it just a 6-month blip until it evens out? So I'll start with Keith, and then we'll work back this way. So why does geopolitics have staying power?
Yes, I think it's more structural. I think it's going to be a little longer term, because if you look at the Anglosphere and their relationship with China and the way they look at China, I don't see the China of the early 2000s, where everybody was going to China. China was the great developing country where if we open a Coca-Cola plant, and one Chinese buy one Coke is going to be a billion Chinese and the multiply effect. I think those days are gone, at least for the short while. There's a book that I would highly recommend. It's called The Great Game, and I highly recommend it. It's about some of the geopolitics that happened in a place called Kashgar. The Chinese call it Kashgar. And in that book, they talk about how that's what, at that time, it was Britain and some of the big European powers, how the powers sort of, the machinations that went on behind the scenes. I think this is here to stay for a while. In my opinion, we'll have to adjust. I don't see it changing significantly. What I think might happen, and I was talking to a couple of people about that yesterday, is somebody playing the China card, and I think I touched on that with you, Matthew, where Canada, for example, could say, well, you know, let me play the China card and remove all its barriers. But China and Canada have terrible relations. We had a 3M problem recently, the last few years, so that might be difficult. But if China doesn't play the China card, what about the EU? They are now, you know, looking seriously at China, and I could see them playing the China card. So if the China card is played effectively by Canada and the EU, maybe, as you suggest, that bifurcation of the world and the geopolitics may subside, but it will still be prevalent.
Francois?
I think there's fundamental change structurally. I think Keith said it with China, but I think it's creating opportunity. Our project and our market that we're targeting is EU and North America. And, you know, we're one of the first out of the gate. We're shovel ready, so we have kind of an edge on the other project. But when we talk about fundamental change, for sure, I have no doubt there's an energy transition. We all know that everybody's asking more and more energy. And I'm going to give us one thing interesting that the partners at Quintera told me is, like in the United States, AI and data center, that's consuming 10% of all the energy in the United States that we're not accounting for. And I would be surprised that somebody would argue with me that this won't expand substantially. We've talked behind the scene. Here it's more EV market. You go to United States and now Europe, defense minerals. I think this is coming. But from one mineral to another, there's substantial change. From one region to another, there's substantial change. I would say rare earth, you know, we think huge mines, rare earth, doesn't take large quantity. If you look at the battery space, graphite is going to be critical. That's the most important minerals in a battery that's going to be rechargeable. Nickel, cobalt, and are more important in quantity to produce. So you need to take that into account. But I think there's fundamental changes structurally, and I'm not saying that we're going to be retracting from that. I think from one time to another, it may change. I think the key is refining here in North America and Europe, and this is the game changer to extract in those regions as we go forward.
Thank you. Bella, up to you to close this out.
Yes, I do agree what you say. I mean, I would say it is a fundamental change which has been triggered. And so I think we're moving there. Having said that, I also kind of agree what you say, that I believe and I hope personally that geopolitical risk, what we experience now, will become less prominent topic in the future, and China will work better on, will align well with the US and Europe again, and as they do now. I mean, there are good relationships between US, China. China is important to the US, we should not forget that. China is important to Europe. Europe is important to China, US is important. There's a bilateral, or there is a strong dependency in both directions. We should not forget that, and I think everybody was realizing that. And besides all the geopolitical noise we hear. So put it on positive things, and I think, so I mean, as for example, we financing battery projects in the US as well, which is a good example where the US is onshoring their capabilities to become less dependent on China. But China is supporting the US, building that factory. Some of the factories are built by Chinese or supported by Chinese technology, which is helping actually the US getting the capabilities to onshore it. So there is behind the scene a lot of positive things happening. So that's why I think the geopolitical risk, which is quite prominent now in the media, and we talk about it, will fade over time, which is good. But I think the trigger factor is also positive. It will bring more processing facilities, capacities to Europe, US, Canada. We have seen we need it. We've seen also we need projects like you, Dumont. We don't want to get all our nickel from basically one jurisdiction, which is also from an ESG perspective, maybe not the best. I think the Western world, especially premium automakers, what you're targeting as well, are also realizing maybe it's not a bad idea to have nickel from a country that has very high ESG standards. So overall, again, I see this as an opportunity. I think geopolitical is a triggering factor, and it will fade over time, but I think we will not go back. I think we won't go back that we say, oh, forget it, we just buy everything from China, let's get everything gone from China. I think that will not come back. I think it's a good working together and the process of moving together closer.
No, with that, again, thank you, Keith, Francois, and Bella, for the panel. Thank you all for your attention, and I think that'll wrap it up for us. But take care, everyone.
Thank you.
Thank you.
Thank you, everyone, for joining us for that panel today. Now it is my pleasure to introduce Don Wellman, Manager of Research and Development, Programs and Partnership of Copper Group of Rio Tinto. Don leads Rio Tinto's strategic research initiatives in copper innovation, helping advance responsible sourcing and technological development in one of the world's most vital metals. Over to you, Don.
Well, good afternoon, everybody, and thank you for being here. I appreciate you sticking around for this. So today I want to talk a little bit about some of the technical challenges facing us across North America associated with critical minerals and copper. Everybody's favorite disclaimer. So where are we at? Well, in total, North America is a little bit of a mixed bag. Canada is in a much better position, I would say, than the United States is. Canada produces 21 of the 31 critical minerals defined by the country and is not 100% import reliant on other countries for any of them in total. There are some that have somewhat of a reliance, some of the usual suspects, if you will, lithium, graphite, rare earths. But ample resources. Canada is really well endowed from a resource perspective. The United States, on the other hand, is in a bit of a different position. So over the past 19 years, the United States has become more dependent on foreign supplies for the minerals that it is defined as critical minerals. Of the critical minerals, we have 50% increase in the number of minerals that we are 100% reliant on other foreign supply chains of. That's in the last 19 years. And we've also seen a 75% increase in the number of minerals for which we are 50% reliant. So the United States is going backwards. And when I looked at these numbers initially, I was a bit surprised initially. But then when I stopped to think about it, I thought, well, no, we actually probably shouldn't be surprised by that. Back in the 1980s, the United States made policy decisions to use our foreign allies, use our friends for mining and minerals. We defunded all of the mining infrastructure, the universities, the Bureau of Mines, and lost most of that focus. So it really shouldn't be a surprise to us that the United States has continued to become more and more reliant. It really wasn't until recently with COVID where the United States realized the fragility of the supply chains and recognized that we have to do something, and we have to do something right now. But when we talk about the challenges that we're facing and the dependence that we have, in large part with China, this is not a situation that came about overnight. And it's not because China just happened to be better at technology than the United States or Canada. Certainly, technology is absolutely a big part of this equation, but it isn't the entire story. China recognized a long time ago, back in the 80s, that the key to global power in the future was going to be through critical minerals. And they established and put in place a geopolitical strategy that they lined up their entire country behind. They put a strategy in place to say that they were going to be the leaders in every unit operation associated with critical minerals. And they've been extremely effective at executing that. They changed regulation, they incentivized development of S&T technology in this area, they incentivized the development of the workforce in this area. There's a statistic that I love to use from 2022 in the United States. There was 600 students in mining-related fields within our university system. China had 1.2 million. They've been doing this and executing this strategy for over 40 years. So it's not like this just suddenly happened. But now we're faced with this challenge of trying to figure out, how do we suddenly catch up to this? Or better yet, how do we leapfrog? But we're starting from a place of weakness, quite frankly, because we no longer possess a lot of the infrastructure, a lot of the expertise, a lot of the technical capacity. We have broken supply chains, and although there's a lot that's being done in a policy perspective, you could say it's a little bit haphazard in terms of how it's being moved forward. Now, don't get me wrong, all of the actions, it's good that we're taking action. At least we're not resting on our laurels. Government, private industry, private equity, academia, technology developers, we need to be acting. We need to be trying to address this grand challenge. But I think one lesson for us to take from the Chinese playbook is an integrated strategy, which is something right now that we don't have. Our solutions, we have to go beyond the pieces. We have to get to the sum of the parts. We can't just have tariffs. We can't just have permitting reform. We can't just have technology development or tax incentives. All of those things are necessary, don't get me wrong, because we do need to lower the regulatory barriers. We need to address trade exposure. We do need policies that send strong market signals that we need to be making the investments, which are significant, to produce these materials. But I think we also need to shift the focus of how we do that so that it's integrated. The pieces come together. We need a strategy that really recognizes the need for material-specific approaches that recognize you can't always directly mine many of the critical minerals that we need to figure out how to produce. We have to recognize gateway minerals and co-products. And we have to recognize the material specificity of the approaches that we need. And I'll say more about that in the next slide. We need a strategy that has aligned policies to developing the infrastructure, the workforce, the commercial readiness, and that utilizes time-phased investment. I know I'll say one thing about the United States over the last 4 years. Boy, have we had money flowing, but have we taken really good advantage of it? I mean, it has just been spend, Get the money out there. Again, absolutely need to do things, but we need to be thoughtful about what we're doing. So we need some time-phased investment, but we actually need to have very clear understanding of what problems do we need to solve and how do we actually need to phase those things, which is going to come from strategy, roadmap, plan. I don't care what your favorite acronym for it is, but we need to have some way to actually bring those pieces together and bring that supply chain picture together to say, if I need to produce X, here are all the pieces that we need to line up to be able to produce X. Do we have those? What do we need to enable those? Is it policy? Is it finance? What is it? So we need to have that, and we need to have more market surety. One of the big challenges with many of the critical minerals is that the markets are very opaque, and relatively speaking, they're pretty small markets. I mean, I'm not talking about, copper and aluminum and things like that. I'm talking about all of those other critical minerals, which in comparison, it's a fractional market. But yet they still take huge amounts of capital and huge amounts of operating costs. They have big risks associated with them. So how do you incentivize anybody to say, sure, I'll go forward and I'll make those investments to try to produce that when I have little to no certainty of what the return on that investment is going to be? So how do we align those pieces better to really start to address the specific challenges that we have in the development of these supply chains? So to the point I mentioned about the material specificity. So mineral processing, so I'm a technical person, I'm a chemist, and I'm going to say that mineral processing is one of the worst words I think we've ever come up with. It is the most overgeneralized word. It overlooks the differences between minerals and how we move from a source to a manufactured product. Minerals, obviously we know, they're not immediately useful in their raw form. We have to extract them, crush them, separate them, beneficiate them, refine them, convert them into final form, increase the purity, meet the material specifications. There's a whole lot that we have to go through in order to be able to get there. And there's not one pathway for all the minerals. They're not all the same. And you can have the same metal, and it may have different pathways because it comes from a different source. But yet, the chemistry and the mineralogy that are dictating that and dictating the technical process needs that we have, that's what underpins the economics. That's what's driving the capital needed. That's what's driving the operating expense that's needed. That's where the risks are associated. And that's also where the market opportunity is. And I can say more about the United States than I can about Canada, but I'll say in the United States, we're in a pretty bad position on many of these. For the most part, we don't have complete chains. There's very few that we have complete chains for. But even if you look across our countries, between us collectively, there's a lot of the critical minerals that we have gaps in this chain. But that's something that's fairly easily identified. I mean, we can do the research to say, okay, if I want to produce, pick your favorite, if I want to produce tungsten, I've got a whole bunch of tungsten mines in Nevada. Okay, great, I can go mine tungsten. Problem is that none of the rest of it exists. So I can't produce tungsten as a critical mineral for defense or other applications. But we can go through and we can do that work to identify those and start to narrow in on what exactly are those opportunities. And that's one of the things that we've been trying to do. So from our copper assets, we've got opportunity for about 25 critical minerals, but at fairly low volumes. And so it doesn't make sense for us to invest huge CapEx to go forward and process them. So where are those partnership opportunities? Who can I give a fairly low product from our material that might be a really decent feedstock to a processor and say, all right, let's partner up on this. Here, you take this, let's get this together into the supply chain. And how can we start to build those partnerships to be able to do that? Well, this is what China realized, and this is what they've been doing. We still have big gaps in technology. We have big time lags. And China's got an integrated strategy where they've been very methodically walking through this. And as was well articulated in the last panel, and has been over the last couple of days, one of the aspects of this that we absolutely can't overlook is the geopolitical dynamics of it. And I particularly like this perspective that was presented by Anthony Vaccaro, the Northern Miner, and mining.com. I really liked the way that they talked about the spheres of influence that are developing over critical minerals and the processes therein. This is becoming a very interesting positioning of critical minerals and, frankly, global powers around critical minerals. They're using these spheres to define control. And as we always see in our world, we're seeing, countries with large militaries and large economies really working to define what these spheres look like and what they control. But these are going to be very, very different for each and every mineral, and even within one metal. So, this was the first one in the, hopefully, is a very long series. This was copper extraction. And, you can see in this one for copper extraction, probably no great surprise that the Americas are the dominant one for extraction, but you can be darn sure that when you look at processing or refining, the Americas are not going to be in the lead anymore. So these spheres are going to be very interesting ways to look at this and think about what does that look like? What are those power shifts? Who do we need to partner with for the different critical minerals depending on what our major national interests are? What do we want control over? Because it's going to be very difficult for any of us to produce all of our critical minerals independent of any other country. So, it's really not a big leap then to say that positioning and investing between various coalitions is going to become very important. And, for North America, it seems fairly obvious. The coalition of the willing, which is Canada and the Americas, is really going to be a very necessary partnership in order to secure North American supply chains if we want to reduce our dependence on some of the adversarial foreign nations. Canada, very well endowed from a raw resource asset. United States, not as much. Processing and refining assets, both have pretty good processing and refining assets, billions of dollars being invested. Expertise in human capital is going to be another big one that I think all of us recognize as a huge challenge. We suffer from the realities and the perceptions of our past, of our industry. We continue to work on that. It will always be a work in progress, I think. But we all face tremendous labor shortages and skill shortages now and into the future. And that's something that I don't think we can fix on our own. I think that's going to take a partnership of all of us. So this, to me, starts to outline, some of these interesting sweet spots and create a bit of a foundation that allows us to shift from focusing on, trying to implement policy that might fix this piece or that piece, or developing a technology for this particular form or this thing, all of these individual pieces, into really starting to define what's this ecosystem look like? What do these supply chains look like? How do we define specifically what we need to go do? What are those gaps that we need to fill? How can we do that as fast as possible and start getting these minerals into our domestic independence? And I just want to put a point on this. I love this study. This is by a colleague of mine out of the University of Michigan, Adam Simon. He's done a tremendous amount. He's an economic geologist, and he's done a tremendous amount of work looking at supply and demand gaps. This is one on copper. He's doing other ones as well. If you're in copper and you haven't met Adam or you haven't read his work, I highly encourage you to do so. He's got a bunch of studies out there and several more coming out, and it's really great work. But what I wanted to show about this, and let's see if I can get a pointer to work, and I'm not going to go into detail. Don't worry, there's no test on this or anything. But what I wanted to point out was just this graph, and this is a blowout of it, so you can see the detail if you want. It's kind of blurry there for me. I don't know if you can see it. But what I wanted to highlight with this and just really kind of emphasize, not that we don't already recognize the urgency of this, but I really thought that this was an interesting way to kind of highlight that, is that if we continue the demand status quo based on our current uses of copper, so not considering electrification, decarbonization of the economy, AI, not considering those new drivers, those new demands on copper, between 2018 and 2050, the demand goes up from 20 to 37 million tons of copper per year. If you do the aggregate math there, that means that we need to mine over 1,100 million tons of copper by 2050. That's 115% more copper than we have produced globally in 118 years. In order to meet that, we need 7 Tier 1 assets brought online every year for the next 30 years. And with an average time frame of bringing a mine online every 16 years, that means that something that we discover right now won't come online until 2041. It's a pretty grim picture and a pretty big hurdle, but hopefully it also is motivating. The demands are there. The demands are there. And this, you can do similar type analysis, and like I said, Adam's doing similar type analyses. He's going through the periodic table. Right now he's on semiconductors, I believe. And it's similar type challenges that are out there. So we can't say that the demands aren't there. We just have to figure out how do we work together to do it because of the challenges in bringing them forward. So I think this is the last slide. So maybe just a quick summary of some of these thoughts. Again, all the things that are being done, it's great that we're doing things. They're good things to be doing. We need our governments to remove red tape. We need them to help provide direct investment to support companies and scale up. But at the end of the day, private industry has to lead in developing commercially viable products. But we have to do it in a way that functionally manages the risks, the costs, and the timelines for delivery of these products to market. And that is really tough when you're talking about the critical minerals, particularly the low volume ones. Based on market obscurities, many of the things I've already talked about, the market obscurities, the high capital, the high operating costs, technical challenges, workforce challenges, I really think that we need to think more about how do we strategically align as mineral ecosystems. Where do we look for those partnerships where collectively we can start to minimize some of these risks? Minimize risks of market distortions by being able to have greater influence over the policies that are being set so that we can get market stability and set points with strong demand on the backside for these materials. That'll strengthen the rationale for us to make those investments and actually go forward with fairly significant investments for fairly small markets. It'll also help with our junior mining companies. It'll help by giving them a bit more surety, providing stabilizing agreements and access to capital. They're critical in this. And if we can define the chains to be able to say, okay, I need to produce this, this is the end product specification, here's a source, how do I get from point A to point E? Then you start to have some surety of what those feedstocks are from link to link to link. Then it's a lot easier to say, okay, yes, I'm going to go develop this processing technology because I see where it can plug in, I see that I can have a feedstock, I see that I can have an offtake. And again, I said this at the end of the last slide, I'm going to say it again, our people. We need know-how, we need expertise, we need the support of our communities, we need the support of our indigenous people. We need everybody to recognize the ability to be part of something that is really greater than all of us. This is about national security, whether it's about Canada, whether it's about the United States. This is about us being able to continue to deliver the things that we like to use every day. Our cell phones, our TVs, clean water through copper pipes, all of that. So thank you very much for sticking around again. I appreciate it, and bid you good day.
Well, hello. everyone, and thank you so much for another great day of speakers, attendees, and panelists. Thank you to Don Wellman from Rio Tinto. That was quite an interesting and revealing presentation, particularly on the copper side. I'd once again like to thank our sponsors and partners for their generosity. And just a reminder that this evening we have 2 special events, starting with our sponsors and cocktails and Korshak networking event, starting at 6 p.m., once again in the January Lounge, where we had our fabulous gala last night. And then later on this evening, please join us for the Atkins Realis After Dark event at the Hilton Ballroom on the 2nd floor. You'll see all the signage, you just go up the escalator. This is not to be missed. They are going to host one of the most amazing After Darks we've ever had. So please do drop in for some drinks and some live entertainment, commencing at 9 p.m. tonight until midnight. So thank you very much, ladies and gentlemen, for an incredible day and for listening to all our panels and all our speakers today. Thank you.